That's Charlie Michael Charlie Sandy Alpha.
So whatever side of the trade you're on today, be careful. This is still a market that can move violently in both directions. The liquidity picture is still a bit constrained. We are in that window of weakness, or at least that time where there aren't those passive decay flows from SPX options, commonly called Vanna and Charm, to bid up the market. We're in the buyback blackout period. And we also are in negative gamma territory. So all that tells you that you can have tails fattened in both directions, not just down, up as well. And it's important to appreciate that potential risk in terms of the size of trades you're taking on and your selectivity when you're trading. This is an environment to be more selective, to use smaller size and wider stops if you want to trade at all. Now, a lot of folks are focusing on the GDP miss. I would focus more on the PCE beat. That's what's important here, really, because what we're seeing here is a continuation of evidence, even from the Fed's favorite flavor of inflation, that indicates that inflation is not under control. PCE printing a quarterly advance of 3.7% at core, the Fed's favorite view of their favorite measure of inflation, is a far cry away from 2%, which is their goal.
The 10-year Treasury yield now jumps to the highest level in more than 5 months following the GDP report.
Oof, highest yield on the 10-year in 2024. That is not going to make equities happy. This is a phenomenon that we've been talking about
So
for
again, just
some
to
time.
recap in post here, is the GDP number did come in lower than expected quarter over quarter. That was at 1.6% on estimates of 2.5%. However, we did see the quarterly PCE and the GDP price index number both come in higher than expected, which does seem to have caused some weakness in US stocks here. The strength in the dollar and Treasury yields as well.
So I do think those risks of stagflation are something to appreciate, to build into our own models of how we're forecasting where the economy could go from here. I would be just a little bit more concerned about this data now that we're seeing so many prints in a row illustrating that same picture. And that's a picture of inflation coming up, and now
Fed swaps no
growth
longer fully
slowing.
pricing a rate cut before December. So again, Fed swaps now no longer fully pricing in a rate cut before December.
So we can see that liquidity building below us here in the heat map here on Bookmap. We can see that's getting us closer to the vol trigger level that the advanced SPX options visualizer has identified. If we do push below that level, it is likely that selling pressure becomes a bit more intense, as does intraday realized volatility. We're implied to open with S&P cash at about 50.10, NASDAQ 100 index at about 17,241 on cash. That would be down about 1.6% on the NASDAQ and 1.21% on the S&P. So if you missed it, Fed swaps are no longer pricing in any rate cut in 2024. That's a big deal. As I was mentioning earlier, we went into this year late December with the idea of up to 7 cuts. Now, there's a question as to whether we'll get any at all. That is a pretty significant shift in expectations, and I think it's worth heeding. And it will have impacts across a number of different markets, not just equities, which I know we all sort of focus on, but also rates markets. And I think that that's going to have an upward impact on the 2-year note, all the way throughout the 10-year note, repricing what's happening with inflation, with the economy, and with the Fed. And so, as I've been sort of adamantly saying, I don't think we're out of the woods with inflation yet. You know, obviously, I wish that was not the case. Like everyone else, I still have to buy food and I still have to deal with energy and all these other costs, services costs across the board. So, you know, like everyone else, I am a consumer of goods and services. I don't like rising prices. I can see, you know, my homeowner insurance going up, my auto insurance going up, like every kind of cost, you know, overall rising, health insurance rising, food costs over time rising. These are all compounding, and these put additional pressure on consumers who are already borrowing a record amount on credit cards and paying record interest. So seeing prices rise and the economy slow is kind of the worst of both worlds, because it doesn't suggest that people are going to have the staying power to pay those higher prices if the economy is slowing as those prices rise. Now, there's some that would say, well, a weakening economy should help to drop prices. It may slow their rate of ascent.
The European Commission are expected to propose new restrictions on 3 Russian liquid natural gas projects in a new package, according to sources.
So it may slow their ascent, but it really depends on what's going on in the rest of the world. It's not just the United States in isolation, and a lot of other countries around the world are cutting rates and trying to stimulate their economies.
S&P futures continuing to drop here, 50, 42.75 below, now down about 64.
So I do think that's something to take into consideration, that you know, we have these offsetting effects from other countries, their fiscal and monetary programs versus what we're doing here. And also, you know, unfortunately, this administration has made critical errors. The late cycle fiscal excess that they engaged in was one of the worst decisions you could possibly have made. Did it avert a recession? Sure. At what cost? You do know, and I'm speaking more broadly here, but, you know, to a greater audience, not just you all, but, you know, politicians should be aware that people would rather have a moderate recession than persistent higher than average inflation. The expectations here that, you know, a robust economy would somehow win the election are not working out as hoped. And I'm not saying this from a political vantage point, because quite frankly, to be completely honest with you all, I don't really like either party and what they have to offer. Okay? But when you bet the country's future, as they have, in this aggressive deficit spend, it's in fact the highest amount of deficit spend as a percentage of GDP with unemployment this low ever. So there is no reason for that largesse. And what did it do? It created demand at a time where there was supply inelasticity and started to push prices higher again when we needed relief from inflation. Now, any classical economist will tell you, when you want to expand the economy, when you want to engage in larger fiscal, that should be during a contraction. That should be saved for a recession. You're going to need that ammo during that time not during sort of a time of the economy slowing and hitting some speed bumps as they were, really leaning into the Chips and Science Act and the Inflation
US
Reduction
two-year
Act during that
Treasury
time.
yields rising now as well to around 5.018%. That's the highest since November 14th.
Boy, no one saw that coming. So I think that's part of the bigger picture, right? There's that fiscal dominance, that overwhelmed monetary policy. The Fed didn't get their job done. Now, a lot of people will blame the Fed for that, and they certainly own some of the responsibility. There's no doubt about
A
it.
senior U.S. administration
A
official
senior U.S.
says
administration
and 17 other
official notes
countries
that
to
the
release
response to
statement
the
calling
latest
on
offer
Hamas
from inside Gaza was totally non-constructive.
a deal on table would bring immediate and prolonged ceasefire in Gaza. That from
A
Reuters
senior
now.
U.S. administration official notes that they do see some indications that there might be an avenue for a deal, but not totally confident.
So point being, when you spend this much late cycle in the economy and you stimulate things this much in an environment where we're already late cycle and, you could say things were overheating a bit at that point, you're going to have this kind of outcome. You're going to have prices push higher more than anyone wants to see and stay higher. The Treasury Secretary has said, well, wages are increasing at a rate that exceeds price increases, so this is fine. No, they're not. And cumulative inflation shows us a
The
picture going
effective
back
Fed fund rate
50
is
years.
unchanged at 5.3.
50 years of data of rising inflation cumulatively, right? And there's all kinds of pockets that go up much more than the rate of headline inflation, like medical insurance, like student tuitions, like childcare costs and otherwise. So nothing's really been resolved. The people that exist in their ivory towers that seem perfectly happy to sort of ignore everything that's happening on the ground, unfortunately, there's likely to be a bit of an upheaval. I don't think that voters are going to be particularly happy about what's happened. And that's a big risk. And it's a bit ironic because a lot of these measures that were taken were trying to secure the election and instead may end up throwing it. So again, I'm not really political about this. I'm just saying it as a matter of fact. And as a matter of fact, classical economics would say, don't do all the things they did. And if you do them, expect this exact outcome, inflation coming back, right? And what makes it all worse is going into this year and really late last year, the Fed was flapping their wings all dovishly when nothing had been fixed. And I know there was a lot of
BCDA, myocardia completes enrollment of CardiAmp.
I know there's a
therapy
lot
to
of
treat
folks
chronic
out there
myocardial ischemia.
that were
That
saying
is Mike Bravo Charlie Delta Alpha BCDA.
I know there are a lot of folks out there saying, the Fed accomplished their mission, inflation came down, there was, every reason to cut. But the reality is
Cullen Frost with their results.
The reality is that's not the case. The inflation was never really under control. It was just subdued. And it's coming back in a pretty meaningful
Safe
way.
and Green Holdings.
And I think that matters because it does set us up for a trajectory where we could see this becoming more of a theme again.
Sandy Gulf Bravo X-Ray, SGBX.
And, don't take my word for it. Look at what's happening in rates. Look at what's happening in commodities. Look at what's happening in various measures of price pressure pass through to consumers. This is a big concern. And it does, again, set us up for opportunities in energy, industrials, materials, metals, and mining. It also sets us up for more defensive allocations in staples and utilities and aerospace and defense. And it really puts more pressure on tech and especially the smaller tech companies where we're seeing pretty significant relative weakness. It also means there's no real reason to buy bonds here, right? There's every reason to sell them, though. So I would be quite careful just blindly buying dips in some of the more popular tech companies
SGBX
here.
On that order news. Shares are popping here now, 21 cents. Sandy Gulf Bravo X-Ray up 50%.
Because I don't think that the story in risk sensitive or I should say rate
MAT
sensitive
Mattel
risk,
to bring 3 channels to Samsung TV.
I don't think the story is over in rate sensitive risk assets. I think there's more unraveling here. It's become a very concentrated area. With what happened to Meta, the story of the year of efficiency has been upended. The idea that, AI was going to be imminently lucrative has been upended. These were the 2 rails that this company rallied so much on. They've been thoroughly undermined. And this was one of the terrific two. It was really Meta and NVIDIA that were radically outperforming. Now we have to really see where things go with the narratives in NVIDIA, in AI. But I would also contextualize this as NVIDIA and Meta are not the same company. And what I mean is NVIDIA is a seller of picks and shovels, right? So they're kind of out there selling the tools that people need to build various AI capabilities, whereas Meta is a buyer of those picks and shovels. They're sort of like one of the prospectors in the gold rush, hoping to strike gold and not yet doing so. Now, Zuck talked repeatedly about all these different areas of AI that they plan to get into, and admittedly, they've created some impressive models. Llama 3, their large language model, is quite impressive. It really is one of the best open source models out there. But does that get them to a path where they can make money? How can they monetize this stuff? Is it going to improve their ability to put more ads out there on their platform or sell them for a higher cost, since that's really their main business and makes more than 90% of their revenue? And we saw with their advertising, growth was lackluster. So was it for their family of apps. So I'd say initially, the answer to that question is no. I've said for a while, AI is a show me story. We can have this hype. It always happens with new innovation, particularly when people don't really understand all the moving parts. You had it happen with Internet of Things. You had it happen with smart devices. We're having it happen with AI. It's kind of being built into everything, and everything is getting just a little bit ahead of itself in terms of where we are in reality versus where we are with hype. So I'd say we're at that sort of peak of inflated expectations in the Gartner hype cycle, and I would just be a little bit careful about what that means for companies that are more of the buyers of the picks and shovels versus the sellers. I think NVIDIA is also objectively overpriced here, but we have to see what happens with their narrative. It does seem like their sales growth is going to slow materially. It does seem like the monopoly hold they have on their CUDA-driven ecosystem is set to erode over time as other competing semiconductor companies build potentially viable alternatives at scale and also cheaper hardware products to plug into those software ecosystems. So I think that that's another story that will be challenged. We'll have to see what happens in late May when they report their earnings. But we have plenty of important earnings tonight. We've got Google, Intel, and Microsoft. Google with EPS expected at 152 and rev of 66.06 billion. Intel with EPS expected of 13 cents with rev of 12.7 billion. And Microsoft expected with EPS of 283 and rev of 60.87 billion. So I know there was some conjecture.
SGBX continued to spike here, 28 cents now, up 100.
So I know there was some conjecture here about the Fed's path and people saying, the Fed's looking too hawkish now. They've made this turnabout and they're saying they're not necessarily going to cut this year. Some folks even placing outsized bets in Fed funds futures, talking about, the Fed has to pivot dovishly. Be careful following folks that make these types of claims, regardless of whether or not they may have direct experience with the Fed. Because if you're really objectively monitoring what's happening in inflation, there's no convincing reason for the Fed to do anything resembling a cut anytime soon. If anything, their turnabout makes sense. And they told us that they would be driven by data. And the data tells us there's no reason to cut. And so now you see increasingly, even from Powell, more, I would say, skepticism as to whether or not that path is clear. And some speakers even saying they may need to hike again if inflationary pressure continues. So we've got just about 13 minutes. I'm sorry, we just got about 23 minutes left until the open here. Let's take a look at the NASDAQ. Similar look as the S&P, not really recovering from that GDP, but primarily PCE quarterly print. This is another one of those situations where the macro does matter. I know a lot of folks have also been content to ignore it and even make fun of it. I think that's a somewhat unfortunate look, quite frankly, because over longer periods of time, the macro always matters. Always. There's not a single instance where it doesn't over a long period of
DSX,
time.
Diana Shipping announced time charter contract for MVDSI Phoenix with bulk trading. That's Delta Sandy X-ray DSX.
So looking at that from the perspective of how these things play out, is it going to play out in the next 5 minutes? Often is the case, no. Although today it did. But these themes, they do play out over longer time horizons. And, you know, when you look at, for example, what happened in 2023, people would say, oh, macro didn't matter because the Fed was hiking and the market didn't fall. Well, you have to contextualize that with the Treasury and the White House doing everything possible to offset the Fed. And then you had countervailing flows from the Bank of Japan and Bank of China helping to add to global liquidity as well. So if there's aggressive deficit spending, where does that money go? Right? You're building bridges, you're building factories, you're building whatever. That money goes into bank reserves, right? Because the government has to pay bills. Well, that more than offsets quantitative tightening, doesn't it? Because quantitative tightening, the goal is to drain that a bit, to tighten financial conditions a bit. But if the government's spending aggressively during that same time, then it more than offsets it. And remember, for the first half of last year, there was no issuance of government debt because there was that manufactured debt ceiling debacle. So that was also liquidity positive. No issuance of debt to soak up liquidity out of the system, and then a ramp up of infrastructure and other kinds of spending to add reserves to banks. So that can kind of explain away that actually, yeah, the macro did matter last year as well. And it wasn't so much the Fed bailing out the banks that was the big catalyst of adding liquidity to the system. It was all the fiscal spend, right? I know a lot of folks tried to say that it was a stealth QE when the Fed came in and bailed out some of the regionals with their bank term funding program. I would argue that's not the case, and we can certainly see that really didn't play out quite as much as if you look at the fiscal impact. That's where the bigger impact was made, in asset prices and in economic activity. That was the anti-QT.
Iceberg ESM for CME buy at 5,041.5 crossed 500.
So we do see some more attempts here by buyers to absorb the selling pressure in the S&P ahead of the opening in just about 20 minutes here, implied down 1.24%. And that's 5,008 cash on SPX. And we are coming right down to this vol trigger level. Someone mentions in one of the chat rooms, one new explanation I've heard is energy will go through the roof into 2027 and is boosted with future plans of AI. This is a very good point. It's something that we talked about in our Macrovisor Q2 outlook. And really what it has to do with is projections for grid utilization are basically doubling over the next 9 years. And there's several feeders into that. One is, of course, AI and just increased data center scale and utilization. AI is a part of it. It's not the only part, but it's a chunk. Another big part is reshoring manufacturing. If you're going to build a lot of stuff at home, it takes a lot of energy. And so between the two, you've got a doubling of energy requirements. And then let's not forget EVs and the amount of capacity they add to the grid when people want to charge these things. So you put them all that sort of trifecta together. It's incredibly bullish of energy and you know, over time, natural gas as well. I know right now we have an excess in storage. I think over time, natural gas, but you know, it's really also for me, I don't like trading the Widowmaker as much as I like trading the companies in the space. Look at Diamondback or FANG, F-A-N-G. That's an oil and gas operator with a lot of operations in natural gas. It's been crushing it. You wouldn't know natural gas was renamed Natural Crash this year by looking at FANG stock. Pressure continuing here in the futures market. Let's check in on one stock that's on everyone's mind this morning, and that is going to be Meta. Meta trading 418 right now, up off of its lows.
GG reporting that the Bank of Japan had to consider measures to reduce its government bond purchases.
Good luck with that.
Seeing some strength in the Japanese yen here as GG report again. Bank of Japan to consider measures to reduce its government bond purchases.
Meta implied down 15.34% on the open here. And there is a pretty chunky gap to fill all the way down to 400 that we saw overnight and could happen again during the cash trading session.
Yes, stop alert. Dell 1058.
It looks like we got a sell stop in ES as the pressure continues, so we're just going to pop back to that chart as we cut through the vol trigger level. Remember, this is a pretty significant change. I don't know that it's time to try to just rebid this thing. Maybe at 5,000, like I guess we're just about above there now. Maybe you could get a bit of a rebid around here, but I would be careful with this. If we start to push meaningfully below that vol trigger is right at 5,000, okay? The reason that I put it there, the reason my algo put it there to be more accurate, is because that's the largest level of positioning on the entire options chain, okay? So that's likely to be an area that if we cut meaningfully below it and build acceptance, we have a pretty significant increase in vol. So I would just be cognizant of that going into the trading day. I don't think it's necessarily the time to just go out and try to buy too many dips. You know, there is some room for continuation here. Believe it or not, before all is said and done with this correction, SPX can be trading at 4,800 or so. This is something we've been talking about at MacroVisor for weeks. Got way ahead of this correction in the sense that we helped to advise people as the market was starting to rotate and fall to hedge or lighten up. Those risks are continuing to build. And remember, over this weekend, you know, if you're a Traderade member, you know I put out the Navigating the Markets, and that's been pretty much on top of all this as well, calling for more risks. You know, we hadn't seen that oversold condition really play out. So we had 2 days of a pop, a third day of kind of, you know, giving that back a bit, and then Meta really changing the narrative and PCE changing the narrative even further. We're not through the worst of this yet, in my humble opinion. And I'm not saying this because I want it to go down more. I'm saying it because, objectively speaking, as a trader and an investor, I have to manage risk
NYCB
first.
in your community bank corp. A board recommends shareholders vote for a proposal to effect reverse stock split. That's NYCB.
Never a good sign when a company wants to do a reverse split. So we can see liquidity building up as we prepare for the market open here. And after the market opens, we'll start to see the new levels from the advanced SPX options visualizer that I built for Bookmap populate here. But for now, I think this is a decent day to be cautious, you know, guarding risk below 5,000 if you're so inclined to take a long here. Look at SPX 5,000 or the vol trigger as your layer of support. That's going to be the best bet to really get a bounce because it's such an enormous area of options positioning. But I think this is a good day to be a bit cautious. Watch that first 20 minutes, see if we build an opening range, how big the range is, and if we pierce it to either side to make a decisive trend day. So we just got less than 5 minutes until the open here. The implied open for S&P is about 5,005, just 5 handles above the key 5,000 level, where there's the largest amount of positioning across the S&P options chain. We are in negative gamma territory, so I expect this to be a somewhat volatile day, but on screen you can see the vol trigger is at that same level in ES, adjusted obviously from SPX to ES with a delta of about 35.5. Watch this level today. I believe it can act as support, but if we cut through it, it could get a lot messier. So just wanted to give a quick update as we approach the market open. And of course, we'll keep the stream going so we can watch how we open and how we trade after that hotter than expected PCE, weaker than expected GDP, and Meta's earnings call disaster.
HON Honeywell CEO said H2 will be stronger than H1. That's Hotel Oscar November. That on their conference call. One minute to the U.S. market open. MYNZ, Maine's Biomed reports top-line results from pooled study evaluating novel mRNA biomarkers and proprietary AI algorithm for integration into pivotal FDA PMA clinical trial for next-generation CRC test. That is Michael Yankee November Zulu, MYNZ. Shares popping to a high of $1.10.
Market on open imbalance, 365 million to the sell side.
U.S. markets are open now. S&P 500 down 69.19 points after the open. Dow is down 512.77. Nasdaq down 342.
Iceberg ESM for CME buy at 5040 crossed 500.
That's a opening gap of note here on Meta following their earnings last night, down 14.6% on the cash equity open this morning.
DB, Deutsche Bank shares following their earnings report and conference call, shares up about 7.5% now, getting a pop here. Delta Bravo, $17.72 for DB. KDP, Keurig Dr. Pepper, popping at the open, moving back a bit now, up about 1.75% following their report. That's Kilo Delta Papa.
Yes, stop alert. Sell 1004.
AAL and BA, American Airlines CEO, said his message to Boeing is the same. Get your act together. That's AAL and BA. Shares of Boeing right now 163.29, down about $4. Shares of AAL selling off here now, down about 2.5% for AAL, American Alpha Lima. XPRO halted for news. X-ray Papa Romeo Oscar halted pending news.
choppy start to the trading session here as markets play around that 5,000 level we talked about just before the open. That is, again, the largest area
RDY,
of options
Dr.
positioning on
Reddy's,
the S&P 500. So I expect it to be an area that we kind of
Nestle India, and
ping
Dr. Reddy's to
below
form
and
joint
above
venture to
until we
take health
ultimately
science
decide the
nutraceutical
direction
portfolio
today.
to
But
consumers
I would
across
be
India
careful trading this
and
thing. We're
other
in
Greek
negative gamma,
territories. Shares of
buyback, blackout. We've
Dr.
got none of
Reddy's
those
this
supportive
morning
Vanna and charm flows,
up
and
about
it is
3.5%
a
at
less liquid
73.42.
time for the market overall. So price discovery is likely to be a little bit more choppy. It means one should be more selective with their trades, use smaller size and wider stops if engaging at all.
Block trade in ticker, BEN.
We do see some selling in some of these larger stocks. Google down over 4%, Microsoft down just over 4.5% ahead of earnings tonight. And there are potential reasons here. Google selling in sympathy because Facebook's ad numbers came in just barely above expectations. But the Microsoft story is a little bit more interesting in the sense that maybe, just maybe, market participants are becoming a little bit more leery of the AI story and how quickly it can be monetized. Microsoft, like Meta, has spent a lot of money on AI, and yet we're not necessarily seeing those near-term returns, so it becomes more of a show-me story. And of course, tonight we get Google and Microsoft earnings. EPS for Google expected at 152 with revenue of 66.06 billion, and Microsoft EPS of 283 expected with revenue of 60.87 billion. All right, let's check in on what's going on around the markets here. Another day where unusual buying flows in single stocks and ETFs options are exceeding that of the unusual buying flows. Well, the calls are exceeding that of puts in unusual size. So that's something that's worth noting. A lot of attention to Monster, Meta, Nvidia, gold miners, and SLV in terms of those unusual sweeps coming through. And as well as APP seeing a 72.50 strike call in the amount of 270,000 premium changing hands for June 21st of this year. There's also some downside hedging in Nvidia, $700 puts, about 325,000 in premium spent for those expiring June 21st. And we're starting to see some of the options activity populating here. We can see that in the puts and calls from the advanced SPX options visualizer that I built for Bookmap. You can see that call activity is exceeding that of puts pretty significantly so far at the open. We'll see how much that matters. We do see real distribution pressure on the other side here. We also can see that this resting offer correlates pretty well with that most active call strike. So there's that convergence, which is important. So we'll zoom back in just to the price action here. That 5,000 level I talked about pre-market, a very key level. Remember, that's
NKGN
the
shares at the highs
SPX.
now. November kilo golf November.
Remember, that's the SPX level.
Iceberg ESM for CME sell at 50.34 crossed 500.
So in ES terms, that's about 50.35. Or the level we continue to toy with here as the market tries to decide its directionality.
In 10 minutes time at 10 a.m. Eastern, we get US pending home sales change month over month. Forecast 0.4% on the prior 1.6%. We also get US pending home sales
ORCL,
index,
Oracle, introduces new AI capabilities to help
prior
organizations boost sales.
75.6.
Oscar Romeo Charlie Yankee.
So someone asked me if the move has pushed us closer or further away from max pain in the S&P. I'm just going to quickly say I'm not a big fan of max pain because the whole reason that dealers hedge to be delta neutral is so that they don't have exposure to loss if if a put gets into the money or a call gets into the money. So the idea of max pain, or that market makers have to, inflict a certain level to get most of these options to expire worthless, it doesn't really hold a lot of water because most of these market makers are delta hedging in near time or real time. So, there's really no need for max pain is what that means. So I would just walk back from, looking at those levels with too much importance, particularly at the index level. Just my 2 cents on that. And we're going to zoom out a little bit again to take a quick glance at the options activity across the chain. We can see calls outpacing puts, but not quite as much as they were just several minutes ago. We do see that activity in puts increasing, and that warm put, that second most active strike, just around where price is trading, just around that point of control as well. And right now,
stop alert. Sell 1304.
Right now, the put-call ratio on SPX options is 1.19. That's call transactions exceeding that of puts by 19%. Often is the case that that's good, but today, again, we can see there's real selling going on beyond where the options implied moves are taking us. And that warm put now moving lower to just above 50.15, where there's a large resting bid on ES. So this is important, again, seeing that convergence level. And we're seeing options traders now adapt their flows to this weakness in the market and expecting the market to potentially move lower, or at least hedging into that potential outcome. So I would look at this as if we build acceptance below 5,000, we're getting below that vol trigger, we're getting below the point of control, we're already well below VWAP. Definitely gives the path of least resistance to sellers here, particularly as we're moving below the bottom of the 20-minute opening range. Okay, so we do see that opening range has formed from the open here, the top being just around 50.41, the bottom being just around 50.31 and change, and we're starting to build volume below that opening range, suggesting that we could close this day as a downtrend day and we could build acceptance below 5,000 on SPX, which would make it more likely that more downward pressure could come without really some very impressive earnings from Google and Microsoft tonight. Google's chart's also in a pretty key area. It's just bouncing around this upward trend channel, and it has seen resistance there several times in the past. It's not the worst place to, well, it was at that upward trend channel before today's trading. I posted about it yesterday on Twitter, positing the idea that today would be a pretty important day for the stock and really emphasizing that would be earnings, deciding how that channel resolves. And it looks more and more likely that a retest of that lower end of the channel and 200-day moving average is the outcome here, particularly if earnings come in or guidance comes in less than expected. And yes, as someone points out, we do have a 7-year note sale this evening. And also in about 5 minutes, we get more data on home sales as well. We'll get U.S. pending home sales change month over month. And for folks that track the ECB, we've got 2 different speakers, but thank goodness it looks like we are in the blackout period for Fed speakers ahead of next week's meeting, so at least we have a brief reprieve from all of that. Although I'm sure after today's data, they would be jawboning even more hawkishly about the lower probabilities of a rate cut this year.
Biden administration to release low carbon aviation fuel tax credit model on Tuesday.
That'll be fun.
In 5 minutes' time at 10 a.m. Eastern, we have US pending home sales change month over month. Forecast 0.4% on the prior 1.6%. We also have US pending homes index, prior 75.6.
Block trade and ticker, EL.
Coming up at 10, pending home sales for March, expecting plus 0.3%.
And we are building more volume below that key S&P 5,000 level. That is going to be a concern during this trading day. We are below that vol trigger, so we could see this intraday realized volatility pick up further. And we also see liquidity continuing to build below us. And that, second most active put strike correlating well with this 403
US
on bid at
Treasury's Yellen says
50.15.
GDP data shows strength in consumer and investment spending.
Oh, good grief. Please stop. Please stop with the pumping up of everything is so great in the economy. Americans don't believe it anymore. We're tired of hearing it. There are so many people in this country have been left behind by this indiscriminate late cycle fiscal excess that has boosted inflation back up, making it harder for people to make ends meet. And the government continues to jawbone about how great everything is. They couldn't make it more clear how disconnected they are from reality.
Yellen says there could be revisions to GDP data.
Yellen saying there could be revisions to GDP data is like me saying that the sun is going to come up tomorrow. Of course, there's going to be revisions to GDP data. Maybe they shouldn't make it so clear that they plan to make those revisions look better than what reality suggests. And I say this because I've been skeptical of government data releases really going back 16 plus years. There's been a lot of variances in
1
data.
minute remaining. I'll lead with US pending home sales change month over month.
So let's
Yellen
wait.
says I still see in underlying core drivers of economic
MRX
activity
IPO indicating
considerable strength.
$20.20. Micro Romeo X-ray.
Ten seconds.
Pending home sales plus
3.4%,
3.4%.
3.4%.
The
Wow.
consensus was for plus
0.3%.
0.3%.
US pending home
Wow.
index 78.2, 78.2.
S&P futures hitting a low of 50.26.
Yellen says we're on a downward path for inflation.
No, we're not. Yellen's saying we're on a downward path for inflation. Is she just completely ignoring the data? Is this back to inflation as transitory? Credibility is transitory for people saying inflation is transitory, but inflation itself doesn't seem
Supreme
very
Court begins
transitory.
hearing arguments for Donald Trump's bid for criminal immunity.
So we're seeing futures now pushing lower here. Again, building acceptance below that vol trigger level. This does portend to further
ELSA,
downside.
Tiziana Life Sciences, reports 3-month neuroimaging scores in multiple sclerosis patients receiving intranasal oralimab.
And this is
Treasury Secretary Yellen said we're on a downward path for inflation.
Yes, iceberg alert. By 1088.
Rents have stabilized, but a lot of people still experiencing the upward adjustment to higher levels.
Yellen says the US economy continues to perform very well.
Yeah. Going to go
Yellen
ahead
said,
and
I have
disagree.
no doubt that housing's contribution to inflation will be coming down this
Yellen
year.
says I have no doubt that housing's contribution to inflation will be coming down this year. And Yellen says we have a very good, strong job market. We're not seeing evidence that the labor market is a source of inflation.
Wait, we have a very strong labor market, but it's not contributing to inflation. Okay, sure, why not?
Yellen says we're not seeing that wage pressures are a source of inflation.
But they are. I mean, that's
Block
exactly
trade
what's
in
driving
ticker,
inflation in the services
VICI,
industry.
block trade in ticker, MDLZ.
I'm not sure exactly why there's so much doublespeak from these folks, but rising wages do put upward pressure on services costs, especially, and we've seen that pass through. In fact, a lot of businesses have talked about rising wages, forcing them to raise prices because of margin compression. So categorically, a lot of the things that are being said are on their face untrue. You don't even have to dig in very far to find that. And again, this is that disconnection between folks in their ivory towers telling us what we're supposed to believe about the economy versus what we can see with our own eyes in front of us. Obviously,
Yellen
the
says,
top
I certainly
quartile,
don't see the US economy as
I don't care. The top quartile of consumers are doing okay, but the bottom 50% are not. They're doing quite poorly, and ignoring that will be in my opinion, to the plight of folks that want to seek office. Because if you can't sympathize with the struggle that a lot of families are dealing with, you're not going to get their votes very easily. And so I think this is a pretty nasty miscalculation, both the late cycle fiscal excess that brought inflation back to try to avert any potential for a recession, and then the complete ignorance towards what all is happening on the ground level, what a lot of people are experiencing. And you go to the other side of it, you look at survey data of American consumers, they're very pessimistic about the economy. If things are so great, why aren't they feeling it? Spot VIX bid up 7.71% here to 16.83. And we can see this distribution of options. We see a lot more interest in lower levels here. That warm put moved from that 50-15 level on ES all the way down to just about 4,995. So there's definitely an expectation from options positioning and options flows right now for a larger move in either direction. You can see that in that distribution we have from the advanced SPX options visualizer. So we'll zoom back in here. We'll take a look around some of the other parts of the market here. Here's the NASDAQ on screen, looking just a little bit better than the S&P, right? S&P seems to be seeing more selling pressure comparatively in terms of where the NASDAQ is rebounding from intraday. So the NASDAQ index is lower, but it's showing some intraday relative strength versus the S&P, at least at the moment. We'll move on to the Russell. Russell looking pretty terrible, making a new lower low, potentially a new lower high here. And it's been downtrending ever since we got the market open and we saw this retest to the point of control and then just a clean rejection lower. And in terms of rates, we're looking at that 5-year rate after the auction yesterday. We can see 5-year note futures dipping lower pretty significantly after that PCE quarterly data release. A similar look here in the 10-year note. When we zoom out, we can see that data release also caused rates to push higher. Rates on the long end now at the highest levels they've been in 2024. And the 2-year note pushing above 5% again. Crude oil seeing a little bit of pressure here, now trading down 82.34. Still overall constructive on the energy sector, and I welcome these reprieves as they often offer opportunities to allocate into some of the better quality stocks. Copper seeing some pressure here, had a good start to the day, now starting to give some of that back up. It has looked a little extended. Again, with bigger pullbacks in copper, I would be looking to allocate long into the commodity and its miners. Not quite there yet, but it is of interest. Gold also retracing back to this key trend line. It's not on screen, but see if I can pop it up there. But gold is an area I'm also interested in as long as it can defend the trend. Okay, so let me put that on screen just so you can see what I'm talking about. Here's gold. We'll just update this little arrow, this hopeful arrow that maybe we get a break higher. But this trend line from March of this year has been pretty well defended. And I would imagine that that's something that, we can kind of count on as a good risk reward area, bidding into trendline retests and getting out of longs if we close below that trend line. But so far, we're defending that trend line pretty well.
Yellen says the dollar has been strong and there are divergences with other countries.
And as long as gold is above that trend line, I think it's worth a rebid. So I'm still bullish of gold here over the intermediate term. Silver here pulling back a little bit. I still like silver as long as it's above $27.05. So we're watching to see how this one trades. But so far, a little bit of weakness into today. And the euro dropping pretty significantly, kind of gapping down on that GDP PCE data release as the dollar strengthened with rising rates. Semiconductors starting to look like they're coming back from their lows, you know, really just had a bid from the cash session beginning into the present. So SMH certainly one to watch here. Semiconductors starting to come back, which is one reason we're seeing the NASDAQ show a little bit of strength from its lows.
UK Finance Ministry says Liz Oakes appointed to be Bank of England's Financial Policy Committee. And Yellen says, my position has been that currency intervention is acceptable only in very rare and exceptional circumstances.
HOLO, microcloud hologram, 266 at the high, now up 12%. That's Hotel Oscar Lima Oscar.
Semiconductors making a new intraday high here, showing relative strength versus the market in the way that they are trading so far. Let's pull up Apple on screen. Apple had a nice pop into the open that is being faded so far.
SGBX, safe and green, up about 100% now at the highs after that order announcement earlier. Sandy Golf, Bravo X-ray.
And Amazon doing what we've talked about for the past couple days on these streams, getting to this really large level of a bid and rejecting it and moving higher. This is something that Bookmap helps us to see really well in what's happening in the overall order book. And when you see these large levels of liquidity being rejected, typically you get a move in the opposite direction, as we did with Amazon, that move of about $1.13 higher. Google coming off of its
coming
lows
up at 10:30, natural gas storage, a build of 87 BCF is expected.
Google coming off of its lows ahead of earnings, one to keep an eye on tonight, as well as Microsoft. And Meta coming off of its lows as well. Remember, overnight it had actually broken below 400 briefly. Now it's starting to gain this rebid, and we've got a rather large area of offered interest just here around 439, 56,000. So that could potentially pose some resistance. At the very least, it puts the onus of proof on buyers to show they have the demand necessary to push through that level. Microsoft ahead of earnings, also showing a little bit of strength out of the open, consolidating, bottoming, and you see this little peak down into the 390 resting bid, and then a rejection. It didn't have the necessary supply to clear out that level, so we saw price move higher. And NVIDIA really also showing a similar look as the rest of the semiconductors, a bid out of the open and rising. And remember, SMH as an ETF, I believe over 20% of it is in NVIDIA.
WISA popping to the highs now, up about 12%. Whiskey India Sandy Alpha, WISA.
Tesla doing Tesla things, showing its volatility. It had a great open, but now it's starting to see some of that fade.
Hamas official says Hamas will not be swayed by U.S. pressure on issue of Gaza hostages.
And so we're going to go back to the S&P 500. Lots of things going on today. We're trading back above 5,000 by just a hair on cash. As we make this move higher, point of control becomes even more important for buyers to demonstrate they have the demand necessary to really push this thing from here.
Yes, stop alert. Sell 1001.
Block trade and ticker, DASH.
Yes, stop alert. Sell 1014.
NVIDIA 850 calls, 141,000 in premium paid for those expiring May 17th. NVIDIA 820 calls, 291,000 premium expiring this Friday. So we are seeing a lot of bullish options volume coming in, especially to some of these semiconductor stocks, and that is helping to boost them as we push into this trading day, into this first hour. Meta 440 calls, just about 245,000 paid for those expiring this Friday. And Microsoft, 400 calls, 150,000 paid for those expiring this Friday as well.
Yes, stop alert. Bell 1009.
Seeing a bit of a reversal of some of the pre-market and opening trends here. The whole day so far, semis have been bid, Nvidia has been bid, and now we're starting to see the NASDAQ come back, leading the S&P as well. NASDAQ's broken above its volume weighted average price and seems to be content to head towards this point of control around 17,450. Rates market starting to see just a little bit of reprieve, but still only just off their lows. Just zoom out here, we can see there's a relatively even distribution now in volumes between the two most active call and put strikes, which is why we have the midpoint on screen. And that's showing us that there's a relative balance in the auction as viewed through the most active options flows. And this has the impact of sort of making prices a little bit more sticky in that middle area, just as we start to push into the point of control and above the largest area of gamma positioning outside of the vol trigger.
Iceberg ESM for CME sell at 50.38 crossed 500.
Underneath the surface, breadth is less than impressive so far, with advancers at 13% versus decliners at 79.2% across all U.S. listed equities. 27.9% trading above the 50-day moving average and 72.1% below. We are seeing strength in semis, consumer defensives, and certain areas of healthcare and industrials. And we can see S&P futures continuing to challenge that point of control level just above gamma 1. And we see liquidity building above, which is typically a constructive sign for prices to move higher, right up into that VWAP level of about 50.44. At present time, I would say we are still deciding how we're going to resolve S&P 5,000 in that really large area positioning. We started to build volume below. We started to look like we were accepting below there, but at this point we've reversed that, and now we're continuing to challenge that very, very sticky area of enormous options positioning on both sides, both puts and calls.
So we're looking now to the Fear and Greed Index, 37 out of 100, which indicates a fear, with the Crypto Fear and Greed Index at 72 out of 100, which indicates greed. Keeping an eye on the VIX as well today. It's currently up around 6% at around 17.
NVIDIA 830 calls expiring this Friday, 111,000 in premium trading there. And we can see the market is pushing above that point of control towards VWAP. We just talked about that scenario popping out, and certainly is starting to play, giving buyers just a little bit more conviction, particularly as liquidity builds overhead, as there is interest in higher prices here. So VWAP, a little bit of a rejection there so far, but overall, buyers are starting to show a little bit more aggression. You can see all that absorption with all these larger green bubbles, giving you an idea that the delta favoring bidding is prevailing so far. Let's take a look over at the NASDAQ, which I expect looks stronger. We talked about the relative strength earlier in this versus the
Treasury
S&P.
Secretary Yellen says China has acknowledged a problem with overcapacity, that in a Reuters interview.
So we can see the NASDAQ now climbing over its respective VWAP, where we did see some short-term resistance. It's now pressed higher.
Yellen said, emphasizing undesirable spillovers from Chinese overcapacity.
So I'd expect that to be the next level of
S&P
resistance.
says Boeing outlook revised to negative on delay of credit metrics restoration. Triple B minus A3 ratings
Yellen
affirmed.
emphasizes undesirable
Boeing faces heightened
undesirable
production uncertainty, notably related to quality issues affecting 737 MAX aircraft. Key changes to leadership pending. That's BA Boeing, not from S&P.
ES iceberg alert by 1061.
So I do expect that point of control around 17,450 to offer potentially some resistance here in the NASDAQ. Let's check in and see how the semis are doing.
Yellen says overcapacity in China is not just a U.S. issue, it's an issue for Europe, Japan.
All right, well, it's a little bit much about what Yellen is saying and how little relevance it has to anything. So anyway, S&P continues to push higher, led by semiconductors and some strength in the more defensive parts of the market. We can see that's been a trend really since the cash open, that semiconductors have had this strong bid. I think this is something that's worth paying attention to here. You know, we are seeing strength in NVIDIA as well. We're seeing a lot of interest in calls helping to move NVIDIA higher. We just had those 830 strike calls coming through with 111,000 in premium, and we can see there's an area of interest up there at 830 as well, about 15,000 shares on offer, and 840 about 29,000 shares on offer. NVIDIA, like SMH, which makes up about a fifth of the SMH ETF, also bid pretty constructively throughout the day here. We're up about $30 or in excess of that from the open.
Valero sees OPEC output ramping back up by the third quarter or the fourth quarter.
So tech recovering now. NASDAQ at the cash index level down just about 1.25, matching that of S&P when NASDAQ was down quite a bit more than S&P earlier. So again, going back to that theme we talked about earlier, seeing some relative strength from the lows in the NASDAQ, that theme continuing so far. You can also see just around these lows here, this large red delta print was met with a pretty aggressive iceberg buy. And that typically gives you a sign that there's some interest in absorbing
consumer
that.
Spending in China is incredible.
And that passive accumulation there marked just about the low, right? The low came in just a little later, but it was low conviction selling pressure. And then the accumulation in earnest really began from there. So watching how icebergs behave and how price rejected this larger area of a bid just below gave us a bit of a sign that that could be a turning point. And these are the sort of things that you can see in Bookmap that give you a better sense as to what's happening in the market that you're not going to see in other trading software. It's a matter of getting acclimated to how it looks different. And I get it. It looks a lot different than charts we're used to. But quite frankly, I find it more helpful than a lot of the conventional charting software and tools out there. Now, folks that might be interested in Bookmap, you can actually get up to 40% off by visiting Traderade.com/bookmap. And if you like the SPX options visualizer, you can grab that on the Bookmap Marketplace, learning more about it by visiting Traderade.com/SPX.
In 5 minutes' time at 10:30 a.m. Eastern, we have EIA natural gas change, forecast build of 83 BCF, prior build of 50 BCF.
You got SMCI 770 calls for May 17th, 211,000 premium paid there. Again, calls exceeding that of puts. This is something that we saw in the unusual flows I talked about a bit earlier. Now it's about 2-to-1. Unusual size sweeps in individual stocks and ETFs versus on the call side versus puts. That tends to be bullish. It tends to show you there's a strong risk appetite. So off the lows, you can see that risk appetite has been building here. Ten-year Treasury yield currently 4.70%, up just about 6 bips. Let's take a look at 10-year note futures here. You can see they've recovered nicely from their lows. That's giving the market just a bit of a reprieve, right? At those lows, the 10-year yield was about 4.71 and change, if not 4.72. Now we're starting to see that reverse a little bit, and that's taking some pressure off the market, and particularly tech. Checking in on the NASDAQ, we can see we're continuing to target that point of control from below that 17,450 level on the front month June NASDAQ futures contract, an area to continue watching as
Treasury
a potential
Secretary Yellen
resistance area.
That China shock was a huge loss of manufacturing jobs in parts of the U.S. that have not recovered. Parts of the U.S. have really been left behind. Free trade has to be something that benefits people throughout the country. Real Caribbean executive says regarding the situation in the Red Sea, the company has rerouted some spring cruises situation in the Red Sea, company has contingency plans for a few other sailings that may be impacted in the fall. That's RCL, Romeo Charlie Lima.
As the NASDAQ tries to challenge the point of control from below, S&P is trying to challenge VWAP from below. And we do see some liquidity building both above and below in that S&P 500 futures contract. So I would say we're reaching an intraday inflection point in both indices to get a better sense as to where the market wants to go from here.
HOLO, microcloud hologram, another pop here, $2.83. Yellen said would be prepared to use authority to sanction Chinese banks if necessary.
Yellen says we would be prepared to use authority to sanction Chinese banks if necessary.
And I'm sure those same banks will be glad to buy less treasuries and help to push rates higher. I mean, it's a quid pro quo type of situation. No one wins when you start to escalate like this. We do see the S&P reaching up to this VWAP level, challenging it, and so far getting sold under. Let's see what the NASDAQ is showing.
1
Somewhat
minute
similar.
remaining.
Somewhat similar. We're about to get EIA data as well, so I'll let them carry that. I'm going to step away for just a minute. I'll be right back. And don't think the energy market data will be a big market mover for for anything outside of natural gas, really. So just take it for what it is. Storage levels are way above average right now. So if we get any kind of
10
decrease
seconds.
in storage, that would be bullish for natural gas. If we continue to see it above the max 5-year range, it would probably be bearish.
Build of 92 BCF, build of 92 BCF. That's higher than the forecast build of 83 BCF. Seeing a little bit of weakness in natural gas.
Natural gas stockpiles rose 92 BCF last week. That's versus the 87 BCF estimate. Natural gas falling to the lows now, $1.60 on that larger than expected bill in natural gas, down about 3% now.
Israel intensifies airstrikes on Gaza's Rafah before ground operation.
Iceberg ESM for CME sell at 50.45 crossed 500. ES stop alert by 10:46.
So a bit of a rejection there up at that point of control level, you know, kind of get pretty close there, seeing a sell down below. In S&P futures, we have a different look. We had that peak above VWAP and sell below the point of control. Now, both of these looking like they're reversing a bit of their earlier gains. Let's take a look around and see what all is going on here. Bit of a rise in rates here. That reprieve in 10-year note futures giving back some of that. Crude seeming like it's stabilizing a little bit here, rejecting that 82 bid and starting to move a little bit higher, but overall looking pretty weak. Copper starting to look like it wants to put in a bit of a low and bouncing off that with some degree of buyer conviction. And look at gold. Gold well off its lows. We talked about that trend line test. It happened again today. It's bouncing again off that trend line. The trend is your friend in gold, and these hits so far have been viable, although if it keeps coming back to that trend line, I would have a lot less conviction on that precious metal. Okay, so right now I like it. I like the way it's reacting. I think it's still a good time to be bullish of gold. Just manage your risk carefully. We are at pretty elevated levels, and I mean that by sentiment and positioning starting to come up as well. So gold can keep pushing higher, but I wouldn't necessarily have the same position size I had on months ago before this big move. And I'm more constructive of the well-run gold streaming companies, Royal Gold, Wheaton Precious Metals.
Executive says bookings have been outpacing last year by a wide margin on a weekly basis, despite having less inventory remaining. That's Romeo Charlie Lima. Gold.
Yes, gold.
Reversed and now spiking here sharply.
You don't say.
23.56.20.
Who saw that coming? We talked about that like an hour ago, right? Gold and the rebid at the trend line. Put the chart on screen. Nice little play.
Gold up about $15 at the highs now, spiking here.
Spot gold rises 1%.
Let's just take a look at that chart again. This is the chart we put up earlier. This is the trend line in gold. We can see how it's very neatly honored that trend line several times. This is a place where buyers like to come in. And once again today, we're seeing that same trajectory, which leads me to believe it's more and more likely that we defend this area and come back to recent highs around 24.40 on the front month gold contract. There's also been large vertical spreads for December this year targeting 2,900 gold. And Citigroup thinking that range, maybe even 3,000 this year being possible. So we do see increasing ideas of much higher levels of gold. Doesn't mean bet the house on it, but this price action today is certainly encouraging to that respect. You also have a little bit of an exhaustive stop out here of shorts. Remember, this is not a very liquid contract in gold, just about 9,000 order book depth. 955 contracts being stopped out to the upside is no small matter. So this could mark a little bit of a limit to that move. It might be a good place to take some interim profits off if you're buying at the trend line for an intraday trade and seeing that exhaustive stop out. Not a bad place to take some of those profits on the core. Let's go back to the S&P futures here. We're just right back to the point of control. Gold miners GDX, the 35 strike for May 17th, 102,000 in premium paid for those calls. So you do see some bullishness in the options for the space as well in those senior miners. And Meta. 3 sweeps of the 450 strikes expiring this Friday. And just over 400,000 in premium paid for those. Another interesting little note we saw when the S&P futures contract peaked above VWAP, someone came in and iceberged about 1,000 on the sell side, and we also had about 159 buy side stops of shorts blown out. That looks just a little bit exhaustive. Not terribly, but just a little bit in terms of the combination of those two events there, the absorption and the stop out. So that just tells me that this retest of the point of control is even more important to decide intraday directionality. Aggressive here with price coming below this larger area of selling interest, this 50-40 level where you could see 38.54 contracts were sold in excess of bought in ES. And someone says, hasn't China been less of a buyer of treasuries overall anyway? Sure, but they could also become a net seller if they wanted to. And the increasing idea of using the dollar as a weapon or financial sanctions or otherwise certainly tempts anyone who's on the wrong side of that to diversify away from dollars, from SWIFT, from treasuries and otherwise. So I would just be concerned about, if the bully pulpit of the dollar is used too aggressively, it's likely going to push the price of gold up more. It's likely going to have more folks transacting outside of dollars, even including things like crypto, but it really is a bad look to use it as a weapon. It's just causing it to be less and less utilized as a mechanism for settling trade. It does not mean the dollar story is over or that it's going to crash imminently or anything like that, or that gold is destined to become the new world reserve currency or, God forbid, the Chinese yuan. But it does mean that the more they lean into using it, the more the world will diversify away. And it's a story that takes years. And we do see a pretty solid decision here. Market moving below that point of control with conviction. Sellers taking control. You could see it in the size of those delta prints here, absorbing any attempts to buy and moving now below that volatility trigger, below that key 5,000 level in S&P cash and down to the midpoint. So was this whole move higher a bit of a head fake? Starting to look a little bit more like that. Let's check in on where the real leadership was. That was semiconductors in NVIDIA, which is about a fifth of the semiconductor ETF. And semiconductors also giving back some of their gains from earlier. And actually this microstructure turning into a bit of a downtrend of lower highs and lower lows in the intraday chart. Let's check in on everyone's favorite stock to love or hate, NVIDIA, also off of its highs. And we had a bit of a clean rejection here. This large level of resting liquidity around 825, buyers took us right up to that point, and ever since then, the failure to get through there has emboldened sellers, and we do see increasing absorption of attempts to buy, like this 8,446 absorption print. So I would just contextualize this as, just like semiconductors, it's starting to look a little bit more like an intraday distribution trend of lower highs and lower lows in NVIDIA, and you can kind of see it in the way this chart is flowing. Let's look at Microsoft ahead of their earnings tonight. Also a similar trend of giving back some of those earlier gains. How about Meta? How are we doing over there with the AI-powered metaverse? Not so well. I mean, this stock is still down quite a bit. It did come back and make a bit of an attempt to reverse some of those losses, but the stock is now kind of enjoying the same trend, so to speak, as semis, NVIDIA, and Microsoft, this series of lower highs and lower lows, a bit of distribution from that earlier rally. We'll go back to the S&P futures here. And S&P futures re-challenging that point of control from below. So again, remember, 5,000 is a really important area. A lot of volatility up and down around that area. It seems like we have to give that area almost a bit of a larger range than we typically would because we're in this low liquidity, negative gamma environment. There's an increased probability of, higher levels of chop or realized intraday vol. and we just keep getting stuck around these key levels. And 5,000, I think, is a really important level, particularly how we resolve it by the close of today. So let's expand the range of points to show acceptance and say it's about 10 points either way, right? To really build acceptance above or below that key 5,000 cash level. And we probably need to see 20, 30 minutes of trading above or below to really show that the market's made some kind of decision. And even then, it can still act a bit like a magnet for lack of liquidity influences elsewhere. So just a day to be cautious, taking any bias, bearish or bullish, too seriously, given the importance of that level, unless we make a much more decisive move above or below it. Let's zoom out a little bit, see where options interest is in the advanced SPX options visualizer. We can see it's still a pretty wide distribution from the most active call, just around 5086 ES, to the most active, or the second most active put around 4985. That's about 100 handle range between those strikes. Ahead of earnings, Google 165s trading 291 premium paid, 291,000 in premium paid for those 165 calls expiring May 31st. And I'm going to bring up a chart of Meta on screen real quick just to show some of the risks that still exist in this stock. I don't think that this picture has been resolved.
Let's take a quick Quebec uniform, India kilo. She sure seeing a spike in activity. No circulations. A new long idea from Zax. QUIK.
Meta is trading below its Ichimoku volume weighted cloud. That tells us it's now in a downtrend. And it is in an area where there's not much volume, right? All the volume that you see in the volume profile here is from this candle, because obviously it's nowhere in this gap and the price had never traded this high before here. So it is in a very volatile zone. You can expect the stock price to be very, very choppy up and down as the traders and investors sort of resolve where it's going to end up. Is it going to end up in this chunkier area of the volume profile above us, get pulled back in, and this is sort of a look below? Or are we going to see buyers and sellers take price down to this next area of transacting, which would take us into the low 400s, an area that we actually saw trade in the overnight session? I favor the downside outcome being more likely looking at this chart and the potential for it to fill this gap, but we have to watch price and see what it tells us.
Block trade in ticker, HCP.
Putin says I plan to visit China in May.
Let's take a look at the NASDAQ here, see how it's performing. And so rejected at point of control, now rejected at VWAP. Sellers really enjoying some continuation of earlier negative momentum after that brief reprieve. Rates
At 11
stabilizing
a.m.
here.
Eastern time, we get the Kansas City Fed Composite Index forecast -5 on the prior -7, and the Kansas City Fed Manufacturing prior -9.
Let's check back in on some of the other areas of the market we have been watching, including the semiconductors ETF.
On the
Continuing
TikTok
that
news
pattern.
now being circulated, ByteDance has comments says we have no plans to sell TikTok. Media reports are untrue.
That'd be interesting.
Coming
If
from their
TikTok,
official account on Twitter.
be interesting if TikTok actually got banned, quite frankly. Probably be quite beneficial to every other US social media platform, but would also set a dangerous precedent for the potential of censorship rising quite a bit. But semiconductors still looking like they're in this distribution pattern overall. Take a look at NVIDIA. I imagine it's a similar look, pretty much. Some iota of stabilizing here at these lower prices, but still looking like distribution overall. Let's take a look at Meta. Meta getting pulled lower. Let's see what happens at this 430 level. So far, it's been rejecting it, but it's not as if buyers are really pulling away with any vigor. So it's becoming more and more likely as we keep getting pulled lower that we do see that filled. That limit order on the buy of 430 with 23,000 shares on bid. Go to the Russell. We haven't checked in on the more volatile cousin of the major indices here. Seems to be stabilizing a little bit. We did get rejected at the point of control earlier. That did cause us to sell down. So we'll be paying attention to this one. But overall, this one has a pretty high degree of sensitivity to rising rates. So it's surprising to see it have really any resilience given what's happening with the 10-year note futures. But I will note, Russell was trading much better before the cash session opened. And after that 8:30 print and then after the cash session, it's just been downhill for the Russell. So I would say it went from, I think it was modestly bid up pre-PCE, pre-GDP. It's given all that back. And as the 10-year note rises in terms of its yield, the Russell tends to get slapped lower. And if you think about it, it makes sense, right? 40% or so of the Russell doesn't make any money. It's these growth companies that are highly speculative. And then there's the regional banks, which are very sensitive to rising rates in the long end, given their exposure to duration and mortgage-backed securities, treasuries, and other forms of debt. S&P 500 now trading lower. Not quite at the lows of the day. We'll put that on screen just for context. We do see liquidity building below again in S&P. That can be a bit bearish. It can kind of help to pull price lower when the trend is matching where the liquidity is building. We did see some attempts by iceberg buyers here to push this over the point of control, but that was met with absorption from sellers who have more than rejected that level. Now, going back to the earlier data release of GDP, this was led by consumption, state and local spending, residential and non-residential fixed investment. I don't know that I would say it's necessarily a sign of a robust economy, particularly how much weaker it came in versus expectations. There was also a decrease in private inventory investment. And increased consumer spending was largely in services and offset to some degree by a decrease in goods spending.
At 11 a.m. Eastern Time, we get Kansas City Fed Composite Index forecast -5 on the prior -7, and Kansas City Fed Manufacturing prior -9.
What's interesting about this GDP print is within services, the increase in consumer activity primarily reflected increases in healthcare, financial services, and insurance, all areas where prices have been rising faster than the rate of inflation. So what this GDP print and the PCE data really tells you is the economy is not doing as well in the first quarter as expected, but prices are continuing to rise in a number of key services. I've talked to folks that have seen their homeowners insurance nearly double, auto insurance up 40%, health insurance up 20, 30%. That kind of tells you what's going on in that part of the picture. And then, of course, healthcare, the cost of healthcare always outpaces the rate of inflation at the headline level by about 2 or 3-fold. That gives you a sense as to what's happening there. And we've seen the price of financial services rise as well. So altogether, not a great GDP print, a pretty disconcerting PCE quarter over quarter print. And yes, we do get 3 versions of PCE. Today we got quarter over quarter. Tomorrow we get month over month and year over year. Also seeing that relative weakness in the NASDAQ start to come back. We had seen relative strength earlier with the NASDAQ. Things were starting to look a little bit promising, but we couldn't take out this point of control at 17,450. That was a bit of a sign, right? There's 905 sell delta contracts at that level. So that was telling you if you got above there, it'd be a lot of sellers off sides that need to have to cover their shorts at higher levels, but we didn't. And so the opposite played out, which is essentially saying we didn't have enough demand to take us above that level. So now we're being overwhelmed with supply once again. Similar look in the S&P 500. It did pop above VWAP, but we had that 1,000 iceberg sell, and we've been selling down ever since then, now moving below the point of control and building some acceptance below that S&P 5,000 cash level where the vol trigger is. Checking in on the options market, $30 SLV calls, $200,000 in premium paid for those expiring June 21st as the optimism in precious metals continues. And we did get that natural gas storage data earlier. Recapping that, I would say storage levels remain well above their 5-year max range. This is showing us that there's still ample supply of natural gas, the commodity weakening a bit today. I think that until we start to dip back into the average range, natural gas is going to have trouble getting a sustained bid.
Shortly expecting the Kansas City Fed Composite and Manufacturing Index. I'll lead with the Composite Index.
SNAP snapped the June $7 put sweep at the bid. Any November Alpha Papa.
That's one that crashes almost every earnings, right? Snapchat, we can almost set your calendar to it.
ADTX, addicts getting a pop here to the highs, Alpha Delta Tango X-ray, Delta and very light volume. ADTX up about
AG, Hawaiian Electric, Hotel Echo. Headline: Hawaiian Electric is said to weigh sale of American Savings Bank. So you're seeing a spike in activity for HE.
-8, lower than forecast, -5. Still waiting for the manufacturing. So the US to sell $70 billion in 6-month bills on April 29th to settle on May the 2nd, and to sell $70 billion in 3-month bills on April 29th to settle on May 2nd.
HE, Hawaiian Electric said to a sale of American Savings Bank. That's Hotel Echo. Amazon Prime Video to become home of National Monday Night NHL games in Canada beginning in the 2024-2025 season. That's Alpha Michael Zulu November AMZN.
Google 150 put sweep coming in for this Friday's expiry, about 235,000 in premium paid for that, hedging ahead of tonight's earnings release. And tonight, Google expected to report EPS of 152 and revenue of 66.06 billion. Let's check and see how the stock is doing ahead of its earnings. I mean, it's hard to call it Alphabet when its stock trades as Google and
And
Goog.
Kansas City Fed manufacturing -13, -13.
But we can see Google has had this resilience today, really rejecting moving below that 151 level for too long and continuing to build from there and moving from an uptrend microstructure to now more of a consolidation microstructure. NASDAQ seeing a little bit of a rebid here as the point of control was pulled down by sellers from that rejected 17,450 level. And S&P coming right back to that level, which would be S&P cash 5,000, which is where, again, there's the largest amount of call and put positioning across the entire options chain. We do have an auction coming up in about 2 hours of 7-year notes. Yesterday's 5-year note auction was not that great, particularly in contrast to the 2-year auction, which was stellar on Tuesday. Looking at the overall heat map today, we're seeing some continued resilience in semiconductors, parts of healthcare, industrials, but overall a fair amount of distribution across the board. And this is another day where breadth is pretty problematic overall. We track these metrics because they do tend to give us a better sense as to what's going on underneath the surface of the market. Right now, there's only 17% advancers versus 77.5% decliners across all U.S. listed equities. And folks, when you get caught around a big magnet level like this, like S&P 5,000, usually it's a good time to kind of pull back from trading S&P itself too aggressively or even NASDAQ too aggressively. Likely better opportunities in other futures contracts or in single stocks and ETFs as we resolve this key area of options positioning.
Iceberg ESM for CME buy at 50.39 crossed 500.
So I've been asked, do I think the EPS and revenue are relevant for Google considering what happened to Tesla and Meta? Let's contextualize these two. It's a great question. We went into Tesla's earnings with really bearish skew. What does that mean? It means there was a lot of demand for puts ahead of Tesla earnings. And Tesla earnings came in, and while they were not great, they weren't a total disaster, as some may have been hedging for. Then we had a conference call where management continued to
It's
repeat a bunch of
11:15 a.m. Eastern time. We expect
hyperbolic takes on what's going to happen with AI and what's going to happen with some of these other initiatives that they're taking. But they really just told us, they don't have a concrete plan at Tesla. Their goal is to release these cheaper EVs early next year. They talked about lowering cost of goods sold and using idle capacity to build these. That seems kind of far-fetched for anyone that has real experience with manufacturing. Obviously, there's a lot of retooling and a lot of operational overhead to introducing any new product line. So I think that was one thing that wasn't necessarily discussed enough. Then they talked about selling excess cloud compute in their cars, which makes no sense whatsoever. There's a lot of connectivity concerns otherwise. Anyway, the market bought it. I think the market really liked the idea of Musk leaning into selling these cheaper EVs, being able to compete with China. So I think that's why Tesla got a bid. It was incredibly bearish positioning ahead of it. Management kind of engaged in a circus of trying to convince investors that no, everything's on the up and up. And for whatever reason, folks bought it. But I think there was also a fair amount of short covering. Short interest in the stock was also the highest in about 2 years. Contrast that with Meta. We went into that with skew somewhat bullish, not quite the same distribution or lopsidedness as we saw in Tesla, but we also had a really, really awful narrative change, right? So Tesla's narrative ostensibly improved because Reuters was saying they're not going to make the cheaper car. Management said, no, we are. On the other side of it, Meta's narrative changed from a year of efficiency and AI being the future to one where we're going to spend inordinate amounts of money on AI, so much for efficiency, and we don't know how or when we're going to monetize this. So it's just a sort of trust me, bro type of story. So I think that's one of the reasons Meta took such a big haircut is their narrative completely changed for the worse. And then if you believe Tesla's management, their narrative changed for the better. I do still think the fundamentals matter, but what I think matters the most is guidance. I think what's most important, we saw it with Netflix. They killed it in their earnings and their subscriber growth. They gave us soft guidance and they tumbled. I think what's going to matter most for all of these growth companies is how they guide. So I'm really going to be paying attention to Microsoft and Google and Intel tonight to see how they guide and how the market reacts. And I'll cover those. We'll have the stream going tonight for earnings as well.
At 11:15 a.m. Eastern Time, we expect comments from ECB's Nagel, who speaks about climate change.
CCS, Century Communities, filed for mixed shelf size not disclosed. That's Charlie Sandy. CCS.
Shortly expecting comments from ECB's Nagel.
Iceberg ESM for CME buy at 50.40 crossed 500.
Fed bids for 4-week bills total $226.1 million.
VNRX, Evolution RX getting a pop to the high, $1.
No, ticker PayPal, PYPL. And Sam Altman, Fortune reporting, Sam Altman's WorldCoin is in partnership with PayPal that now being circulated, PYPL. PayPal seeing a spike in activity now in those circulations, PYPL.
PYPL, report from Fortune. Says Sam
At
opens
11:30
WorldCoin
a.m.
in
Eastern
partnership
Time, the
with
US sells
PayPal. That's from
$70 billion in 4-week bills,
Copy Yankee
prior bid
Papa
cover of
Lima.
2.9 and prior high yield of 5.28%.
Hey folks, hope everyone out there tuned in is having a good trading day so far. I realize it has been quite a turbulent session. So, certainly if you're getting chopped up by this type of price action, what I call it is the popcorn machine, because you just see people getting popped
GME
out of their
GameStop,
stops
the May
left and right.
$10 calls trading. Golf Michael Echo, GME GameStop. She was moving again today.
So this is the popcorn machine. This is where it's a good time to be a little bit careful. As we discussed earlier, more selective trading, smaller position sizes, wider stops for the trades you have the conviction to enter. That, for me, is how I approach a market like this. And my only real trade today that I did intraday was gold, right? Because it was just such an easy trade. In and out, you hit that bottom trend line, and then you had that exhaustive stop out we talked about earlier. That's it. That's your in and out trade. There doesn't always have to be a day of constantly hitting buttons and trying to, make our
PayPal
broker.
continue to see heavy activity on those circulations.
It's not a good time to pay our brokers' kids through college, is what I'm saying, with commissions. Much less trading and just much more selective trading in this type of environment is the key to surviving. It's fine to observe, it's fine to watch, but we don't need to always participate. And this is a big lesson for traders of all time frames. So let's be just a little bit more careful out there. I don't want to see anyone get hurt. Whatever side of the trade you're on, bullish, bearish, whatever, I'm just here to help and try to help you all find your way through the markets, because at the end of the day, trading is one of the hardest professions, and the shorter the time frame, the more likely it is that you're going to have a bad outcome, right? Because you're increasing the probability of trades eroding your capital. So for me, I just want to try to play the role of being the calm, rational voice out there, objectively analyzing what's going on. From the very beginning today, I was saying, 5,000 key level, we're going to chop around a lot. We've still seen that as the outcome. If you can trade that chop and make money, that's great. But if you're finding yourself struggling in that chop, take a step back and consider this is not an ideal trading environment. We did have a trend develop, but we haven't had a normal trend day outcome, right? And we haven't had the types of options flows that give us any real degree of conviction one way or the other either yet. So I would just be a little more careful in this environment. If you're not used to this and you're getting chopped up, take a step back, look at your system, look at what qualifies an entry and an exit. Are you over trading? Is that over trading serving you? And if it's not, reconsider frequency, selectivity, but also, and here's another thing.
MRX indicating $20 on 652,000. RBRK indicating $38 on 931,000. LOAR indicating $40 on 516,000 IPOs for today.
Understand the regime you're in. Understand the dynamics of the market environment, because that's the other thing that you can, first of all, potentially backtest against if you can qualify those variables over longer time frames. But secondly, it gives you a sense as to when you do well and when you don't. So when you're journaling your trades, don't just talk about entry, exit, talk about the regime. How are you doing during a choppy trading day versus a trend day? Is your success rate better or worse? Probably worse if you're like a lot of other people. That might tell you don't want to trade these types of days as much, right? There's these little things that we can do as traders to kind of reprogram ourselves to have better outcomes, and all has to do with behavior. And behavior forms over time, right? So first you get into an action that you repeat, then it becomes a habit, then that habit becomes a routine, and then it becomes an ingrained behavior. So that selectivity, people that have been trading for a long time that are successful, they kind of build it in to their mental framework. But if you're struggling with that selectivity or that regime identification, whatever your time frame, focus on it a little more. Because understanding the type of trading regime, the type of environment you're in, like today is more of just a sort of balanced chop fest, right? because we didn't get really a lot of opportunities in the cash session. A lot of this
At
happened pre-market.
11:30 a.m. Eastern Time, the US sells $70 billion in 4-week bills, prior bid cover of 2.9 and a prior high yield of 5.28%.
So it's just that's the wisdom I wanted to convey. I've been trading since 2005. And one of the things that I've learned over time is regime awareness really helps me be more selective about what trades I want to take and don't want to take. You know, we can have a theory, that's fine. But not only does the price action have to agree, but so does the environment to add the probabilities of the outcome we're looking for. NASDAQ trading down 1.72%, S&P 500 at 1.25% at 5,805 cash. NASDAQ 100 down 1.6%.
BYND, Beyond Meat, getting a pop here, $6.16, Bravo Yankee November Delta.
And that stock is just reaching an area around $6 where we've seen rebids. So BYND, highly shorted stock, 37.77% of float shorted. This is about 22 million shares of a 60 million share float. So this could be a bit of a squeeze, average volume about 3.5 million. So to exit that trade for shorts could take quite a while. It could take about 2 trading weeks. And so if you do have an event volatility catalyst to the upside, this is one that could run. Now, it is a terrible company, so don't get me wrong. I don't want to be long beyond as an investment. But as a trade, this is one of those crowded shorts that you want to keep your eye on, because when the momentum gets going, is if you pull a chart up on screen, you can see this thing can run pretty wildly. So watch BYND, especially the calls near to the money, close to expiration for the potential of a squeeze taking place. Earnings are coming out May 8th, so you have a little time ahead of that. So I've been asked, what sites can I check short interest? If you're, looking for 2 free ways to check short interest, you can check finviz.com, finviz.com, and Yahoo Finance. Obviously, the data is going to be a little bit latent because you're not paying for it. If you want to pay for short interest, there are a number of vendors out there. FactSet has that data. I believe there's a company called S3 that has that data. There's a number of different vendors that have short interest data. There's also fintel.io, which gives you just a little bit of other data about short interest. It's more about the number of shares that are available to borrow at Interactive Brokers, which is one of the largest clearing houses for that. So my thought here would be, when looking at some of these stocks that have low floats, high short interest in an environment where some of the hedge fund favorites are getting smashed, some of these could have room to run, right? Some of the favorite shorts could have some room to run. We just need a catalyst. And thanks, Jim. Really appreciate that. That's
Shortly expecting the results of the 4-week bill auction. I'll lead with the high yield.
Very nice feedback. He said, best education I've seen in a long time on the web. Definitely going to reach out more this weekend about services in the Discord. Thanks for all the streams as well. You're welcome. Really love to hear that. That's awesome. And I'm glad it's helpful to you in your process. Do see some liquidity building above here in the S&P 500 futures contract, just below that second most active call strike level as we continue to toy around with S&P 5000. And look at this chart. What have we really done today other than chop around? We've just chopped around the vol trigger, and that vol trigger matches S&P 5000. And as Boog said on the Discord, one does not simply escape S&P 5K after OPEX. All too right. One does not. There's an increased likelihood because you've got that gamma unclenching effect, but it doesn't automatically mean that that area is resolved because it's such an enormous area of positioning overall. Let's check around some of these other markets, these indices and stocks and other commodities and contracts we like to watch. Here's the NASDAQ. It got up to a large resting offer for this contract since it's not terribly liquid and was rejected. And we see selling pressure building into that rejection. So that is interesting. That's certainly giving us another sign from auction theory that not enough demand to take us over a supply zone. So path of least resistance is reversing lower, now below VWAP, heading towards the point of control. Russell 2000's been playing games with this point of control ever since the open here. Really got absolutely smashed when that PCE data came in hotter than expected and pushed rates higher. And we have this 10-year note futures contract still recovering from those lows. But remember, this is still well off its earlier high. So rates are still up across the yield curve. And that is putting some pressure on equities today as well. Crude oil trading 82.23.
5.275%, 5.275%. Bid to cover ratio 3.14, 3.14. So the US sells $70 billion in 4-week bills and awards 26.27% of bids at high.
So just a fine auction there for the 4 weeks. Not really anything I would have expected, and the 6 months, not really anything I would have expected to be a event volatility catalyst. And so it wasn't. There's almost always demand for bills, particularly when bank reserves and reverse repos have an abundance of cash. And reverse repo, above 400 billion, probably still enough liquidity in the system to bid those pretty well. So not too worried about the shorter end auctions, really looking at the belly of the beast. And today we have that final belly of the beast auction, that 7-year note at just after 1 p.m. when we can expect the results made public. Could see copper also having a day of just consolidation. This is a common theme across many markets. Gold has retreated lower off of its earlier highs. Again, we saw that exhaustive stop out from shorts, and that marked the high. That is often a turning point when you see something like that happen, because basically at that point, you've seen all that forced buying take place, and the path of least resistance is often lower unless there's further event volatility catalysts to the upside.
Yes, iceberg alert. Buy 1001.
And silver, wow, quite a day for the metallic Widowmaker. Also chopping in a range, but a big range, basically a 2.5% range on this contract. Let's take a look at the semiconductors. We earlier were looking at their relative strength versus the broader market. It looks like they're starting to give that back, rebalancing around this VWAP level. This is probably one of the more important charts to watch, along with NVIDIA, which is about 20% of the SMH ETF. And it is grinding lower here. Zooming out on NVIDIA, you can see how this is now starting to really give us a look of moving away from consolidation and back into a downtrend. We'll move back to the S&P futures here. And just covering unusual options flow, NVIDIA 830s for May 17th. Those calls in demand with 151,000 in premium paid there. And Tesla 170s for this Friday, 118,000 in premium paid there. Snapchat 1250s for May 17th, 99,000 in premium paid for those. So we are still seeing unusually large sweeps on the call side of individual stocks and ETFs exceeding the demand for puts on the other side. In terms of S&P options, the excess of calls versus puts was over 19% earlier. Now it's just 4% with a put call ratio of 1.04. Most active strike on the put side 40-70, most active strike on the call side 50-50. Been asked, what are my thoughts on the 7-year ahead of the auction after today's data and the mixed 5-year auction? I think it's going to be another tough one, maybe C to D grade. So yesterday I gave the 5-year a C minus, and just for context, the 2-year before that I gave a B. I grade auctions based on indirect demand, bid to cover, particularly versus prior auctions, and then I also look at whether there's a tail. Yesterday's 5-year had a small tail. Bid to cover was lower, even though yield was appreciably higher, and the indirect take was a bit low, around 66%. So I'm, especially after today's PCE data, leery to say that we're going to have a very strong auction. I think that this sparks concern, particularly in those longer duration commitments to the U.S. Treasury, about what's going to happen with the purchasing power of the dollar, how much higher yields could go, which would mean that the notes that you're buying could be worth less if you had to clear them on the market. And what that implies is that you could have a weaker auction. You also have Janet Yellen threatening Chinese financial institutions and, saying they could sanction them. And unfortunately, ICBC and some of these other Chinese banks are some of the largest participants in these treasury auctions.
Getting a pop here to the high on some volume popping. Now that's MUX shares up about 5%.
So I do think it's important to take that into consideration ahead of the auction. I don't expect a great auction. I don't expect it to necessarily be abysmal, but I would expect it to be as bad as, if not marginally worse than the 5-year auction yesterday, which was objectively not a great auction. Got some other feedback I'd love to share because it's why I do what I do. One person says, really appreciate your insights and commentary. Very helpful. Someone else agreed, said great analysis and info. So thank you all so much for tuning in, saying as much. I also, someone on our Discord said, I'm absolutely loving your streams and real-time commentary. There's so much to learn from your remarks, observations, and everything that you share this way. It's just impossible to get that from books and elsewhere. Sincere thank you, sir. So, y'all are the reason I do what I do, because I'm here to help. I started my journey on social media to learn and to share what I've learned. And so hearing this type of feedback is very gratifying. I am very humbled, but also honored to be someone that you all look to learn more about the markets and what's going on and improve your own horizons. And meanwhile, for me, it's still a journey of learning. I'm never going to say I'm a master. I'm always a student. I'm always learning. The one thing we know about the world of finance and, quite frankly, technology and a number of other areas of life is you always have more to learn. So someone asks, I read China and Russia have pretty much stopped using the dollar for anything. How will that impact the market? I would say it's a little bit of an exaggeration to say they've stopped using it for anything. I mean, China's the U.S.'s second largest trade partner. So they're still in receipt of a very large volume of dollars. A lot of those dollars get parked back in U.S. treasuries. And so I think the risk here is if the Treasury Department gets too aggressive on Chinese financial institutions and overall just China, that could cause some of these larger participants in auctions to step back. And I think that would cause more volatility. It would cause rates to particularly have the potential to move higher, but you'd also just have more volatility because there'd be less participation in the market. So I think the Treasury Secretary's words are not considering the overall implications of how this could impact a market that relies on foreign buying. Really, without strong foreign buying, the U.S. Treasury market's going to have appreciably higher yields. So You know, with regards to Russia, they've been kind of locked out of the Western financial system to some degree. I mean, obviously, they can skate sanctions in a number of different ways, and we can see they have with their oil prices far above what was supposed to be sort of the limit or the cap, and Russia's economy seeming to do overall reasonably well. I think that the overarching theme here is the dollar is used more and more as a weapon. You're going to have more and more countries move away from transacting in it and using it as a store of value or as a reserve for their central banks. You can see central banks around the world have been buying gold in record volume since 2022. What happened in 2022? Well, the US and their allies in Europe started to use the Western financial system as a weapon against Russia and anyone that wanted to support them. The more you lean into that, the less appealing your currency is, the more that folks will diversify. This is a long-term picture, though. This is not the imminent end of the dollar. It's something that could take years, if not decades, to fully play out because there's so many assets that are priced in dollars. There's so much debt in dollars, and there's so many attractive financial assets that are priced in dollars that the dollar is going to have demand for some time to come. There's also a lot of trade. The most of the world trade is still settled in dollars, albeit less over the years. So there's always going to be this demand. It's going to take quite a long time, I think, for the dollar to really fall out of favor. And then you have to ask yourself, what's the successor? Is it the euro? Is it the yen? Is it the yuan? Is it gold? Is it some sort of central bank digital currency or IMF, SDR? You know, there's not a lot of viable alternatives at scale. So that's the other reason. It's just sort of like if currencies were a dilapidated neighborhood, the yen would be the house that's on fire and is like burnt to ash. The euro would be the house that's like just starting to catch fire and the fire department's trying to respond to it, but they're late. And then the US would be the house that needs like, you know, new floors and work done on the drywall and work done on the roof and all that, but it's not completely like destroyed, right? So it's not that any of these are the best place to transact or to store money. It's more that the US is like the least bad in a overall pretty bad situation. It's been a race to the bottom. I mean, look at it. Even though the dollar is appreciating in value against the euro and the yen, its purchasing power continues to diminish. So, you know, when you measure the dollar against any objective benchmark of purchasing power, you can see for almost, 100 years straight, basically since the inception of the Fed, the dollar's path of least resistance in purchasing power is down about 97%. So I'd say that, this is sort of the destiny of these fiat currencies. Eventually they lose value.
For CME sell at 5,045.25 crossed 500.
But often it takes longer than anyone would reasonably expect. Yeah, you're welcome. Great question. $220,000 in premium paid for Meta, 435 calls expiring this Friday. And we're just going to briefly recap GDP and PCE because I know not everyone was tuned in earlier, and I think this is helpful information to contextualize what we're seeing. So today's GDP came in weaker than expected. This was 1.6% print versus a forecast of 2.5%. And the prior reading was 3.4% for Q4 2023. But what really shocked markets was U.S. core PCE prices advancing 3.7% quarter over quarter. The prior reading there was 2%. The forecast was 3.4%. So what does that tell you? It gives you a sense that inflation is still a problem, that it is still reaccelerating. The Fed really wants to see core PCE at 2%. So a 3.7% reading is the exact opposite of what gives them any confidence of cutting into this environment. And indeed, Fed swaps are no longer pricing in certainty of one rate cut this year. So net, rates are moving higher, risk is moving lower, the inflation situation isn't under control. A lot of this can be attributed to a combination of fiscal largesse, the Inflation Reduction Act and Chips and Science Act, late 2022 going into 2023, the cessation of debt issuance for the first half of 2023 being net liquidity positive, and then really going whole hog into that spending the latter part of the year when debt issuance resumed. That more than offset the tightening of Fed's monetary policy. And then it didn't help that the Fed started talking about mission accomplished late last year when nothing of value had been accomplished. That led animal spirits in the market to price in as many as 7 cuts this year. It helped to build this rip-roaring rally in stocks that benefit from disinflation, like these tech stocks, and growth in other rate-sensitive areas of the market. Now we're seeing that narrative upended. Inflation is back, or maybe it never really went away. The Fed's rate cut trajectory is now one where it's much more conservative. We get a rate cut this year, but there's no certainty about that whatsoever. And then looking into the overall liquidity dynamics that have been driving the market, that's starting to dry up. Financial conditions are starting to tighten. Rates are starting to move up again. A lot of that driven by concern about inflation and, to a lesser degree, the Fed's changing rate trajectory path. All of that tells us volatility is back. And there is a repricing of risk, particularly in the more rate-sensitive parts of the market. And their beneficiaries, these late-cycle plays, energy, industrials, metals, materials, mining, and otherwise, that can benefit in this type of environment. So it's a rotation. It's a bit of de-risking. It's some profit-taking. It's not the end of the world, but it does mean that investment and trading strategies need to adapt and evolve.
Airbus, with their results, CADSY reported 0.76 euros.
Now ticker Boeing, comparable headline.
Airbus to increase output rate for A350 to 12 per month in 2028. That's from Airbus.
Note Airbus also giving revenue guidance. Note Airbus sees deliveries below estimates.
Yes, iceberg alert. Sell 1000.
And folks, if questions come to mind while you're tuned in, feel free to let me know.
Yes, iceberg alert. Sell 1060.
I'm seeing a little bit of selling up here as we revisit some of these highs we've been at. Seems to be an area of interest where sellers are looking to de-risk a bit. You can see those larger icebergs. Just 1,000 share or 1,000 contracts sold up here. Similarly, when we're back at this level, we had another 1,000 sale. And we do see a lot of resting liquidity, a lot of interest in offers above as well. So something to be aware of. The market's making it clear this is an important level, sort of a line in the sand.
MRX indicating $19.50 now on 1.02 million shares. LOAR $45 on 1.35 million IPOs.
And folks, if you're tuned in here, we just released our free preview of the Bank of Japan's rate decision and monetary policy framework. It's available on macrovisor.com. Highly suggest checking it out if you're following the story of what's going on with the
I'll take a
yen.
YYGH, Yankee Golf Hotel share seeing continued heavy activity, new highs, YYGH.
And if you're following that story in Japan, it's a great read and certainly an important area of the market, particularly as the yen is in focus. Earlier today, we got news that the Bank of Japan is considering slowing their government debt purchases, and I would just throw caution on that. I don't think that they're going to be able to do that. Hey, Aaron, great to see you on the feed. His question is, did the sell today just price in PCE and Microsoft Google earnings? I don't know that it did. I think for PCE, perhaps, to some degree, because the scare really seemed to happen with the release of GDP and quarterly PCE data. So maybe that part is being priced in more so. And certainly we're in a very low skew environment at the index level. So this is not a well-hedged market. We'll see whether those dynamics change overnight ahead of tomorrow's release. If they do and the market's better hedged, then maybe we can say this is more priced in. On the other side of it, with Microsoft and Google, I would say that's not priced in yet. And the reason I say that is because I think that either scenario, tails are pretty big in both directions. But the onus of proof and really the burden of showing that growth trajectory is going to be able to continue.
Shortly expecting the results of the Freddie Mac mortgage rate statistics for the US.
That'll be on management to show in guidance that they're confident that this trajectory of double-digit growth is something they can sustain. I would be skeptical.
Yes, stop alert by 11:36. Stop ESM for CME buy at 5046.96, volume 929.
I would be a little bit skeptical that we get that kind of rosy guidance, but we'll certainly see. And my thought here is watch rates. I think this is still a story about rates. Started talking about the 10-year above 4.5%. Stocks take notice. I still think that's the story. As rates appreciate, you see a lot of what was market leadership come under increasing pressure. Speaking of rates, we're just checking in on the 10-year note futures contract, continuing to be bid off the lows, but still, it had a pretty big, sharp drop today, which pushed rates to the highest levels we've seen this year.
Your LOAR, Lima Oscar Alpha Romeo IPO for today open, LOAR.
LOAR, Lower Holdings, opening at 45, priced at $28. That's Lima Oscar Alpha Romeo.
Yes, iceberg alert. Sell 1001.
Open now.
It's more iceberg selling here at the upper end of this range. We did make new highs here, but we are seeing a lot of offered liquidity above us and some iceberging into those highs.
US 30-year fixed rate mortgages 7.17% April 25th week versus 7.1% in the prior week.
Let's go back to the semiconductors and see how they're faring. Remember, they were showing us leadership earlier. Not really recovering the way that one would hope to see with the market trading as it is. So it doesn't seem like semiconductors are leading us quite out of the weakness. The head of that pack, NVIDIA, also not reclaiming its intraday high. So let's look at some of the other parts of the NASDAQ. Looks like we're actually seeing leadership from Microsoft coming in here ahead of their earnings. Meta is still trading kind of flat over the last hour, so not so much there. Amazon's also perking up quite a bit. Apple getting a rebid. Tesla still chopping around. It's kind of been all over the map today. When we zoom out, you can see that, but back in a pattern of distribution. But it looks like it's some of the other stocks that are leading this higher, not so much the semis. Google, another one. So I'd be focusing on those: Google, Microsoft, Meta, what's happening at Apple. That seems to be what's helping to lead us off the lows so far today. The semiconductors seem to have kind of shrugged this off a bit and are no longer leading the market higher.
LOAR, Laura Holdings, moving higher now, 47.70.
Also, it's important to look at some of these other stocks for what they are. SMCI is an integrator. They are not a semiconductor. So when the integrators are rallying, like Dell and HP and others, certainly it can pull that name higher as well. But it's important to contextualize it properly. The leading semiconductors that are moving today are Broadcom up 2.26% and NVIDIA up 1.89%. Now let's just take a quick look at the market heat map here. You can see this on screen. We'll just full screen it for a moment. So you can see where the strength and weakness is in the broader market. This is the heat map from FinViz. You can find it at finviz.com. And there's, the semiconductor space with NVIDIA and Broadcom kind of leading the way, and a lot of the others not really faring so well. I guess Monolithic Power Systems, another one. Lam Research doing okay, but overall a bit of a challenge space. Arista Networks has a good bid here too, up about 3.14% after a brutal several weeks. And SMCI marginally bid, just up 1.83%. Again, wouldn't make a lot of that company's price action. I don't think it's a favorite of this market anymore. IBM after their earnings, but importantly also the HashiCorp acquisition, down almost 9% today. Meta down 12.61%, certainly well off its overnight and cash session lows. And so it's mixed, right? You've got some pockets of strength in semiconductors, in parts of healthcare. You've got some industrials that are doing reasonably well here, right? But you also have some pretty large swaths of weakness. And I think that's something to just kind of take into consideration. The rotation here is somewhat limited. There is just more widespread selling pressure as a theme. So we'll pop that off screen here and go back into Bookmap. And folks, if you have any charts or anything else you'd like me to look at, feel free to let me know. We did see the S&P take out that overhead resting liquidity despite several iceberg sales and a bit of an exhaustive move by buy-side stops. We still have this moving higher, this market moving higher, well off of the key 5,000 level, building some acceptance here at about 51.19 on cash. So what is that telling us? It's telling us the market seems like it's resolving above that key 5,000 level. You also see liquidity building up above us here at 50.56 and 50.60, just between that warm call or the second most active call strike on SPX. And you can also see that most active call strike just around implied 50.86 on ES.
Ticker PEI, Papa India shares an increased activity, new highs. No company did report earnings. No Dan Niles out with a positive tweet mentions on PI.
Continuing to see price of the S&P 500
Ticker
gravitate towards
OSCR.
the
Yes, iceberg
Spike
alert.
in activity.
Sell
New high.
1,000.
Oscar, Sandy, Charlie, Romeo.
continuing to see
Iceberg ESM
S&P
for CME sell at 5,050.
continue to see S&P prices moving up towards these larger levels of resting liquidity overhead that correlate well with the second most active call strike on SPX as the market starts to reverse off of its lows, making new intraday highs. We also just saw a 1,000 watt iceberg once again, passive distribution into the strength.
Dollars. That's Michael Romeo X-ray, MRX. U.S. judge rejects Donald Trump's bid to throw out E. Jean Carroll's $83.3 million defamation verdict.
The ticker Rocket Companies RKT. Note Hunter Brook announces a long position in a tweet for RKT. They're now being circulated.
MYSZ, my size, halted on a circuit breaker. Michael Yankee, Sandy Zulu, halted low volume on that one.
So far, S&P futures seeing a little bit of resistance right here at what has become the most active call strike that correlates well with this large offer, this resting offer of 656 contracts just above 50.55. We do see that liquidity building above us as well, rather large offers. And as we've built this uptrend of higher conviction buying, we've also seen some passive distribution, some larger institutional iceberging into it. Folks, coming up in just over 40 minutes, we will have the 7-year note auction from the U.S. Treasury, which could be a market-moving event. Last auction we had was a 5-year. That was about a C- auction based on my grading. Indirect demand was lower. Bid to cover was lower in the last auction, despite yields being higher, and we did have a small tail. The 2-year auction on Tuesday was actually stellar. That was a B rating. No tail, strong bid to cover, and large indirect take over 70%. So let's see how this 5-year note auction comes out, or I'm sorry, the 7-year note auction comes out after yesterday's 5-year that wasn't so ideal. I'm not expecting it to be too good, and we'll have to just see how the market digests that. I will have some of the Treasury futures contracts on screen, and we'll discuss those results as they post.
White House said some aid will get to Ukraine in a matter of days. As U.S. can contribute to Ukraine's air defense needs, we'll do that. RBRK indicating $38.50 to $39. Supreme Court conservative justices seem receptive to Donald Trump's argument that former presidents have at least some degree of criminal immunity for certain acts taken while in office.
So seeing according to sources, TikTok owner ByteDance is to prefer shutting down over loss-making app rather than a sale if it exhausts all legal options. So the algorithms TikTok relies on deems core to
SMCI,
ByteDance's
Supermicro
overall
getting a
operations,
pop here.
making
Sandy
sale of the
Micro,
app
Charlie,
unlikely,
India,
according to sources.
up about 3.5% now, SMCI. TikTok owner ByteDance to prefer shutting down of loss-making app rather than a sale of exhaust all legal options, that according to sources reported by Reuters.
Continuing to see S&P futures climb up through these levels of resting liquidity overhead. There is some passive distribution as we go, but buyers obviously have the demand to keep this going here, cutting through every single level of resting liquidity, now targeting 50.65 here with 786 on offer. Moving over to the 10-year, we can see that rates have come off of their highs. There's a bit of a reprieve as the contract has a bid. We can also see the NASDAQ is recovering appreciably from its lows and really to new highs on the day, I believe. Let's just zoom out. Yep, indeed, just making new highs recently on the day on the NASDAQ here. Let's check over at semiconductors. We know this is a pretty important part of the market. And we do see they're starting to recover after this consolidation finally breaking.
Ticker
out to a new
NCI
high.
November Charlie India share seeing a spike in activity, new highs NCI.
We can also see NVIDIA also climbing up to this key level around 820, where there's been a lot of options activity and a fair amount of resting liquidity overhead.
Let's take a Joby in a press release. Joby is partnering with Abu Dhabi. Shares of Joby seen a spike in activity, new highs. Let's take our NCI, November Charlie, India. Shares continue to see heavy activity, new highs, NCI. Let's take a BTCY, Bravo Tango Charlie Yankee. They are withdrawing their offering, BTCY. In the form RW being posted. I know ticker JOBY should continue to see heavy activity, new highs. Juliet Oscar Bravo Yankee.
Fed bids for 7-year notes totaled $209.7 million.
Figure IZM, India, Zulu, Michael share spiking with activity for IZM. Ticker rubric IPO is open. Romeo Bravo, Romeo Kilo, RBRK.
ERK opens at $38.60. The IPO price was $32. Romeo Bravo, Romeo Kilo, RBRK.
In 10 minutes' time at 1 p.m. Eastern, the US sells $44 billion in 7-year notes. Prior bid to cover 2.61, prior high yield 4.185%. Ahead of the auction, latest CFTC positioning data shows speculators net short 362K 10-year note futures, a potential source of covering demand at the auction.
ES stop alert. Buy 1000.
And folks, just continuing to see a bit of the same area of potential resistance at this 50.65, where the second most active call strike is transacting. We have seen the most active call strike moving up just about 50.85. That's the SPX level translated to ES. And we see additional upward pressure here overall, suggesting that we may indeed take out this area that has so far acted as resistance.
In 5 minutes' time at 1 p.m. Eastern, the US sells $44 billion in 7-year notes. Prior bid to cover 2.61, prior high yield 4.185%.
So we are going to be getting that 7-year note auction coming in. Let's take a look here at the 10-year note futures ahead. We do see a pretty strong bid there, making up some of those post-quarterly PCE losses that we've seen. We'll check in on the 5-year note futures as well. Pretty similar look there. We'll check back on these as the auction grows closer.
S&P futures popping here, 50.6750.
NASDAQ taking out 17,500 to the upside here, moving above the point of control that buyers have dragged higher. And that 17,450 negative delta of 834, more sellers off sides.
SMCI Super Micro more highs now, 789.76. Shares up about 4.6% now. Sandy Michael Charlie India.
And SMCI 775
Shares of
calls.
NVIDIA up 3.3%, 823.05.
SMCI 775 calls 278,000
SPR Spirit Aero
expiring
Airbus
this Friday.
CEO says cooperation and partnership with Spirit Aero is good, if not very good. Managed complex and difficult situation. That's Sandy Papa Romeo.
NVIDIA
SPR.
830s on bid, 147,000 premium for those calls expiring this Friday. Also just crossed. Taiwan Semi 137,000 in premium for those expiring on May 3rd. Those are the 140 strikes. A lot of semiconductor and hardware sweeps. We've got NVIDIA and Taiwan Semi in the semiconductor space, SMCI in the hardware integrator space getting a lot of demand here. As we approach that 7-year note auction, we're going to be keeping the 10-year note futures on screen because that's the most liquid proxy to really view the results of this auction.
Block trade in ticker, BEN.
It's about 2 minutes away from the auction, probably about 3-4 minutes away from results.
Shortly expecting the results of the 7-year note auction. At the top of the hour, we do also get the when issued yield.
Final trades on CNBC, XLU, VZ, GM.
When issued yield 4.716%.
You can see liquidity diminishing here in the 10-year note futures contract ahead of this event. This is another reason to be careful trading these. Liquidity tends to vanish across a number of different contracts, making slippage and execution risk much higher.
Bid to cover 2.48, 2.48. High yield
FSRN,
4.716%,
Fisker now trades OTC.
4.716%.
A report
US
from
sells
Business
$44
Insider
billion
said that
in
CEO Henry
7-year notes
Fisker
and
told
awards
staff
35.06%
during a meeting that on
of bids
Thursday
at
that the
high.
company was in talks with 4
Primary dealers
automakers.
take 13.9%, direct 20.99%, and indirect 65.11%.
Going to go ahead and give this rating, this auction a C rating. It's better than the 5-year auction yesterday in that there is no tail, but demand was still pretty low. So not a great auction, all things considered. Yields had risen appreciably, yet the bid to cover actually dropped, and the indirect take was just in the mid-60s.
US 7-year yields little changed at 4.723% after the auction.
You can see liquidity coming back. No real market reaction to this auction, basically being treated as a non-event so far. And I'm just giving it a C, basically an average auction. There was no tail, but demand was pretty low, and so was the indirect take. Let's go back to markets here, see what kind of reaction we have in the futures. So again, that auction, giving that a C grade. The bid to cover drop from the prior auction was 2.61 when the yield was appreciably lower. There was no tail, but indirect demand was only 65%. So giving that a C grade auction, pretty much a non-event for the overall market. Yields little changed. And seeing a spike here in S&P 500 futures post-auction. Moving up just about 5 handles off the lows towards this resting liquidity at the 50.75 offer, 235 contracts. A little bit of iceberg selling into that pop, just about 100 contracts passively distributed into that. You can see the icebergs are shrinking a bit, but institutions are still selling into strength. And we do see more liquidity stacking up above here in S&P futures and some appearing below. We've got 50.60 on the bid at 183, 50.73 at 222, and 50.80 at 223. And we are just pushing above that second most active call. The most active call implies S&P 50.86 on the June front month contract. So auction, a bit of a non-event. Markets kind of given the all clear to keep moving higher. Any hedging that was made into that auction being taken off here.
Treasuries hold losses after $44 billion sale of 7-year notes.
Yeah, not much of a change here. Again, looking at the Treasury market, this is a market that the primary event was PCE and GDP, with PCE helping to scare the rates higher and prices of Treasuries lower. That is something the auction didn't really have much of a material impact on. So to be clear, the auction really a non-event. If we zoom in on that time frame, just kind of chopping back and forth. The bigger catalyst was that scare of higher than expected inflation data. Now we can see price so far just being drawn back to that warm call strike on ES. That seems to be a somewhat important level for us to watch. Let's take a look at what's going on over here in the NASDAQ as well. And we'll just zoom in a little bit here on the near-term price action. And this is a contract where you don't get as many hints from resting liquidity, but where we do see resting liquidity is just down here at, I think it's just about 17,420 or so, 100 contracts on the bid. That's really the largest level we see near current pricing. We are above the point of control in VWAP. Buyers did pull that point of control higher. And since they have, we've seen additional accumulation, but now we're starting to look like we're doing more of a consolidation here. Let's take a look at the Russell. Russell actually breaking out to the upside here, unlike what we're seeing in the NASDAQ. But overall, this is one that really fell appreciably earlier, so it still has a lot of repair work to do, up only about 20 points from its lows here. Let's check in on crude oil. Crude oil has been pretty choppy today, as we can see zooming out on this chart. It did base around 82, and you can see this is a familiar theme we've talked about quite a bit on the stream today. When you get to a level of large liquidity on bid or on offer, and price rejects that level, particularly more than once, you are often going to run the other direction. So crude ran the other direction, just about 50 cents higher off of those lows around 82. Copper continuing to chop sideways, a bit of a theme we talked about earlier. Gold had a nice run earlier. It's given some of that back. This is still one that's above that trend line, so it's still worthy of a bid, but the more it taps down on that trend line, the less conviction I have that it's going to be able to follow through higher in the near term without a larger corrective selling impulse. Silver had a nice round trip today. This is one that's also been worthwhile rebidding when it sells. It got down to about 27.15 around 10 o'clock and then pushed all the way back up to 27.60. This is not one to trade in size. You can see how much it moved in such a short period of time, basically 2% in 30 minutes. So you got to be careful with the metallic Widowmaker. But like gold, I remain constructive on it. My pivot level for silver is 27.045. Checking in on the euro, it is getting a bid. That's helping markets here as the dollar is weakening a bit. And you can actually see that the euro has made new highs after that PCE-induced drop. It is now actually rallying rather significantly off those lows. You can see semiconductors making new highs here. We saw that earlier bid. It was sold into, but now they're actually starting to gravitate higher following Microsoft, Google, Meta, and others higher. So let's take a look at Apple. Apple coming down a bit, but again, this was one that had a nice bid off of its lows. Amazon is another one that had a pretty nice bid off its lows. It really well rejected that 170 level. It pierced through it, but then it built support at that level, and it's been kind of up and away ever since. But I have a feeling 173 is sort of the other side of this, where we may see some resistance because of the size of that offer. Google getting down to 155, giving up some of its earlier gains, but this is another one that had a nice rebound today, right, into some selling pressure at the open. It's just sort of been up and away ever since. And we have Google and Microsoft earnings coming tonight after the close, with Google expected to give us 152 EPS, and 6606 billion in revenue. Got Meta on screen here, just trading below 440. Got a large resting offer overhead at that level, 19K shares on offer. This one's recovered well, but I don't know that it's out of the woods yet. And Microsoft really staging a pretty impressive rally off of its lows, making new cash session highs ahead of its earnings and almost recovering completely. And then you've got NVIDIA here, which is also challenging some of those earlier highs and starting to break above them. You do have a pretty large resting offer at 827 and then a larger one at 830 and an even larger one at 840. We did talk earlier about the options interest in NVIDIA, those large sweeps coming through. This is the most actively traded stock in terms of its options almost every single day. So, no surprise we saw those sweeps came through and that helped to give this a bid as well. And Tesla just sort of trading sideways, continuing to digest that post-earnings rally. And folks, on either side of the trade, either believing that this is the
Shortly
cure
expecting
to
the
all
results of the Fed reverse repo operation.
cure to all that ails the company, or that maybe management's blowing a lot of smoke. I lean in towards the latter camp on that one. So let's go back to the S&P 500 here. We'll see how that reverse repo auction goes. And, the key level for me is really 400 billion. Going below that would get me a little more concerned about liquidity.
$74 counterparties take 443, spot 928 billion at the Fed reverse repo operation.
Yeah, so we see reverse repo balances coming back up to the mid 400 billions. I wouldn't be too concerned about short-term liquidity from that perspective, given that we've seen that rebound after some degree of paying out from it for tax estimates and remaining tax balances. Meta 440s sweeps on the call side for those expiring this Friday, 126,000 premium paid there. And once again, single stock and ETF options flow. The unusual sweeps on the call side have outpaced those on the put side by about 2-to-1. That tends to be bullish. We've been talking about that ever since I spotted it earlier. That's one of the reasons I think the market's able to push higher here, is there is still a decent amount of risk appetite circling the edges, buying the dip, and trying to push markets off their lows.
In 10 minutes' time at 1:30 p.m. Eastern, ECB's Panetta speaks in Frankfurt.
We'll take a moment to zoom out here and look at the S&P on a longer term chart. And what we're seeing here is futures are trading in the Ichimoku cloud. What that
No,
tells
letter
us,
X, U.S. Steel sure seeing a spike in activity, new highs. Letter X.
what that tells us is that price is not in any discernible trend based on Ichimoku cloud technical analysis. And you can kind of see that with the volatility. It's a little bit indecisive. You can also take note of some of these key levels for S&P 500 futures based on prior price action. And these are important because they tend to be somewhat reflexive. I like to say the market has muscle memory. So that's where we're trading right now. We are in the cloud. We are without trend, and we're kind of trying to get pulled back into this high volume node. And we can see S&P futures
ES
just
iceberg
retreating
alert.
a bit here.
Sell 1000.
And we do have a little bit more selling pressure happening here from the institutional side. Looks like 1,000 icebergs sale cumulatively. Let's take a look
ES
at the
iceberg
NASDAQ.
alert. Sell 1008.
Some more distribution pressure happening here at the index level. And let's just zoom out just a little bit. We can see VWAP here just about 50.46 around the midpoint as we see a relative balance between the most active two calls and puts in terms of transacted volume. So getting pulled down to that midpoint in VWAP, not too unlikely as we start to see the options influence become more of a market imbalance.
In 5 minutes' time at 1:30 p.m. Eastern, ECB's Panetta speaks in Frankfurt.
So if we look at this price range in S&P, we just kind of came back and undid
Yes, iceberg alert. L1000.
that PCE reaction, just kind of bottoming out here and then pulling back higher. We did see some strong iceberg demand earlier, that 3,500 buy, that 1545 buy at the lows. Now towards the highs, we're seeing more distributive iceberging. So make of that what you will, but it looks like institutions bought the lows and are starting to sell more into these gains. All the way from back here, we saw 1,000 sale, 1,400 sale, recently a 200 sale. We heard some more coming over the Bookmap automated chatter as well. So, we kind of did the full range, got to the top of it. We saw some exhaustive stopping out up there as well. Let's see how we go from here. I don't expect Panetta's comments to be market moving for the US, but it could certainly affect the euro. That could affect the dollar, and that could be something that impacts markets here.
BABA, Alibaba shares popping to the highs now. 75.03, up about 0.5%, BABA.
Yes, iceberg alert. L1003.
Shortly expecting comments from ECB's Panetta.
Yes, iceberg alert. L1000.
We do continue to hear some distribution into this upward pressure. There are some larger sellers on the other side of this tape. So it's really about buyers being able to keep that demand coming through. But neither side is too aggressive here. You can see that from the smaller size of these delta bubbles.
ECB's Panetta says small rate cuts would counter weak demand and could be paused at no cost, and we must weigh risk of monetary policy becoming too tight, and large rate cuts could create a credibility issue. Hesitations in adjusting rates would hurt investment and productivity. Timely small rate cuts would counter weak demand and could be paused at no cost. ECB's Panetta says the ECB is likely to remain restrictive well into 2025.
Seeing some other noteworthy sweeps coming through. Meta 440s for this Friday, 148,000 in premium paid for those calls. Amazon 205s for May 17th, 144,000 paid for those. And Google 160s for GOOGL, May 9th, 167,000 paid for those calls.
Yes, stop alert. By 1007.
So, quick recap of GDP. The largest contributors to the increase in GDP were consumption, residential fixed investment, and non-residential fixed investment. Within consumption, the primary increase was attributed to healthcare and insurance, healthcare, and financial services. These are areas that tend to rise appreciably above the rate of inflation, even what's measured. So it just suggests increasing prices are helping to push GDP higher beyond what PCE deflates. Within goods, the decrease was primarily reflected by decreased demand for cars and car parts, as well as gasoline and energy goods. So that's another sign. You know, auto sales tend to do well when the economy is doing well. They're slipping over that last 3-month period during Q1. Within residential fixed investment, the increase was led by brokers' commissions and ownership transfer costs, as well as new single-family housing construction. So that's, again, not exactly
alert. Sell 1,000.
Not exactly robust. And then finally, the increase in state and local government spending, which was another big contributor to GDP, was from increases of compensation. That's right, wages on the rise. And then the decrease in inventory investment primarily reflected decreases in wholesale trade and manufacturing. Again, more signs of slowing. So this is actually not a great GDP print at all. And I do question what it would look like if there wasn't so much late cycle government spending going on. I think it would be appreciably weaker. And it does show the consumer still spending, but they're essentially spending more to get the same or less. And costs are continuing to appreciate in areas of services like medical costs.
Yes, stop alert. Buy 1,000.
And within insurance. And I would say that's another factor. We talked about that earlier, that insurance across the board is appreciating significantly higher than the rate of inflation, and certainly higher than a lot of these measures account for as well. So when looking at the data, always drill down. Even BLS has a nice little summary on the page. I saw some folks saying, you know, the GDP print looks great. No, nothing to worry about. I would take the other side of that and say, actually, there are some concerns with this print. It doesn't mean like imminent recession or anything like that, but it does mean there's an appreciable slowdown happening. And it's happening at a time when prices are rising. And that's not exactly the combination you want to see. Jamie Dimon of JP Morgan Chase flagged the risk of stagflation rising as well. Someone asks in the chat, you mentioned PCE. Wasn't GDP today and PCE tomorrow? Sorry if I'm missing something. No worries, friend. So today we got GDP, which is quarterly, as well as quarterly price data. Remember, the GDP is real GDP. It's deflated by quarterly PCE. So we do get quarter over quarter PCE data with GDP. Then the subsequent day, Friday, we get year over year and month over month PCE data. So we get 3 different measurements of PCE. Quarterly comes with GDP on Thursdays. Monthly and yearly comes in with the big headline prints on Friday. So hopefully that helps. But that hotter than expected PCE print was one reason the market took a bit of a tumble earlier today.
Israel was willing to consider the release of only about 20 abductees as part of a deal with Hamas and not 40 as it had been demanded in the past, Israeli officials said.
So I'm going to ask, do I think tomorrow's PCE data is already priced in today? You know, earlier at the lows, I would have said yes. But given this reversal, I would be more inclined to say no. But what I really want to see is what skew looks like at the end of the day. So what that means is the distribution of premium between puts and calls on the S&P 500. And I want to see whether there's any kind of hedging going into tomorrow, any kind of appreciable increase in hedging, particularly for puts that are rolling off tomorrow. If we see that, I'll say, you know, maybe we're in a better hedge situation. But from everything that I can see right now with the market appreciating, with, you know, really kind of reversing off those lows pretty meaningfully. I would say, and let's just zoom out and see if I'm right that we're kind of at new cash session highs here. I think we are. Yeah, we certainly are now at new cash session highs. The pop that we had earlier also happened just during PCE, during that liquid head fake. But I would say that, around these levels that we had, between 9 and 11, we're sort of like down and just holding around S&P 5,000. I would have said absolutely. It looks like it's more priced in than not, but I'd still want to see the amount of hedging. Now I'd be less inclined to say it's priced in. I think that if we do get a meaningfully hotter than expected number, particularly at core is what the Fed really watches closely. So core month over month and core year over year are going to be very important. And I think if they come in meaningfully cooler than what's expected, we could have a pretty nice face ripping rally in bonds and in stocks. But on the other side of it, if it's a print like today where it's, over 10% higher than what's expected, I think that will cause concern, particularly at core PCE. So I'm going to say that just based on everything I'm seeing right now, I don't really think it's priced in, but I want to see what skew looks like after the close. So hopefully that at least helps to contextualize how I look at this. The other thing that I would say is I really do think the earnings tonight are going to be important. We do have Google, Microsoft, and Intel all reporting, and I think they're going to give a pretty good sense as to how tech is doing. Google, like Meta, is very concentrated in advertising, so we're not going to get quite as much of a clue there outside of the digital advertising space. But Microsoft, with their involvement with consumer and business computing, the cloud, and some of their forays into artificial intelligence and office productivity, software as a service, I think that'll give us a much better idea as to how tech is doing in this environment and whether there's any appreciable slowdown that we need to be concerned about, both in the first quarter and in their guidance. So I think that we do have event volatility risks. They do run the risk of kind of shaking things up. The earnings events tonight are going to be more NASDAQ centric, and the PCE release tomorrow is going to be all about how the rates market digests it. I really like to look at the 10-year note, see how it's trading after a release like that, and then get a sense as to the equity market. But we do see the S&P 500 now trading up towards the most active call strike, as demonstrated by the Advanced SPX Options Visualizer. This is a tool I built for the Bookmap software that's in their marketplace now. It's available for anyone.
S&P futures continuing higher now, 50.8250.
And that
down 25.25.
Thank you. And that tool is something that helps us illustrate just how options are impacting the broader market. So this is something that I built because I always like Bookmap and the way to be able to visualize liquidity and get a better sense as to what's happening with supply and demand in the market. But then I always wanted to view the options market because equities are about 400 billion of notional trade every day across all the futures contracts, and options is 1.2 trillion just across the S&P cash index, or SPX. So the tail's really wagging the dog. And you can see today it's really been important for this market as well, that most active call strike giving us a sense as to where this rally is likely to go. And we could see earlier that the put strikes and the other formerly most active call strike were also magnetic forces for this market. So for me, I really like to look at this with a little bit of nuance. If you folks like Bookmap, you could certainly check it out at a decent discount, traderade.com/bookmap, and get up to 40% off. And the options visualizer is available. You can learn more about it, traderade.com/SPX, and get it on the Bookmap Marketplace, but it is specifically for the ES contract traded with Rhythmic or DXV data. And I will be actually making some other tools. I'll be making options visualizers for the most popular option driven stocks like Nvidia, Microsoft, Meta. I'll also be making them for SPY and QQQ and potentially IWM. So look out for those in the future as well. Currently under development.
$92, up 65%. Bravo Alpha Charlie Kilo. AY shares now at 2059, up about 1%. Alpha Yankee. BACK shares hitting $6.35 at the high of 82%. And shares are halted again on a circuit breaker. That's BACK.
S&P futures continuing to climb towards that most active call strike we see on the advanced SPX options visualizer on the right-hand column. 50,000 contracts traded there, by far the most active options contract on the chain at this time. S&P futures continuing to climb towards that most active call strike.
I'm gonna take a TTOO, Tango Tango Oscar. Patent circulations on the name.
TTOO, T2 Biosystems received notice of allowance for U.S. patent application methods and systems for amplification in complex samples, including diagnostic and therapeutics in whole methods for pathogens in whole blood. That's TTOO.
And folks, we're just going to pause this stream here on Twitter, and I'm going to restart it so that it comes back up for everyone to be able to see more easily. So just check back on my feed. There will be this stream coming right back momentarily. It'll be just a brief interruption, and I will repost the link on my profile so you can find it. So just check back here momentarily. The Twitter stream will be coming right back up if you're tuned in using that. And thank you for everyone tuning into this stream. We're just getting this going. We've been live pretty much all day here, just having fun watching the markets. It's been an up and down day, bit of a roller coaster, but you know, this can be fun if you're used to trading it. For me as an observer, I always learn something as well, just watching how the markets are trading and these intermarket dynamics. So, you know, whether I'm taking trades or watching and sitting back, it's fun. I did get a decent gold trade in off the bottom trend line and a bounce into an exhaustive stop. So that was the main intraday trade I took today. I continue to be a buyer of dips in energy, industrials, metals, materials, and some of these other spaces like aerospace and defense and utilities on dips. So I did see some opportunities in that space and just added some long-term positions in the swing portfolio. But overall, you know, it's been a pretty choppy session, and I think it's got Going to continue that way into the after hours and into tomorrow. So, smaller size, more selective trading, wider stops necessary for those trades one is willing to take.
EACK, after resuming, shares off the highs now $6.11, up 77%.
And if you're just joining the stream, thank you, thank you. You got it here on Twitter. It's on Twitch. It's also on YouTube. We've got it kind of going everywhere right now as we have a pretty exciting day unfolding. I stream more regularly on our Discord, but I want to be able to make this available to the broader public so that folks can see what we do over at Traderade, how we approach markets with a focus on education and a focus on trying to unpack what all is going on so we can make better sense and become better traders as time goes on. So on screen, you can see Bookmap. It is featuring the S&P 500 futures contract, and we have the advanced SPX options visualizer on the right-hand side. This is a tool that I built into Bookmap to better show the impact of options on price. We're just going to zoom in a little bit more to the current microstructure just over the last 30 minutes or so. We can see that price got right up to that hot call level, a little bit of liquidity building above there. And this is just another way of sort of demonstrating on screen that magnetic impact of the most active options contract and what that can do to futures where a lot of market makers are doing their hedging. Because once again, in the SPX options complex across the full chain, about $1.2 trillion of notional changes hands every day. About half of that is for 0 DTEs that are expiring the same day or about 6.5 hours or less after they're bought. But nevertheless, in the entire futures complex of equities, it's only about $400 billion of notional trading hands every day. So the tail really does wag the dog. Options have a much bigger influence on the market than they used to. And that's really important in the context of visualizing how options are being traded and where those larger levels of positioning exist. And so that is why I built that tool that we have here on Bookmap. Let's take a look around some of these other areas of the market. We just got about 2 hours before the close. NASDAQ similarly seeing just a little bit of a retreat after hitting that high, consolidating some of those gains. Let's take a look at the Russell. Russell never really fully recovered. You can see it had this big drop after GDP and PCE, quarter over quarter PCE. And we had a recovery. We are above the point of control in VWAP, but we just haven't really made that convincing of a recovery off the lows versus what you're seeing in the NASDAQ and the S&P. Over here in the world of rates, we've got the 10-year note futures contract on screen. It's recovered sort of like the Russell, right? You see kind of a similar look. You had this big move down and then just sort of a tepid rebid. So if you look at these two, you can almost see the same kind of pattern. It makes sense because the Russell is objectively more rate sensitive than the NASDAQ or the S&P 500. So you're seeing a bit of that relationship. If you want to know what the Russell is going to do, watch rates, because 40% of the Russell doesn't make any money. And then another good chunk, the regionals, are very sensitive to the long end, right? So they really ends up being the most rate sensitive index, particularly with the 10-year over 4.5%. Over in the world of crude, it is getting bid up to 83 and change. We did see this rejection of this lower resting bid at 82. That marked the lows on the day. It was tested twice, and we had that strong rebid now up above $1 from those lows. And we saw that buyers were able to amass enough volume to really drag that point of control up to current pricing around 83. In the world of copper, we're also getting a bit of a rebid here as we get closer to the close of the day. And this has been a pretty choppy one. It seemed to want to get back to around 40.50.06, but having multiple times testing down there and seeing an appetite come back, now we're starting to move higher above that point of control in VWAP and closer to the intraday highs. Gold coming off of its lows. Again, that was a decent trade this morning. We talked a little bit about that as it was happening. The trend line retest, the exhaustive stop run to the downside, the rebid, and then the exhaustive stop run to the upside, setting up that opportunity to trade off a well-established trend line and then exit into buyers starting to show that.
MGIC Investment announcing additional $750 million share buyback. That's Michael Tango Golf.
Awesome. So then, we just saw a little bit of that exhaustion. That gave me cause to want to get out of that. But trading gold is not for the faint of heart, and especially trading silver isn't for the faint of heart. Silver traded earlier up as high as 27.61. This is a contract to be quite careful with. If you're not familiar with trading silver, I don't recommend it. It is called the metallic widowmaker for a reason. If you do understand how to trade these things, you know that you really want to set yourself up to not lose more than 1% on any stop out on a swing. And you'll realize that with silver, that's somewhat difficult to do unless you have a reasonably sized account or you're trading in the ETFs in small size. So again, silver is something I'm still bullish of. I just recommend caution trading it because it's violent. I mean, look at this, basically this thing had a 2% range in 30 minutes earlier from like 10 o'clock up to like 10:30, 10:40. You got to be careful about that with silver. It can get you on both sides of it. So I'm still bullish of the stuff, but I'm putting that cautionary note out there because I'm realistic in how I trade. I set my expectations for folks that watch me and how I approach the market very, very conservatively because I want your survival rate to be higher. A lot of people blow themselves up doing things impulsively, taking on too much size, trading too much. I'm the opposite. I come to the market with a degree of caution. I don't take every trade I see. I try to be much more careful about execution, specifically in an environment like this. And so, I'm happy to get like 3 to 5 trades off in a day if I'm aggressively intraday trading and walk away. And I'm happy to have a swing portfolio of maybe 15 or 20 stocks, maybe up to 30 if things are getting really crowded. And that's about it. And I'm not actively trading those super aggressively, right? Those are for, multiple week, multiple month timeframes. So, I know that some folks talk about trading every single blip, every candlestick on a 30-second chart, whatever. That's fine. If that works for you, go kill it. But for a lot of us folks that don't want to pay our brokers' kids, college tuition through our commissions or through the slippage, even if you're at a free broker, you're still paying somehow. Believe me on that, you are on that spread. Then I'm going to be a little bit more careful on that, right? I think that less is more when it comes to the sustainability of trading. Now, let's talk about the semiconductors really looking strong. They had this bid into the open, then they fell, consolidated, and then got rebid. And we see this microstructure. This is something we keep coming back to. You toss all the indicators out the window. Don't worry about the liquidity, the options, anything else. If you just want one thing to look at, just one simple thing, look at the trend structure. Okay? Higher high, higher low. Higher high, higher low. Higher high, higher low, higher high. Are we building a higher low? That's what matters. That's what tells you what's happening on any time frame. You can use this, on like a 5-minute chart, 30-minute chart, 1 hour, 4 hour, 1 day, 1 week, 1 month. You can still see those similar dynamics, albeit at varying time frames. Now, I don't mean throw out everything else, but if you're having trouble, if you're having analysis paralysis, if you just got too much going on and you don't know what to look at or how to trade, just kind of distill it to the most simple level. Are you in a definable trend? If you're in a definable trend, then you should get a better sense as to what side of the tape you want to be on. With semiconductors after 12 p.m., it made sense to be bullish. Made a couple bucks on that, right? If that changes and we see a lower low or a lower high, kind of, one after the other in sequence, then why would you want to be long anymore, right? Just look at it from that microstructure perspective, gives you another sense, something with more clarity. And if you're a visual learner, you'll probably be able to see these things very easily on charts of multiple different time frames at a glance, right? So just use what works for you. You might see other people trading. Maybe they say they're killing it. Maybe they even lie and say they never take a loss. But the reality is trading is a game of coming to terms with losses, cutting them earlier on losers, and trying to understand why winners work and staying in them as long as they work. And so you have to figure out what works for you as a trader. It's not about what works for someone else. Everyone is a bit different. And that's good. That means you have strengths that are different than someone else. And once you learn those strengths, you can lean into them. But the most important thing is impulse control, risk management, and making sure that you understand the system you're trading so you can build on it and start to become consistent. So let's go back here to the S&P 500 futures. Just seeing a little bit of consolidation after those gains. Zooming out here, you can see we had a pretty nice rippy rally coming off of those lows made just after the open. There has been steady iceberg selling into this rally. That's to say institutions have been, steadily selling, and there's been some accumulation as well. Certainly two sides of every trade, but that is interesting to take note of. We do have earnings coming up. Microsoft is expected to report at 4:05 p.m., Intel and Google at 4 p.m. Expectations are EPS of 152 for Google with revenue of 66.06 billion, Microsoft 283 EPS with revenue of 60.87 billion, and Intel EPS 13 cents with revenue of 12.7 billion. Of the three, I would say Intel looks pretty interesting just from a technical standpoint. That if it gets a bid from the bottom of its range, that looks pretty intriguing. Google, on the other hand, hit the top of its channel, reflected lower, and it is recovering from that a bit, but I still think the top of that channel could be a pretty interesting area of resistance. If we pop above it, got plenty of room to run. If we get rejected there, back to the 200-day moving average seems like a logical conclusion.
EBR, Petrobras resuming trade.
So I was asked, how is CVD still negative? Riot, I think you're here on the voice chat so you can hear me. There is much more aggressive selling here in the earlier part of the day than we see in buying. So this is more of like a seller's strike than buyers really taking aggressive control. So I think that's part of the context here. Also, options have taken a greater role in setting price discovery. So that's kind of pulling things higher without the volume transacting in futures quite as much. So I would look at it from that perspective. Let me know if that is helpful. So I've been asked about Biden's capital gains proposal for fiscal year 2025 budget, which, first of all, we didn't ever have a fiscal year 2024 budget, just so everyone knows. None was ever passed, right? So from October 1st of 2023, which began the 2024 fiscal year for the government, I know it's weird, but that's how they do it. We haven't had a budget. So this is a budget item for a budget that may not even pass during an election year. Just want to throw that out there as a big kind of caveat to all of this, right? Because there's like zero chance that this is going to pass into law, this cap gains proposal. This is all about placating to voters and trying to say, oh, we're going to get, those rich folks.
TMUS, FCC approves T-Mobile purchase of Mint Mobile. That's Tango Michael Uniform Sandy.
We're going to make them pay their fair share. I just don't see any way in the world this passes. I don't think it'll pass this Congress. I don't think it'll pass the next Congress. I don't think that there's an appetite to pay almost 50% in long-term capital gains. And I would argue that this is simply a political maneuver. It's a trial balloon, and it's attempting to get voters to be distracted away from their promises on the economy and the reality in the economy, and look at, these sort of ideas of how we can punish the
Shares of
rich.
Petrobras spiking now here. The shareholders approved. A payout of 50% of previous week withheld extra dividends. That's PBR. Shares resumed trading. Now it's $17.07. Off at Bravo Romeo. NUWE getting a pop here. November Uniform Whiskey Echo.
I'm going to take our CFR Charlie Foxtrot Romeo shares selling off new lows. No company conducting its conference call. CFR.
The Wellis low price stock up 33% now. NUWE. CFR, Cullen Frost during their conference call now going on. Share is pulling back here sharply down about $8.50. That's CFR.
NYMEX diesel May futures settle at $2.55 a gallon. NYMEX gasoline May futures settle at $2.75 a gallon. NYMEX WTI June futures settle at $83.57 a barrel. That's up 76 cents or 0.92%. And NYMEX natural gas May futures settle at $1.63.
On ticker NUWE, November Uniform Whiskey Echo, sure seeing a spike in activity, new highs, UWE.
Block trade and ticker, CCL.
Seeing some selling pressure in the S&P 500, taking it down below that most active call strike where we saw some resistance and a bit of pinning earlier. Now we're below that second most active call, that warm call where 44,000 contracts have changed hands in SPX index options. And we're starting to see some gravity potentially down here to VWAP. We can also take note that most active put strike just above, or just below, I should say, the point of control. So that most active put around 50.35 and change, and that point of control around 50.37. So watching this all play out pretty closely, we did see enough liquidity overhead that once again, supply overwhelmed demand, and that caused a bit of a retrace lower. And the NASDAQ, similar look as the S&P, tracing back down just over 80 points from those recent highs. And the Russell actually overall relatively resilient, but similarly tracing back from its highs as well.
Brent crude futures settle at $89.01 a barrel. That's up 99 cents or 1.12%.
Coming up after the close today, earnings from INTC Intel, GOOGL Google or Alphabet, MSFT Microsoft, WDC Western Digital, TMUST Mobile, SNAP Snap reporting after the close.
Noting Brent crude futures rise by more than $1 per barrel to $89.08 a barrel in post-settlement trade.
Seeing a little bit of continuation on that downside pressure here in the market. We can see that the distribution of calls has changed just a little bit here, moving higher on the second most active call strike from where it was previously. S&P futures trading at about 50, 66, 75, just above the point of control in VWAP and just below this really large level of offered liquidity where it was previously rejected. If we zoom out and look at the trajectory of the market today, we can see we had this gap down into hotter than expected PCE and weaker GDP, and then we've more than filled that entire move lower, rebidding the market back up to new intraday highs. And throughout that process, there was iceberg distribution, some degree of accumulation, especially earlier, right? You can see massive amounts of iceberging here in the sell down that happened earlier, but now just more consistent buying, not quite as much conviction behind the buyers, but sellers have not necessarily been taking advantage of this. We haven't seen any strong distribution like we saw earlier today, but we do see a higher amount of iceberg selling into this strength. So that is telling you that there is passive distribution into this rally, and that area that we saw earlier around 50.90, which is just above that most active call strike, seems to be an area of resistance where we also had a bit of an exhaustive upside stop run. That 1098 contract stop run marked the end of that move, as well as the rejection below that liquidity, which we tried to push into about twice, and now we're starting to move lower by about 20 handles from where we were. So we do have earnings coming up in just over an hour. We've got Microsoft, Google, and Intel reporting. Microsoft expected to report $2.83 of earnings, a revenue of $60.87 billion. Google expected to report $1.52 EPS and revenue of $66.06 billion. And Intel expected to report EPS of 13 cents and revenue of $12.7 billion.
S&P futures getting another pump here, 50.75.
Seeing a bit of a rebid here in S&P futures. There was some iceberg absorption there at those lows. And it looks like that was just enough to kind of scare the sellers away, because now we're being rebid back up to that most active call strike translated into ES levels from SPX. We are just less than an hour away from the close. We do get earnings from Microsoft, Intel, and Google, or Alphabet as they like to be called, after the close. Hey, Scooch, I'll take a look at MSOS in just a few. I'll be right back.
RILY, B. Riley Financial, new highs now at 33.84. Romeo India Lima Yankee.
Hi, big deal. I'm not sure what you're seeing on your screen, but the information that's coming through from Bookmap, for example, on the S&P futures contract is the June front month contract for S&P futures, and it is pretty much real time. We have ultra low latency set up on the YouTube because we have a pretty stable and fast internet connection. So these should be pretty darn accurate. There might be some latency depending on your buffer settings, but overall, this should be spot on in terms of what the actual pricing is for the front month S&P 500 futures contract, if that's what you're referring to. So I had someone ask about MSOS. I'm just going to take a look at that one real quick. I'm just pulling up a larger chart on the other screen. All right, so we're going to pull that in. This is from TradingView. And we're just looking at MSOS here. So what I'm seeing with this one is it seems to be struggling. It's inside the Ichimoku cloud, so it is without trend, and it is struggling below the point of control. So this is suggesting this is one that could be volatile. It could get kind of stuck here for a bit. If it moves much lower, you've got this decision zone here, right? This is the lowest area in the volume profile. Let's just call it around 825. That's going to be a pretty important area for this stock. If it does pull below there and find acceptance there, it's probably going to retest these lows that we saw earlier this year, right? So let's just call that around 739 where that lower closes on the candle. That's where I like to focus. And you can see there's some interaction with other areas of price around that same area as both resistance and support. On the other side of it, if it's able to push above the point of control and the cloud, then we could have a resumption of this and making a higher low, which would be a pretty constructive look for the chart. And if it can do that, if it can kind of push back above the cloud and the point of control, I don't see any reason why it couldn't try to retest this wick high, right? Just maybe around just under $11. So I think right now we're seeing this thing in a bit of a decision zone. And if it goes, below this 825 level and finds acceptance, I think 739 is a bit of a no-brainer for a downside target. If it's able to build above the cloud and the point of control, I think it's got more upside, potentially all the way up to $11. Now, the big catalyst for something like this is really going to be something like the DEA descheduling cannabis, right? If you saw something like that play out, that would be huge. That would certainly help to boost animal spirits in the entire industry. And I think that would be the thing to kind of hope for if you're looking for an upside catalyst to see that play out. But the reality is, if that does play out, you're probably not going to have a lot of time in the ETF to react, because a lot of that reaction is going to happen pretty quickly. We know how these things trade. They don't tend to be particularly liquid. So I think that would be the other side of it, is just to be kind of cognizant of, if you get what you want in terms of the catalyst, you may not necessarily have time to play it the way you would want to. So I would just kind of keep that all in the back of my mind if looking at playing MSOS. It's a great question. It's an area that's been, pretty interesting. It's certainly afforded us a relatively wide trading range. And so I think it's been an area that's worth watching and continuing to watch, particularly if we see any signs that we're going to come about on this scheduling issue. My thought is we probably get some movement on that closer to September or October. So we may kind of be trading in the chop zone for a while until. Hopefully that is helpful to you. Let me know. All right, let's take a look at the NASDAQ here as we approach a tech-heavy earnings evening. After the market, Google and Microsoft be the two most watched, but Intel coming in as well. And let's just zoom out a little bit for context. We can see the NASDAQ trading above the point of control in VWAP. So buyers certainly in control. We also got above that key pivot level of 17,450 where there's a negative delta of 834. When you see a move like that, you are putting buyers in control. You're taking sellers further and further offside, so they become motivated buyers in that environment. And we had a similar bit of a look in ES as well. If we zoom out here, we could see there was a pretty strong sell delta down here just around the hot put, a lot of additional selling pressure. The further we got away from those levels, the more offsides those sellers became. And then we also had a different level. This was a level where buyers became more aggressive around 50.45. Now, obviously, you can see when you move below that level that sellers were getting more aggressive, that buyers were getting more fearful. But as you pushed above that level, you can see that buyers were actually taking control. So that's another thing to look at as a session volume profile, get a sense as to which party is kind of at the advantage in terms of their positioning and whether they're in or out of the money. And we can assume, based on this sort of naive look, assuming these are all bought to open, that this is a situation where buyers are very much in control and in favor, and sellers are more and more offsides if they haven't covered yet. All right, so I had a great question here, and they asked, just to make sure if I understand correctly, if core PCE was to come in hot tomorrow, would that potentially push back the first Fed rate cuts and be risk off for equities? I think this is a great question because, I would have answered it differently earlier today where price action was versus where we are now. Earlier today, when we had the sell down and we were closer to S&P 5,000 at cash, I would have said, maybe it's more priced in because we see that more negative reaction to quarter over quarter PCE. And so that, and we saw that negative reaction in rates and we saw it in risk. But we've come off of a lot of that negative reaction, particularly in the NASDAQ and S&P. So I'd say that now it's going to depend a lot on skew. Like how well hedged is this market going into tomorrow's print? So looking at dollar sign skew on stock charts tomorrow or even tonight is going to be helpful, after we get the refresh data to get a sense as to how well hedged we're into that print. But I'm going to say, just based on everything we're seeing so far today, that I don't think that it's necessarily priced in. So my thought is if we get a hotter than expected core reading, month over month in particular, that could, and for me, hotter than expected month over month's got to be pretty big. And so, I would say maybe 0.37, 0.39, something like that, that's coming in materially hotter than expected, which would annualize to an unacceptably high rate. I think that would scare the market a bit. It would probably draw the 10-year note, well above 4.7%. It would probably push S&P below 5,000 on cash at the index. So I don't think we're necessarily out of the woods with that. I don't know that that's my baseline expectation for core going in month over month for tomorrow, but I do think it is a risk we need to be cognizant of. The other side of it, I would say, is, earnings are still a risk in Microsoft and Google, to both sides, both upside and downside risks in a less liquid market. This could really push the NASDAQ around. These are two of the biggest components. And then you have Intel adding to that as well. So my overall thought would be, in terms of the rate cuts, Fed swaps are already no longer really pricing in a cut this year. So that's kind of, I would say, less certain at this juncture based on the current outlook. And I think that if we get more confirmation from that tomorrow with month over month core PCE, that will probably completely price out the possibility of a rate cut this year. That doesn't mean we won't get one. It just means that's where the expectations are at that time. And, obviously, if we get softer inflation and economic data in the months subsequent, that could cause some reconsideration there. We see S&P futures pushing above that hot call strike into that large level of offered liquidity above. Let's see how this goes here. We'll just zoom in a little bit to this microstructure. Yeah, you're welcome. Always happy to look at these. So on YouTube, Adam asks, would ES not push
NVDA,
into...
NVIDIA at the highs of the day now, like 32.50, November Victor Delta Alpha.
And that was an area we've been watching as well. NVIDIA 830 strikes pretty active, just pushing above
stop
there,
alert by 1020.
Nevertheless, I was asked, this area above us, which the S&P is starting to chew through now, what do I expect the reaction to be? I look at this as the auction, really a bit of a inflection point, right? We have a large amount of supply. Can buyers take us above that supply with some degree of conviction? If they can, that's great. That's telling us that, buyers have control and they're likely to take prices even higher. If they can't, then that's where I would get a little concerned, because often is the case that you reflect meaningfully lower if you get rejected. So the context of this liquidity isn't so much that it's predictive as it's a inflection point for the market. When it's that much up there, you've really got to test the buyer's ability to push liquidity through that, to show sufficient demand. So let me know if that's helpful.
Stop alert by 1001.
CBS 60 Minutes earlier in a tweet mentioning that NVIDIA will be a segment on Sunday on 60 Minutes NVDA.
Ticker Tesla, TSLA. Not sure seeing an increase of activity, new highs for Tesla.
This is starting to look a little bit more like what I call a death cloud overhead with the amount of liquidity that's looming just above price. So it's going to be pretty important for buyers to try to take price above here in the near term. Otherwise, we do have a higher chance of price kind of running away and reversing to the downside.
Yes, stop alert. By 1003.
So once again, we have this really large area of offered liquidity above us on S&P, just starting around 50.91 and going all the way up through 50.94. Buyers need to try to take price through this large area of offered liquidity, or as often is the case, we kind of get pulled lower here as they're showing they don't have enough demand to overtake that supply. So let's see how this plays out. We've got just about 30 minutes left in the trading day, and then we'll be getting right into big tech earnings with Google, Microsoft, and Intel reporting after the bell. And these will be pretty important to get a sense as to what we can potentially expect next week as well. seeing some signs we're getting rejected here from this death cloud that we were talking about, that large area of offered liquidity above price. So far, buyers not able to show any real conviction, and we're starting to see signs of reversing lower as we head into the close with just about 27 minutes left in the trading day. And so far, it's starting to really look like that death cloud rejection. Again, we had that large area of offered liquidity. As soon as I noticed it, I remarked this could be a death cloud. Now that we're moving lower and lower from that level, just about 6 handles below, I'd say we could probably confirm that is the case. Buyers did not have the demand to take us through that large area of offered supply, and so the path of least resistance for now is lower. But I would also add the caveat, this is the last half hour of trading. It tends to be the most volatile period of time. And we're coming up to 3 big earnings with Microsoft, Google, and Intel. So be careful with position size into this last hour or last half hour and the next half hour after that with these earnings releases, because anything can happen.
Let's take a Paramount PARH. There's seen a spike in activity. CNBC reports Paramount Skydance inch closer to a merger as key hurdle looms. There's a Paramount continuing to sell off.
Block trade in ticker, HCP.
More color on Paramount. CNBC reports Skydance and its private equity backers are targeting May to finalize terms in a deal with Paramount.
Shares of Paramount Global selling off as CNBC reporting that Paramount and Skydance inch closer to a merger as key hurdle looms. That's PARA, Paramount.
Seeing
Paramount
seeing
shares
some,
hitting a low of $12.22, down 38 cents, PARA.
Seeing some continuation of that death cloud theme that we talked about a little bit earlier, that move lower based on rejecting that large offered area above. We're now about 10 handles below the area we were. We were just below that death cloud. So it just kind of shows when you have a really large offer, it's an inflection point. It tends to get buyers more interested in trying to either prove themselves or running away from that area. And today, well, they didn't have the conviction, so they ran away.
ISEN board approved rescission of previously announced reverse stock split. That's India Sandy Uniform November. ISUN. Shares of iSun spiking here on volume penny stock. Company rescinding its reverse stock split news or decision. EALK,
Total money market
Talkspace,
fund assets rose by
June $3 calls
$9.13
trading.
billion to
Tango Alpha Lima
$5.98
Kilo.
trillion for the week ended April 24th.
That ticker Paramount headline now hitting Reuters.
CNBC report says Skydance's plan would name David Ellison CEO of Paramount Global and former Universal CEO Jeff Shell as president. That's PARA. Shares off the lows now, $12.34. Coming up right at the close, earnings from INTC. Intel expecting 14 cents. Google or Alphabet expecting $1.51 GOOGL. Microsoft coming up at about 4:05 p.m. expecting $2.82.
Market on close imbalance, 320 million to the sell side.
So keep in mind now, in 10 minutes' time at the cash equity close today, top of the hour, do you see earnings season continue? Alphabet printing Q1 2024 earnings, estimated EPS of $1.53, estimated revenue $66.1 billion. Same time, Intel are due to print their Q1 earnings too, estimated EPS of 13 cents and an estimated revenue of $12.7 billion.
Block trading ticker, UBER.
Just about 5 minutes away from the closing bell here as we approach Google and Intel earnings, which are expected just after the close, and then Microsoft at 4:05 p.m.
I know ticker Zoom ZM. Sure, seeing a bump in activity on Circulations USC has canceled their main commencement ceremony. This comes after protests.
So seeing reports that the US and allies want to cut chip-related China exports amid Huawei alarm. So this is the Financial Times reporting. US is pushing allies in Europe and Asia to tighten restrictions on exports of chips, chip-related technology and tools to China amid rising concerns about Huawei's development of advanced semiconductors. And so we're just less than 5 minutes away now to the top of the hour. Cash equity close and earnings from Alphabet and Intel. Alphabet are printing Q1 2024. Estimated EPS is seen at $1.53, with an estimated revenue of $66.1 billion. Intel also printing Q1 earnings, estimated EPS of 13 cents, and an estimated revenue of $12.7 billion. Slated to print after this at 4:05 p.m. Eastern Time is Microsoft. They're printing Q3 2024 earnings with an estimated EPS of $2.83 and an estimated revenue of $60.9 billion.
All right, folks, we are just minutes away
Block
from the
trade and
closing
ticker,
bell.
HCP.
Really just about a minute and a half. And we had that death cloud play out, brought us down, about 20 handles almost from the highs prior, maybe about 17 handles. So it worked out just fine. That's what happens. You have that really large area of offered liquidity, you get that rejection.
Coming up on 1 minute to the U.S. market close. Coming up right after the close, earnings from GOOGL, Google, INTC, Intel.
So we're shortly expecting earnings prints from Alphabet
Microsoft
and Intel. Again, this is due
4:06.
to post at the top of the hour, keeping our eyes peeled any time from now. And do remember after this as well, about 5 minutes past the top, Microsoft are due to print as well.
All right, folks. So we do have Microsoft and Google, all that on screen. So what I'm going to do is I'll rotate between them as we get earnings and as we're watching these, and I'll just drag them a little bit closer to each other so we can go between them pretty easily. And for Intel, I just need to spend just a moment here cleaning up this chart. So just bear with me as I get rid of some of all these notations. I just want to make it simple, straightforward to read for everyone watching. All right, so we've got all that on screen. We'll just...
Iceberg ESM for CME buy at 5,081.25 crossed 500.
We will focus on Google here because Google is going to be the one that's coming out after hours, right after the close.
There are no signs
according to
of
their
earning
scheduling.
prints yet.
ES Iceberg Alert by 1023.
MSFT, Microsoft is out. Microsoft reporting $2.94. The estimate was $2.82 for Michael Sandy Foxtrot Tango. Revenue of $61.9 billion. The estimate was $60.77 billion. So that's a beat for Microsoft. Michael
Seeing
Sandy
Intel earnings come
Foxtrot
across now,
Tango.
the revenue is a beat slightly.
Intel reporting
12.72 billion on estimate.
12.72 billion. The estimate was 12.78 billion in revenue, a loss of 9 cents for Intel. That may not compare with the 14-cent estimate. 18 cents adjusted on Intel. So that's a beat for Intel, INTC on earnings. TMUS, T-Mobile is out. T-Mobile reporting $2. The estimate on T-Mobile was $1.95. That's a beat for TMUS. Tango Michael Uniform Sandy, revenue of $19.59 billion. The estimate was $20.03 billion, so that's short on revenue for TMUS. Intel sees a loss of 5 cents for Q2. GOOGL, Google reporting $1.89. The estimate was $1.51 for GOOGL, Google or Alphabet.
See shares of Microsoft bid higher, just about $20 after
ES
hours
Stop
here.
Alert by 1050.
We do see a positive reaction in S&P futures here as well.
Alphabet authorized company to buy back up to an additional $70 billion in shares. That's GOOGL. Shares of Alphabet spiking sharply now, $172.82, up almost $27 at, correction, up almost $17 at the high for Alphabet. Shares of Intel selling off here, 33.14 the low, down about $2 at the lows after hours for Intel. Shares of Microsoft at 422.88, spiking up about $22 now. MSFT. BYD, Boyd Gaming reporting. Boyd Gaming reporting $1.51 Bravo Yankee Delta. The estimate on Boyd Gaming was $1.57. That's short for BYD, Bravo Yankee Delta. Western Digital, WDC, reporting 63 cents. The estimate was 13 cents. Revenue of $3.46 billion is a beat. The estimate 3.32 billion. So that's a beat for WDC. VRSN, VeriSign, reported $1.92. The estimate was $1.86. That's a beat for VRSN. ROKU, Roku reporting revenue of $882 million. That's a beat for Roku.
Block trade in ticker, PINS. Block trade in ticker, PINS.
SKS, Skechers reported $1.33 GAAP earnings. The estimate $1.10. That's a beat. Sales coming in ahead at $2.251 billion. Also a beat for Sandy Kilo X-Ray. ROKU, Roku, reported a loss of 35 cents, better than the 62-cent loss that was expected for Romeo Oscar Kilo uniform. EEAM Atlassian reported 89 cents. The estimate was 62 cents, so that's a beat. Revenue of 1.19 billion for Atlassian. That's a beat for TEAM, Tango Echo Alpha Michael. FIX Comfort Systems reported $2.69. The estimate $2.01 for Foxtrot India X-Ray. LHX, L3 Harris. $3.06. The estimate was $2.90. That's a beat for LHX, Lima Hotel X-Ray. Revenue of $5.211 billion is a beat for Lima Hotel X-Ray LHX. SNAP, Snap reporting a loss of 19 cents. Adjusted earnings of 3 cents versus a loss of 5 cents expected for SNAP. So that's a beat for Snap. Shares of Snap popping on that news, up about $2. That's SNAP continuing to pop here now. $14.20 the high on Snap on that earnings beat, SNAP. PEX Terex reported 1.3 billion in revenue. The estimate was 1.235 billion for Tango Echo X-ray. Earnings of $1.60 for TEX. The estimate was $1.35. Google or Alphabet shares continuing to pop here, up about $23 at the high, following their report, GOOGL. 179.25 the high now on Golf Oscar Golf Lima.
Pretty large area offered there just above at 179 on Google as well. That's probably going to be an important area potential
Shares of
after-hours
Amazon
resistance.
moving along with other companies, along with the companies that are reporting today. Google, Microsoft, Amazon shares popping here, 181.79 at the high right now, up about $6.50 on AMZN. KLAC, KLA 10 core reporting. KLAC reporting $5.26. The estimate was $5.08. That's a beat for KLAC. Revenue $2.36 billion is a beat. The estimate was $2.31 billion for Kilo Lima Alpha Charlie. SSNC reporting $1.28. The estimate was $1.21. That's a beat. Revenue $1.44 billion is a beat for Sandy, November Charlie, SSNC. JMPR, Juniper Networks. Juniper reporting
PS Iceberg
$0.29.
alert. Buy 1001.
The estimate on Juniper was 40 cents. So that's a miss for Juniper Networks. Revenue of 1.15 billion is short of the 1.24 billion estimate for JMPR. EW, Edwards Life Sciences. Edwards reporting 66 cents. The estimate on Edwards was 64 cents, so that's a beat for EW, Edwards Life Sciences. Sales of $1.6 billion is a beat. The estimate 1.58 billion for Echo Whiskey. EMN, Eastman Chemical, selected by U.S. Department of Energy to get up to $375 million investment for a second U.S. molecular recycling project in Longview, Texas. That's Echo Michael November. WKC World Connect reported revenue of 10.951 billion. That's short of the 11.753 billion estimate. Earnings of 47 cents, short of the 49-cent estimate for World Connect. So that's a miss for WKC, Whiskey Kilo Charlie.
Taking a look at the market wrap for today's session, Wall Street was shaken by data that revealed exactly what investors did not want to hear: a sharp slowdown in the world's largest economy and persistent inflationary pressures. Treasuries fell, with yields reaching new 2024 highs as economic data revived the stagflation debate, adding uncertainty to the path of the
MHK,
Federal
Mohawk
Reserve policy.
Industries reported
Swap traders
$1.86.
pushed back
That's a
the
beat.
first rate cut to December.
Sales coming in ahead
Equities
at
also struggled,
2.679
but
billion.
recovered
That's Michael
most of their
Hotel
losses
Kilo.
thanks to a rally in two heavyweights, Nvidia and Tesla. Their rally counteracted a post-earnings drop in fellow megacap Meta platforms. The latest economic data ended a period of strong demand and low price pressures, which had fueled hopes for a soft landing. Gross domestic product rose at an annualized rate of 1.6%, falling short of all expectations. A closely watched measure of underlying inflation increased at a faster than expected 3.7% rate. The S&P 500 fell to around 5,050, erasing this week's gains. Meanwhile, 10-year yields increased 6 basis points to 4.7%. A $44 billion offering of 7-year notes was sold roughly in line with expectations.
for Foxtrot Echo.
So pretty outstanding positive reaction to the earnings that we got from Google and from Microsoft. Not so much Intel. Snapchat also surprising to the upside. One of the first times in memory where Snapchat really gapped higher meaningfully on earnings. We'll see what the conference call brings, but so far the shares are trading up.
EIG, Employers Holdings, reporting 67 cents. The estimate was 71 cents, Echo India Golf. So that's a miss.
Snapchat bid up 27.27% to 14.51 after hours.
ARR, Armor Residential REIT, reported 24 cents. The estimate was $1.04. That may not compare for ARR. COF, Capital One Financial, reported $3.21. The estimate was $3.31. So that's a miss. Sales coming in ahead at 9.4 billion.
Yeah,
Charlie
sir.
Oscar Foxtrot. FIX, Comfort Systems, raised its quarterly dividend to 30 cents plus 5 cents from the previous, that's Foxtrot India X-Ray.
So we will be carrying the Google and then Microsoft earnings calls back to back. That Google call set to start momentarily here in just about 5 minutes. So we'll be live streaming that and then hopping off there after it wraps up in about an hour, going right to the Microsoft call, which starts right then at about 5:30 p.m. Eastern. So stay tuned. We'll be carrying everything here. This is just covering the earnings reaction and then some analysis after the calls about what we're seeing from these companies. Certainly a big difference versus what we saw from Meta yesterday. These results being appreciated by the markets, particularly Google bid up almost 13% after hours, a big move to new all-time highs for that stock.
Fed discount window loans $7.02 billion in the week ended April 24th after $8.56 billion. And Fed bank term funding loans $125.5 billion in the week ended April 24th after $125.7 billion.
Over to Sundar.
Thank you, Jim, and hello, everyone. It was a great quarter led by strong performance from search, YouTube, and cloud. Today, I want to share how we are thinking about the business and the opportunity more broadly. Of course, that's heavily focused on AI and search. Then I'll take you through some highlights from the quarter in cloud, YouTube, and beyond. Let's discuss our momentum and strategy. Taking a step back, it took Google more than 15 years to reach $100 billion in annual revenue. In just the last 6 years, we've gone from $100 billion to more than $300 billion in annual revenue. Of course, search continues to power that, as you see in our Q1 results. But in addition, we expect YouTube overall and cloud to exit 2024 at a combined annual run rate of over $100 billion. This shows our track record of investing in and building successful new growing businesses. Now, let's look at how well we are positioned for the next wave of AI innovation and the opportunity ahead. There are 6 points to make. 1, research leadership. 2, infrastructure leadership. 3, innovation in search. 4, our global product footprint. 5, velocity in execution. 6, monetization paths. First, our foundation of research leadership. We've been an AI-first company since 2016, pioneering many of the modern breakthroughs that power AI progress for us and for the industry. Last week, we further consolidated teams that build AI models under Google DeepMind. This will help simplify development and establish a single access point for our product teams as they build generative AI applications with these models. The teams are making rapid progress developing Gemini and other models. In February, we rolled out Gemini 1.5 Pro, which shows dramatic performance enhancements across a number of dimensions. It includes a breakthrough in long context understanding, achieving the longest context window of any large-scale foundation model yet. Combining this with Gemini's native multimodal understanding across audio, video, text, code, and more, it's highly capable. We are already seeing developers and enterprise customers enthusiastically embrace Gemini 1.5 and use it for a wide range of things. Beyond Gemini, we have built other useful models, including our Gemma Open models, as well as image and visual models and others. Second, infrastructure leadership. We have the best infrastructure for the AI era. Building world-leading infrastructure is in our DNA, starting in our earliest days when we had to design purpose-built hardware to power search. Our data centers are some of the most high-performing, secure, reliable, and efficient in the world. They've been purpose-built for training cutting-edge AI models and designed to achieve unprecedented improvements in efficiency. We have developed new AI models and algorithms that are more than 100 times more efficient than they were 18 months ago. Our custom TPUs, now in their 5th generation, are powering the next generation of ambitious AI projects. Gemini was trained on and is served using TPUs. We are committed to making the investments required to keep us at the leading edge in technical infrastructure. You can see that from the increases in our capital expenditures. This will fuel growth in cloud, help us push the frontiers of AI models, and enable innovation across our services, especially in search. AI innovations in search are the third and perhaps the most important point I want to make. We have been through technology shifts before, to the web, to mobile, and even to voice technology. Each shift expanded what people can do with search and led to new growth. We are seeing a similar shift happening now with generative AI. For nearly a year, we've been experimenting with SGE in search labs across a wide range of queries. And now we are starting to bring AI overviews to the main search results page. We are being measured in how we do this, focusing on areas where GenAI can improve the search experience while also prioritizing traffic to websites and merchants. We have already served billions of queries with our generative AI features. It's enabling people to access new information, to ask questions in new ways, and to ask more complex questions. Most notably, based on our testing, we are encouraged that we are seeing an increase in search usage among people who use the new AI overviews, as well as increased user satisfaction with the results. And with Circle to Search, people can now circle what they see on their Android screens, ask a question about an image or object in a video, and get an AI overview with Lens. Fourth, our global product footprint beyond search. We have 6 products with more than 2 billion monthly users, including 3 billion Android devices. 15 products have 500 million users, and we operate across 100+ countries. This gives us a lot of opportunities to bring helpful GenAI features and multimodal capabilities to people everywhere and improve their experiences. We have brought many new AI features to Pixel, Photos, Chrome, Messages, and more. We are also pleased with the progress we are seeing with Gemini and Gemini Advanced through the Gemini app on Android and the Google app on iOS. Fifth, improved velocity and execution. We've been really focused on simplifying our structures to help us move faster. In addition to bringing together our model building teams under Google DeepMind, we recently unified our ML infrastructure and ML developer teams to enable faster decisions, smarter compute allocation, and a better customer experience. Earlier this year, we brought our search teams together under one leader. And last week, we took another step, bringing together our platforms and devices teams. The new combined team will focus on delivering high-quality products and experiences, bolstering the Android and Chrome ecosystems, and bringing our best innovations to partners faster. We also remain focused on long-term efforts to durably re-engineer our cost base. You can see the impact of this work reflected in our operating margin improvement. We continue to manage our headcount growth and align teams with our highest priority areas. This speeds up decision-making, reduces layers, and enables us to invest in the right areas. Beyond our teams, we are very focused on our cost structures, procurement, and efficiency. And a number of technical breakthroughs are enhancing machine speed and efficiency, including the new family of Gemini models and a new generation of TPUs. For example, since introducing SGE about a year ago, Machine costs associated with SGE responses have decreased 80% from when first introduced in labs, driven by hardware, engineering, and technical breakthroughs. We remain committed to all of this work. Finally, our monetization path. We have clear paths to AI monetization through ads and cloud, as well as subscriptions. Philip will talk more about new AI features that are helping advertisers, including bringing Gemini models into Performance Max. Our cloud business continues to grow as we bring the best of Google AI to enterprise customers and organizations around the world. And Google One now has crossed 100 million paid subscribers, and in Q1, we introduced a new AI premium plan with Gemini Advanced. Okay, those are the 6 points. So now let me turn to quarterly highlights from cloud and YouTube in a bit more detail. In cloud, we have announced more than 1,000 new products and features over the past 8 months. At Google Cloud Next, more than 300 customers and partners spoke about their generative AI successes with Google Cloud, including global brands like Bayer, Cintas, Mercedes-Benz, Walmart, and many more. Our differentiation in cloud begins with our AI hypercomputer, which provides efficient and cost-effective infrastructure to train and serve models. Today, more than 60% of funded GenAI startups and nearly 90% of GenAI unicorns are Google Cloud customers. And customers like PayPal and Kakao Brain are choosing our infrastructure. We offer an industry-leading portfolio of NVIDIA GPUs along with our TPUs. This includes TPU v5p, which is now generally available, and NVIDIA's latest generation of Blackwell GPUs. We also announced Axion, our new Google design and ARM-based CPU. In benchmark testing, it has performed up to 50% better than comparable x86-based systems. On top of our infrastructure, we offer more than 130 models, including our own models, open source models, and third-party models. We made Gemini 1.5 Pro available to customers, as well as Imagen 2.0 at Cloud Next. And we shared that more than 1 million developers are now using our generative AI across tools, including AI Studio and Vertex AI. We spoke about how customers like Bristol-Myers Squibb and Etsy can quickly and easily build agents and connect them to their existing systems. For example, Discover Financial has begun deploying GenAI-driven tools to its nearly 10,000 call center agents to achieve faster resolution times for customers. Customers can also now ground their GenAI with Google Search and their own data from their enterprise databases and applications. In Workspace, we announced that organizations like Uber, Pepperdine University, and PennyMac are using Gemini in Google Workspace, our AI-powered agent that's built right into Gmail, Docs, Sheets, and more. We also announced Google Vids, a new application to create stories in short video format. And we introduced Gemini for meetings and messaging, and Gemini Security for Workspace. Customers are choosing Workspace because they have deep trust in our powerful security and privacy features. Our cloud business is now widely seen as the leader in cybersecurity. I saw this firsthand when I went to the Munich Security Conference in February. Cybersecurity analysts are using Gemini to help spot threats, summarize intelligence, and take action against attacks, helping companies like American Family Insurance aggregate and analyze security data in seconds instead of days. Turning next to YouTube, which continues to grow and lead in streaming. We announced that on average, viewers are watching over 1 billion hours of YouTube content on TVs daily. AI experiments like Dream Screen will give anyone the ability to make AI-generated backgrounds for YouTube Shorts. And on subscriptions, which are increasingly important for YouTube, we announced that in Q1, YouTube surpassed 100 million music and premium subscribers globally, including trialers. And YouTube TV now has more than 8 million paid subscribers. Finally, in other bets, Waymo's fully autonomous service continues to grow ridership in San Francisco and Phoenix with high customer satisfaction, and we started offering paid rides in Los Angeles and testing rider-only trips in Austin. Overall, it was a great quarter, and there's more to come. I/O is in less than 3 weeks, followed by Brandcast and Google Marketing Live. I want to thank our employees around the world who are at the heart of this progress and who continue to focus on building innovative products, helpful services, and new opportunities for businesses and partners around the world. Thank you. Philip.
Thanks, Sundar, and hi, everyone. Google Services revenue of $70 billion were up 14% year-on-year. Search and other revenues grew 14% year-on-year, led again by solid growth in the retail vertical, with particular strength from APAC-based retailers, which began in the second quarter of 2023. YouTube ads revenues were up 21% year-on-year, driven by growth in both direct response and brand. Network revenues declined 1% year-on-year. In subscriptions, platforms, and devices, year-on-year revenues increased 18%, driven again by strong growth in YouTube subscriptions. Let's now talk about a few highlights from the quarter from a product innovation and advertising performance perspective. First, it bears repeating that AI innovation across our ads ecosystem is core to every aspect of our product portfolio, from targeting, bidding, creative, measurement, and across campaign types. We've talked about how solutions like smart bidding use AI to predict future ad conversions and their value helping businesses stay agile and responsive to rapid shifts in demand. And how products like Broad Match leverage LLMs to match ads to relevant searches and help advertisers respond to what millions of people are searching for. This is foundational. As advances accelerate in our underlying AI models, our ability to help businesses find users at speed and scale and drive ROI just keeps getting better. We're especially excited about the doors GenAI is opening for creative capabilities, helping deliver on the premise of getting the right ad to the right user in the right moment. Look at Performance Max. In February, we rolled Gemini into PMax. It's helping curate and generate text and image assets so businesses can meet PMax asset requirements instantly. This is available to all US advertisers and starting to roll out internationally in English, and early results are encouraging. Advertisers using PMax asset generation are 63% more likely to publish a campaign with good or excellent ad strength. And those who improve their PMax ad strength to excellent see 6% more conversions on average. We're also driving improved results for businesses opting into automatically created assets, which are supercharged with GenAI. Those adopting ACA see on average 5% more conversions at a similar cost per conversion in Search and Performance Max campaigns. And then there's Demand Gen. Advertisers are loving its ability to engage new and existing customers and drive purchase consideration across our most immersive and visual touchpoints like YouTube, Shorts, Gmail, and Discover. Hollywood film and TV studio Lionsgate partnered with Horizon Media to test what campaign type would deliver the most ticketing page views for its The Hunger Games, Ballad of Songbirds and Snakes film. Over a 3-week test, Demand Gen was significantly more efficient versus social benchmarks, with an 85% more efficient CPC and 96% more efficient cost per page view. Lionsgate has since rolled out Demand Gen for 2 new titles. We're also bringing new creative features to Demand Gen. Earlier this month, we announced new generative image tools to help advertisers create high-quality assets in a few steps with a few simple prompts. This will be a win for up-leveling visual storytelling and testing creative concepts more efficiently. And then there's obviously Search Generative Experience, which Sundar talked about. I'll add that innovation in the user experience on Search has historically opened up new opportunities for advertisers. We saw this when we successfully navigated from desktop to mobile. We're continuing to experiment with new ad formats, including search and shopping ads alongside search results in SGE. And we shared in March how folks are finding ads either above or below the SGE results helpful. We're excited to have a solid baseline to keep innovating on and confident in the role SGE, including ads, will play in delighting users and expanding opportunities to meet user needs. Which brings me to Search and our strong performance in the first quarter. In Q1, retail was again a top contributor. Our focus remains on driving profitability and growth for retailers, helping them optimize digital performance for both online and offline, as well as innovate across our shopping and merchant experiences. Highlights include continued upsides for retailers, leading into agile budget and bidding strategies across Search, PMax, or both. Take-home goods retailer IKEA, who leaned into Google's store sales measurement to understand its total omni-channel revenue opportunity across Search. By measuring 2.3 times more revenue and using value-based bidding solutions to bid to its omni-channel customers, IKEA drove a significant increase in omni revenue in Q1 and is now scaling this strategy globally. We also expanded local inventory ads into 23 countries, helping drive shopper confidence and offline sales. Retailers can convert intent into action by showcasing in-store availability, pricing, pickup options, and more, all in one ad format. Moving to YouTube. Last quarter, I went deep into our strategy. It all starts with creation, which drives viewership, which leads to monetization. A few updates to build on Sundar's remarks. First, creation, which is all about giving creators the tools to create amazing content, grow their audiences, and build their businesses. In 2023, more people created content on YouTube than ever before, and the number of channels uploading shorts year on year grew 50%. We also hit a new milestone with 3 million plus channels in our YouTube Partner Program. We recently shared that YPP has paid out more than any other creator monetization platform, including over $70 billion to creators, artists, and media companies over the last 3 years. From a viewer's perspective, watch time across YouTube continues to grow, with strength in both Shorts and CTV. According to Nielsen, YouTube has been the leader in US streaming watch time for the last 12 plus months. In the first quarter, Living Room benefited from a combination of strong watch time growth, innovation in the user and advertiser experience, and a shift in brand advertising budgets from linear TV to YouTube. Viewers are watching YouTube because they expect to access everything in one place, across screens and formats, their favorite creators, live sports, breaking news, educational content, movies, music, and more. And advertisers continue to lean in to find audiences they can't find elsewhere. Which brings me to monetization. We're pleased with our Q1 performance across both our ad-supported and subscription offerings. Sundar covered subscription growth. On the ads front, direct and brand were both strong this quarter. Shorts monetization continued to improve, with Shorts ads now supported on mobile, tablet, living room, and desktop, and available to both performance and brand advertisers. In the US, the monetization rate of Shorts relative to in-stream viewing has more than doubled in the past 12 months, including a 10-point sequential improvement in the first quarter alone. Just last week, we introduced new ways for brands to get the most out of their Shorts ads with new lineups on YouTube Select, including sports, beauty, fashion and lifestyle, and entertainment. For YouTube advertisers, increasing brand lift is one of the core goals. In Q1, we saw strong traction from the introduction of a pause ads pilot on connected TVs, a new, non-interruptive ad format that appears when users pause their organic content. Initial results show that pause ads are driving strong brand lift results and are commanding premium pricing from advertisers. Before I wrap, 2 quick highlights on how we're helping our partners transform and accelerate impact with the best across Google. Number 1, to help McDonald's build the restaurant of the future, we're deepening our partnership across cloud and ads. Part of this includes them connecting Google Cloud's latest hardware and data technologies across restaurants globally and starting to apply GenAI to enhance its customer and employee experiences. Number 2, WPP. At Google Cloud Next, we announced a new collaboration that will redefine marketing through the integration of our Gemini models with WPP Open, WPP's AI-powered marketing operating system already used by more than 35,000 of its people and adopted by key clients including the Coca-Cola Company, L'Oreal, and Nestle. We're just getting started here and excited about the innovation this partnership will unlock. With that, a huge thank you to our customers and partners, many of whom we're excited to see at Google Marketing Live and Brandcast in just a few weeks. And a huge thank you, as always, to our incredible teams for their agility and hard work this quarter. Ruth, you're up.
Thank you, Philip. We are very pleased with our financial results for the first quarter, driven in particular by strength in search and cloud, as well as the ongoing efforts to durably re-engineer our cost base. My comments will be on year-over-year comparisons for the first quarter unless I state otherwise. I will start with results at the Alphabet level, followed by segment results, and conclude with our outlook. For the first quarter, our consolidated revenues were $80.5 billion, up 15% or up 16% in constant currency. Search remained the largest contributor to revenue growth. In terms of total expenses, the year-on-year comparisons reflect the impact of the restructuring charges we took in the first quarter of 2023 of $2.6 billion, as well as the $716 million in employee severance and related charges in the first quarter of 2024. As you can see in our earnings release, these charges were allocated across the expense lines in other cost of revenues and OPEX based on associated headcount. To help with year-on-year comparisons, we included a table in our earnings release to adjust other cost of revenues, operating expenses, operating income, and operating margin to exclude the impact of severance and related office space charges in the first quarter of 2023 versus 2024. In terms of expenses, total cost of revenues was $33.7 billion, up 10%. Other cost of revenues was $20.8 billion, up 10% on a reported basis, with the increase driven primarily by content acquisition costs associated with YouTube, given the very strong revenue growth in both subscription offerings and ad-supported content. On an adjusted basis, other cost of revenues were up 13% year-on-year. Operating expenses were $21.4 billion, down 2% on a reported basis, primarily reflecting expense decreases in sales and marketing and G&A, offset by an increase in R&D. The largest single factor in the year-on-year decline in G&A expenses was lower charges related to legal matters. On an adjusted basis, operating expenses were up 5%, reflecting first in R&D an increase in compensation expense primarily for Google DeepMind and Cloud, and second in sales and marketing a slight increase year-on-year, reflecting increases in compensation expense primarily for cloud sales. Operating income was $25.5 billion, up 46% on a reported basis, and our operating margin was 32%. On an adjusted basis, operating income was up 31%, and our operating margin was 33%. Net income was $23.7 billion, and EPS was $1.89. We delivered free cash flow of $16.8 billion in the first quarter and $69.1 billion for the trailing 12 months. We ended the quarter with $108 billion in cash and marketable securities. Turning to segment results. Within Google Services, revenues were $70.4 billion, up 14%. Google Search and other advertising revenues of $46.2 billion in the quarter were up 14%, led again by growth in retail. YouTube advertising revenues of $8.1 billion were up 21%, driven by both direct response and brand advertising. Network advertising revenues of $7.4 billion were down 1%. Subscriptions, platforms, and devices revenues were $8.7 billion, up 18%, primarily reflecting growth in YouTube subscription revenues. TAC was $12.9 billion, up 10%. Google Services operating income was $27.9 billion, up 28%, and the operating margin was 40%. Turning to the Google Cloud segment, revenues were $9.6 billion for the quarter, up 28%, reflecting significant growth in GCP with an increasing contribution from AI and strong Google Workspace growth, primarily driven by increases in average revenue per seat. Google Cloud delivered operating income of $900 million and an operating margin of 9%. As to our other bets for the first quarter, revenues were $495 million, benefiting from a milestone payment in one of the other bets. The operating loss was $1 billion. Turning to our outlook for the business, with respect to Google Services, first within advertising, we are very pleased with the momentum of our ads businesses. Search had broad-based strength across verticals. In YouTube, we had acceleration in revenue growth driven by brand and direct response. Looking ahead, 2 points to call out. First, results in our advertising business in Q1 continued to reflect strength in spend from APAC-based retailers, a trend that began in the second quarter of 2023 and continued through Q1, which means we will begin lapping that impact in the second quarter. Second, the YouTube acceleration in revenue growth in Q1 reflects, in part, lapping the negative year-on-year growth we experienced in the first quarter of 2023. Turning to subscriptions, platforms, and devices, we continue to deliver significant growth in our subscriptions business, which drives the majority of revenue growth in this line. The sequential quarterly decline in year-on-year revenue growth for the line in Q1 versus Q4 reflects in part the fact that we had only 1 week of Sunday ticket subscription revenue in Q1 versus 14 weeks in Q4. Looking forward, we will anniversary last year's price increase in YouTube TV starting in May. With regard to platforms, we are pleased with the performance in Play, driven by an increase in buyers. With respect to Google Cloud, performance in Q1 reflects strong demand for our GCP infrastructure and solutions, as well as the contribution from our workspace productivity tools. The growth we are seeing across cloud is underpinned by the benefit AI provides for our customers. We continue to invest aggressively while remaining focused on profitable growth. As we look ahead, 2 points that will affect sequential year-on-year revenue growth comparisons across Alphabet. First, Q1 results reflect the benefit of leap year, which contributed slightly more than 1 point to our revenue growth rate at the consolidated level in the first quarter. Second, at current spot rates, we expect a larger headwind from foreign exchange in Q2 versus Q1. Turning to margins, our efforts to durably re-engineer our cost base are reflected in a 400 basis point expansion of our Alphabet operating margin year-on-year, excluding the impact of restructuring and severance charges in both periods. You can also see the impact in the quarter-on-quarter decline in headcount in Q1, which reflects both actions we have taken over the past few months and a much slower pace of hiring. As we have discussed previously, we are continuing to invest in top engineering and technical talent, particularly in cloud, Google DeepMind, and technical infrastructure. Looking ahead, we remain focused on our efforts to moderate the pace of expense growth in order to create capacity for the increases in depreciation and expenses associated with the higher levels of investment in our technical infrastructure. We believe these efforts will enable us to deliver full year 2024 Alphabet operating margin expansion relative to 2023. With respect to CapEx, our reported CapEx in the first quarter was $12 billion, once again driven overwhelmingly by investment in our technical infrastructure, with the largest component for servers, followed by data centers. The significant year-on-year growth in CapEx in recent quarters reflects our confidence in the opportunities offered by AI across our business. Looking ahead, we expect quarterly CapEx throughout the year to be roughly at or above the Q1 level, keeping in mind that the timing of cash payments can cause variability in quarterly reported CapEx. With regard to other bets, we similarly have work streams underway to enhance overall returns. Finally, as I trust you saw in the press release, we are very pleased to be adding a quarterly dividend of 20 cents per share to our capital return program, as well as a new $70 billion authorization in share repurchases. The core of our capital allocation framework remains the same, beginning with investing aggressively in our business, as you have heard us talk about today, given the extraordinary opportunities ahead. We view the introduction of the dividend as further strengthening our overall capital return program. Thank you. Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press star 1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. And our first question comes from Brian Nowak with Morgan Stanley. Please go ahead.
Great. Thanks for taking my question. I have two. The first one, I want to ask about overall search behavior. Philip, I know you talked in the past about how overall query trends continue to grow. Can I ask you to drill a little bit more into monetizable and commercial query trends? Have there been any changes in sort of your commercial query trend growth? There's just been all these new entrants moving around in e-commerce is my first one. And the second one for Ruth, when you talked about sort of more efforts to moderate expense growth from here, can you just sort of give us some examples of areas where you still see the potential for more optimization or work streams in place to continue to durably re-engineer the OpEx space as we go throughout 2024? Thanks.
Thanks, Brian. To your first question, look, I think broadly, we've always found that over many years when things work well on the organic side, monetization follows. So typically, the trends we see carry over well. Overall, I think with generative AI in search, with our AI overviews, we are definitely, I think we will expand the type of queries we can serve our users. We can answer more complex questions well, and in general, that all seems to carry over across query categories. Obviously, it's still early, and we are going to be measured and put user experience at front, but we are positive about what this transition means.
And on the second question, in terms of the various work streams, as both Sundar and I said, we remain very focused on ongoing efforts to slow the pace of expense growth, what we've been calling durably re-engineering our cost base. And I made this point in opening comments, but we are very cognizant of the increasing headwind we have from higher depreciation and expenses associated with the higher CapEx. And so these efforts are ongoing, and they're very much the same that we've talked with you about previously. It starts with product and process prioritization, all of the work around organizational efficiency and structure. These are ongoing. And so as an example, the work that Sundar talked about, combining devices and services with our platforms and ecosystems, product area is a really good example, because unifying the teams not only helps us deliver higher quality products and experiences, but we think it enables us to move with greater velocity and efficiency. And then the other work streams we've talked to you about in the past, like all of the work around technical infrastructure, which Sundar alluded to, streamlining operations within the company through the use of AI, what we're doing with procurement with our suppliers and vendors, which he also referenced, the work you've seen on real estate optimization. These are all ongoing work streams, which is why we have them under the umbrella durably re-engineering our cost base, and they are ongoing.
Our next question comes from Doug Amuth with JP Morgan. Your line is now open.
Thanks for taking the questions. Sundar, you talked about bringing more generative AI features into the main search page. Can you just talk about what kind of queries or scenarios you think that's working best for so far, and just how we should think about the cadence of continuing to adopt more of those features within core search? And then, Ruth, on CapEx spending, the $12 billion in 1Q, can we assume that run rating that and above is reasonable for this year? And I know it's very early, but should we generally expect higher CapEx next year as well?
Thanks, Doug. On SGE in search, look, I think it tends to we are seeing early confirmation of our thesis that this will expand the universe of queries where we are able to really provide people with a mix of factual answers, a link to sources across the web, and bring a variety of perspectives, all in an innovative way. And we've been rolling out AI overviews in the US and UK, trying to mainly tackle queries which are more complex, where we think the SGE will clearly improve the experience. We've already served billions of queries, and it seems to cut across categories. But we are still continuing our testing, and we'll keep. We are metrics driven in these areas, and so we'll. But I am optimistic that it clearly improves the user experience. Users are telling us that, and we are seeing it in our metrics, and we'll continue evolving it through the course of this year.
And then in terms of CapEx, as I said in opening comments, we do expect the quarterly CapEx throughout the year to be roughly at or above the $12 billion cash CapEx we had here in Q1. As I said, you can always have variability in the reported quarterly CapEx just due to the timing of cash payments, but roughly at or above this level. And it really goes to Sundar's comment, opening comment, that we're very committed to making the investments required to keep us at the leading edge in technical infrastructure to support the growth in cloud, all the innovation in search that he and Philip have spoken about, and our lead with Gemini. I will note that most, nearly all, I should say, of the CapEx was in our technical infrastructure. We expect that our investment in office facilities will be about less than 10% of the total CapEx in 2024, roughly flat with our CapEx in 2023, but is still there. And then with respect to 2025, as he said, it's premature to comment, so nothing to add on that.
Great. Thank you.
Our next question comes from Eric Sheridan with Goldman Sachs. Please go ahead.
Thanks so much. Maybe just one question of the big picture nature for Sundar. Sundar, if we come back to your earlier comments at the beginning of the call and framing up longer-term initiatives and longer-term narratives, wanted to know if you could talk a little bit about both the opportunities and the challenges of operating at scale in a time like this where there's a lot of technology innovation going on, and how you see the elements of trying to strike a balance towards moving the organization forward while still, continuing to both invest for growth as well as balance margins. Thanks so much.
Thanks, Eric. Great question. Obviously, I think the AI transition, I think it's a once-in-a-generation kind of an opportunity. We've definitely, been gearing up for this for a long time. You can imagine we started building TPUs in 2016. So we've definitely been gearing up for a long time. The real opportunities we see is the scale of, research and innovation which we've built up and are going to continue to deliver. I think for the first time, we can work on AI in a horizontal way, and it impacts the entire breadth of the company, be it search, be it YouTube, be it cloud, be it Waymo, and so on. And we see rapid pace of innovation in that underlying. So it's a very leveraged way to do it, and I see that as a real opportunity ahead. In terms of the challenges, I think making sure I think we are constantly. I think it's been a mindset shift which we've been driving across the company to make sure that we are embracing this opportunity, but being very efficient in how we are approaching it, making sure we are redirecting our people to the highest priorities across the company, building on our 20 years of experience in driving machine efficiencies year on year, so that we can put our dollars to work as efficiently as possible. So making sure balancing all of that, moving forward in a very bold and responsible way at the same time. Those are the important things to get right from my perspective.
Our next question comes from Stephen Ju with UBS. Your line is now open.
Right. Thank you so much. So, hi, Philip. I think it's approaching the 2-year anniversary for the launch of ads on YouTube Shorts, and I think you've given us an update on monetization pickup sequentially. But, with that in mind, I think, YouTube has launched an array of ad products and automation tools to help advertisers transfer what they're doing to the vertical screen. So, how is this translating into buy-in among your advertiser clients? And secondly, based on what you've seen over the last 2 years, are there any structural reasons that you can cite as to why the monetization cannot match what is already the case on the horizontal screen? Thanks.
Yeah, look, this is a great question. First of all, let's start with the fact that YouTube performance was very strong and this quarter. And on Shorts, specifically in the US, I mentioned how the monetization rate of Shorts relative to in-stream viewing has more than doubled in the last 12 months. I think that's what you were referring to. Yes, we're obviously very happy with this development. The way to think about it is advertisers really only spend with us when they see a positive ROI. So you can assume that this wouldn't be happening unless it were to work for advertisers in the short term and also in the long term. That's an important part, I think. Overall, Shorts is a long-term bet for the business. It has really helped us respond to both creator and viewer demand for short-form video. We talked about the strong growth, averaging 70 billion daily views. I mentioned a number of channels. Uploading has increased 50% year over year. So again, very happy with this development. And to your question, structural reasons, whether we can't get to a match here, I have a hard time seeing those at the moment over time.
Okay, thank you.
Our next question comes from Justin Post with Bank of America. Your line is now open.
Great, thank you. I'm going to ask another one about CapEx. It seems to be your biggest investment area. Just first, you saw the big uptick the last 2 quarters. but you've been investing in AI for years. Is the uptick because supply is getting easier to get, or do you see more opportunities with the available supply to really fuel AI? So it has the GPUs and everything gotten better that you feel more investing more? And then thinking about the returns both for advertising and cloud on the CapEx, do you feel like this is a higher cost of doing business, or do you think this is an opportunity to even get better returns on your capital spend than you've had in the past? Thank you.
So the increase in CapEx, as Sundar said and I said, really reflects the opportunity we continue to see across the company. It starts with all that we're doing in support of the foundation model, all the Gemini foundational model, but then also clearly the work across cloud on behalf of cloud customers and the growth that we're seeing with GCP and the infrastructure work there. And of course, as both Sundar and Philip talked about, the application across search, YouTube, and more broadly, the services that we're able to offer. So it's the growing application and our focus on ensuring that we have the compute capacity to deliver in support of the services and opportunities we see across Alphabet. And it really goes to the second part of your question, which is that as we're investing in CapEx and applying it across our various businesses, it opens up more service and products, which bring revenue opportunities, and we're very focused on the monetization opportunity. It does underlie everything that we're doing in Google Services and Google Cloud. And as Sundar noted, we're at the same time very focused on the efficiency of all elements of delivering that compute capacity from hardware, software, and beyond.
Our next question comes from Mark Mahaney with Evercore. Your line is now open.
Great, thank you. This is Jan Lee for Mark Mahaney. A couple questions. One, just maybe an expansion on the search query question from before. More like search volume, and maybe in the context of the off-Google environment, like AI chatbot, for example, we've seen kind of Meta AI directing to Google search results. Do you think there's actually a scenario where like AI system can create a step function change in search volume or use cases off Google? If you can give us more color on what are you seeing right now or what are you expecting to see in that area? And then the second question on just the comment of YouTube and cloud exiting at 100 billion run rate. What is informing this outlook of visibility for you? If you can talk about, is it driven by any sort of cloud demand inflection or step change in the Gen AI workload demand? If you can flesh it out a little bit, thanks a lot.
You know, on your first question, look, you know, I said this before, but to be clear, you know, we view this moment as a positive moment for search. And I think it allows us to evolve our product in a profound way. And search is a unique experience. You know, people come and they get to, you know, be it if you want answers, if you want to explore more, if you want to get perspectives from across the web, and to be able to do it across the breadth and depth of everything they are looking for, and the innovation you would need to keep that up. I think it's what we've been you know, building on for a long time, and so I feel we are extraordinarily well set up, particularly given the innovation path we are on. And overall, I view this moment as a positive moment. So that's how I would say it. On the second part, Ruth?
I'm sorry, what was the
YouTube and cloud.
Yeah, like in terms of your comment about 100 billion exit rate for YouTube and cloud, what's driving this visibility for you, and any kind of inflection you're seeing in the cloud demand?
Oh, I would just say from Sundar's opening comments, it's just the ongoing momentum that we've seen in the business that we've been talking about, the ongoing growth, the strong performance. And so what we were really getting at in that comment, what Sundar was getting at, is that we've continued to build strong businesses over time, and that just helps dimension it. We had similar comments last quarter when you talk about our subscription business. We're really proud of all the work that teams are doing across the company, building new, strong opportunities, delivering for our users, for customers, for advertisers in profound ways. And so it was just helping to dimension what we have built over the years.
Our next question comes from Ken Gorelski with Wells Fargo. Your line is now open.
Thank you very much. Two, if I may. First, on GCP, you had nice acceleration in the quarter. Could you talk a little bit about the opportunities and constraints upon GCP's ability to continue to address that large addressable market and accelerate growth? Is it more sales oriented? Is it more product sales solutions, or both? And do you plan to address most of these organically, or could a partner approach work for you? And then the second one, just more detailed on YouTube and sports rights. Could you reiterate your view on further live sports rights? There's some larger, mostly in the U.S. league rights coming up soon, and will be more over the next several years. Could you just talk about your philosophy there beyond NFL Sunday Ticket? Thank you.
Thanks. Look, on the cloud side, obviously, it's definitely a point of inflection overall. I think the AI transformation is making everyone think about, their whole stack, and we are engaged in a number of conversations. I think, be it AI infrastructure, people really looking to Vertex AI, given our depth and breadth of model choice, or using Workspace to transform productivity in your workplace, etc. So I think the opportunities there are all related to that, both all the work we have built up and AI being a point of inflection in terms of driving conversations. I think you'll see us do it both organically and with a strong partner program as well. So we'll do it with a combination. And the challenges here are always, and there are switching costs to cloud, and the challenges we see is how do we make it easier for people. There's a lot of interest, but there's definitely barriers in terms of people switching, and so that's an area where we are constantly investing to make it easier for our customers.
And with regard to your sports rights question, look, I mean, we've had longstanding and significant partnerships with the most popular sports league here in the US, around the globe, federations, teams, athletes, broadcasters. And obviously these partnerships in combination with our very vast audience of sports fans drives investment in subscription experiences across many offerings, NFL Sunday Ticket, YouTube TV, YouTube primetime channels, and so on. But there's nothing that we have to announce at the moment. We're obviously always looking at where we can create more value for our users, for our advertisers, for creators, but nothing specific to talk about at this moment.
Thank you.
Our next question comes from Ross Sandler with Barclays. Your line is now open.
Great. Sundar, I had a question about smartphone-based AI searches. So you guys are powering all these new AI interactions and searches on Pixel and on Samsung devices, and I think there's speculation that Gemini might be used on iOS in the future state. So the question is, if users start searching on smartphones and those searches are basically rendered on the model on the phone without accessing the web, how do you guys anticipate monetizing some of these smartphone-based behaviors that are kind of run on the edge? Any thoughts on that?
Look, I think if you look at what users are looking for, people are looking for information and an ability to connect with things outside. So I think there'll be a set of use cases which you'll be able to do on device. But for a lot of what people are looking to do, I think you will need the richness of the cloud, the web, and you have to deliver it to users. So I think again, to my earlier comments, I think through all these moments, you saw what we have done with Samsung, with Circle to Search. I think it gives a new way for people to access search conveniently wherever they are. And so I view this as a positive way to bring our services to users in a more seamless manner. So I think it's positive from that perspective. In terms of on-device versus cloud, there will be needs which can be done on device, and we should to help it from a privacy standpoint. But there are many, many things for which people will need to reach out to the cloud. And so I don't see that as being a big driver in the on-cloud versus off-cloud in any way.
And our last question comes from Colin Sebastian with Baird. Your line is now open.
Thanks, and good afternoon. I guess first, follow up on some of the questions on SGE and the core search. I guess I'm wondering, along with some of those changes in behavior, is there a way to quantify that overall engagement shift, whether that's an increase in time spent or increase in or the level of increase in queries for both sort of traditional search as well as more generative answers? And then secondly, on the hardware roadmap, I assume later this year we'll hear more about some of the products. But any areas of a particular focus or that you would point out that we should keep in mind in terms of hardware launches in the back half? Thank you.
Look, on the first question on search, not much more to add to what I said, but what we have seen, and remember we've been in live experiments just for a few weeks and in US and UK and on a slice of our queries where and all indications are positive that it improves user satisfaction. We see an increase in engagement, but I see this as something which will play out over time. But if you were to step back, this moment, there were a lot of questions last year, and we always felt confident and comfortable that we would be able to improve the user experience. People question whether these things would be costly to serve, and we are very, very confident we can manage the cost of how to serve these queries. People worried about latency. I think we are, when I look at the progress we have made in latency and efficiency, we feel comfortable. There are questions about monetization, and based on our testing so far, I'm comfortable and confident that we'll be able to manage the monetization transition here well as well. It'll play out over time, but I feel we are well positioned. And more importantly, when I look at the innovation that's ahead and the way the teams are working hard on it, I am very excited about the future ahead.
Thank you. And that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Thanks, everyone, for joining us today. We look forward to speaking with you again on our second quarter 2024 call. Thank you, and have a good evening.
All right, folks, so that does it for the Google conference call, or Alphabet as they prefer to identify as these days. We're going to be switching gears over to Microsoft shortly here, and I think it's going to be an interesting call with them as well. The Google call was well received overall. We can see that the stock was bid up throughout the call, so we're just going to quickly pop back to that chart of Google, and the call started at 4:30. It was bid up. We did give some of that back, but we also have this huge level of resting liquidity below that seems to be acting as support. So overall, pretty positive reaction to the stock, trading at all-time highs after hours earlier, and it's bid up. Let's see here. At this time, it's bid up just about 12.85% after hours. A lot of mentions on AI, improving progress in some of their advertising initiatives, and certainly seeing some good progress in Google Compute, in YouTube Shorts, and otherwise. So I would say that the market liked what it heard. It also got a $70 billion buyback, a 20-cent dividend. And so things over at Google seem to be taking that path of efficiency. The market was really hoping to hear from Meta and did not. So talk about a tale of two different outcomes. So we'll be getting ready with the Microsoft earnings call here shortly as that starts. Let's just see if they have any kind of fun hold music for us at this point. Oh yeah, this is great. So I'll go ahead and mute that for a minute until the call gets going. But we are very close to the start of the Microsoft earnings call, and I'll host that. I think it'll go on till about 6:30 Eastern with the Q&A session, and then we'll have some closing remarks and thoughts as we get into the market tomorrow. But so far, looks like we're going to have a pretty strong update tomorrow. The biggest risk is going to be PCE. going into tomorrow. That is something that if it came in materially higher than expected year over year and month over month, could add to the theme of what we saw quarter over quarter today with the GDP data and give rates a scare higher and risk assets a bit of a move lower. But on the other side of that, if it comes in line or cooler than expected with these earnings as a tailwind, should have a pretty decent trading day tomorrow to the upside. So let's go back to the Microsoft earnings call, as it should be starting any moment now, and I'll subject you to some of their hold music as we wait. I mean, it sounds very upbeat, so I guess we're at least expected to think this is going to be good stuff, right?
Greetings and welcome to the Microsoft Fiscal Year 2024 Third Quarter Earnings Conference Call. At this time, all participants are in a listen-only mode. A question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star 0 on your telephone keypad. As a reminder, this conference is being recorded. I would now like to turn the conference over to your host, Brett Iverson, Vice President of Investor Relations.
Good afternoon, and thank you for joining us today. On the call with me are Satya Nadella, Chairman and Chief Executive Officer, Amy Hood, Chief Financial Officer, Alice Jalla, Chief Accounting Officer, and Keith Dolliver, Corporate Secretary and Deputy General Counsel. On the Microsoft Investor Relations website, you can find our earnings press release and financial summary slide deck, which is intended to supplement our prepared remarks during today's call and provides the reconciliation of differences between GAAP and non-GAAP financial measures. More detailed Outlook slides will be available on the Microsoft Investor Relations website when we provide Outlook commentary on today's call. On this call, we will discuss certain non-GAAP items. The non-GAAP financial measures provided should not be considered as a substitute for or superior to the measures of financial performance prepared in accordance with GAAP. They are included as additional clarifying items to aid investors in further understanding the company's third quarter performance, in addition to the impact these items and events have on the financial results. All growth comparisons we make on the call today relate to the corresponding period of last year unless otherwise noted. We will also provide growth rates in constant currency when available as a framework for assessing how our underlying businesses performed, excluding the effect of foreign currency rate fluctuations. Where growth rates are the same in constant currency, we'll refer to the growth rate only. We will post our prepared remarks to our website immediately following the call until the complete transcript is available. Today's call is being webcast live and recorded. If you ask a question, it will be included in our live transmission, in the transcript, and in any future use of the recording. You can replay the call and view the transcript on the Microsoft Investor Relations website. During this call, we'll be making forward-looking statements, which are predictions, projections, or other statements about future events. These statements are based on current expectations and assumptions that are subject to risks and uncertainties. Actual results could materially differ because of factors discussed in today's earnings press release, in the comments made during this conference call, and in the risk factors section of our Form 10-K, Forms 10-Q, and other reports and filings with the Securities and Exchange Commission. We do not undertake any duty to update any forward-looking statement. And with that, I'll turn the call over to Satya.
Thank you, Brett. It was a record third quarter powered by the continued strength of Microsoft Cloud, which surpassed $35 billion in revenue, up 23%. Microsoft Copilot and Copilot Stack, spanning everyday productivity, business process, and developer services to models, data, and infrastructure, are orchestrating a new era of AI transformation, driving better business outcomes across every role and industry. Now I'll highlight examples walking up the stack, starting with AI infrastructure. Azure again took share as customers use our platforms and tools to build their own AI solutions. We offer the most diverse selection of AI accelerators, including the latest from NVIDIA, AMD, as well as our own first-party silicon. Our AI innovation continues to build on our strategic partnership with OpenAI. More than 65% of the Fortune 500 now use Azure OpenAI service. We also continue to innovate and partner broadly to bring customers the best selection of frontier models and open source models, LLMs and SLMs. With 5.3, which we announced earlier this week, we offer the most capable and cost-effective SLM available. It's already being trialed by companies like CallMiner, LTI, Mindtree, PwC, and TCS. Our Models as a Service offering makes it easy for developers to use LLMs and SLMs without having to manage any underlying infrastructure. Hundreds of paid customers from Accenture and EY to Schneider Electric are using it to take advantage of API access to third-party models, including, as of this quarter, the latest from Cohere, Meta, and Mistral. And as part of a partnership announced last week, G42 will run its AI applications and services on our cloud. All up, the number of Azure AI customers continues to grow, and average spend continues to increase. We also saw an acceleration of revenue from migrations to Azure. Azure Arc continues to help customers like Dick's Sporting Goods and World Bank streamline their cloud migrations. Arc now has 33,000 customers, up over 2x year over year, and we are the hyperscale platform of choice for SAP and Oracle workloads, with Conduent and Medline moving their on-premise Oracle estates to Azure, and Kyndryl and L'Oreal migrating their SAP workloads to Azure. Overall, we are seeing an acceleration in the number of large Azure deals from leaders across industries, including billion-dollar-plus multi-year commitments announced this month from Cloud Software Group and the Coca-Cola Company. The number of $100 million-plus Azure deals increased over 80% year over year, while the number of $10 million-plus deals more than doubled. Now on to data and analytics. Our Microsoft Intelligent Data Platform provides customers with the broadest capabilities spanning databases, analytics, business intelligence, governance, and AI. Over half of our Azure AI customers also use our data and analytics tools. Customers are building intelligent applications running on Azure, PostgreSQL, and Cosmos DB with deep integrations with Azure AI. TomTom is a great example. They've used Cosmos DB along with Azure OpenAI Service to build their own immersive in-car infotainment system. We are also encouraged by our momentum with our next-generation analytics platform, Microsoft Fabric. Fabric now has over 11,000 paid customers, including leaders in every industry, from ABB, EDP, Energy Transfer to Equinor, Foot Locker, Itochu, and Lumen, and we are seeing increased usage intensity. Fabric is seamlessly integrated with Azure AI Studio, meaning customers can run models against enterprise data that's consolidated in Fabric's multi-cloud data lake, OneLake. And Power BI, which is also natively integrated with Fabric, provides business users with AI-powered insights. We now have over 350,000 paid customers. Now on to developers. GitHub Copilot is bending the productivity curve for developers. We now have 1.8 million paid subscribers, with growth accelerating to over 35% quarter over quarter, and continues to see increased adoption from businesses in every industry, including Itaú, Lufthansa Systems, Nokia, Pinterest, and Volvo Cars. Copilot is driving growth across the broader GitHub platform too. AT&T, Citigroup, and Honeywell all increased their overall GitHub usage after seeing productivity and code quality increases with Copilot. All up, more than 90% of the Fortune 100 are now GitHub customers, and revenue accelerated over 45% year over year. Anyone can be a developer with new AI-powered features across our low-code, no-code tools, which makes it easier to build an app, automate workflow, or create a Copilot using natural language. 30,000 organizations across every industry have used Copilot Studio to customize Copilot for Microsoft 365 or build their own, up 175% quarter over quarter. Cineplex, for example, built a Copilot for customer service agents, reducing query handling time from as much as 15 minutes to 30 seconds. All up, over 330,000 organizations, including over half of Fortune 100, have used AI-powered capabilities in Power Platform, and Power Apps now has over 25 million monthly active users, up over 40% year over year. Now on to future of work. We are seeing AI democratize expertise across the workforce. What inventory turns are to efficiency of supply chains, knowledge turns, the creation and diffusion of knowledge are to productivity of an organization. and Copilot for Microsoft 365 is helping increase knowledge turns. That's having a cascading effect, changing work artifacts and workflows, and driving better decision-making, collaboration, and efficiency. This quarter, we made Copilot available to organizations of all types and sizes, from enterprises to small businesses. Nearly 60% of the Fortune 500 now use Copilot, and we have seen accelerated adoption across industries and geographies with companies like Amgen, BP, Cognizant, Koch Industries, Moody's, Novo Nordisk, NVIDIA, and Tech Mahindra purchasing over 10,000 seats. We're also seeing increased usage intensity from early adopters, including a nearly 50% increase in the number of Copilot-assisted interactions per user in Teams, bridging group activity with business process workflows and enterprise knowledge. And we're not stopping there. We're accelerating our innovation, adding over 150 Copilot capabilities since the start of the year. With Copilot in Dynamics 365, we're helping businesses transform every role and business function as we take share with our AI-powered apps across all categories. This quarter, we made our Copilot for Service and Copilot for Sales broadly available, helping customer service agents and sellers at companies like Land O'Lakes, Northern Trust, Rockwell Automation, and Toyota Group generate role-specific insights and recommendations from across Dynamics 365 and Microsoft 365, as well as third-party platforms like Salesforce, ServiceNow, and Zendesk. And with our Copilot for Finance, we are drawing context from Dynamics as well as ERP systems like SAP to reduce labor-intensive processes like collections and contract and invoice capture for companies like Dentsu and IDC. ISVs are also building their own Copilot integrations. For example, new integrations between Adobe, Experience Cloud, and Copilot will help marketeers access campaign insights in the flow of their work. When it comes to devices, Copilot in Windows is now available on nearly 225 million Windows 10 and Windows 11 PCs, up 2x quarter over quarter. With Copilot, we have an opportunity to create an entirely new category of devices purpose-built for this new generation of AI. All of our largest OEM partners have announced AI PCs in recent months, and this quarter we introduced new Surface devices, which includes integrated NPUs to power on-device AI experiences like auto-framing and live captions. And there's much more to come. In just a few weeks, we'll hold a special event to talk about our AI vision across Windows and devices. When it comes to Teams, we once again saw year-over-year usage growth. We're rolling out a new version, which is up to 2 times faster while using 50% less memory to all customers. We surpassed 1 million Teams rooms for the first time as we continue to make hybrid meetings better with new AI-powered features like automatic camera switching and speaker recognition. And Teams Phone continues to be the market leader in cloud calling, now with over 20 million PSTN users, up nearly 30% year over year. All of this innovation is driving growth across Microsoft 365. Companies across the private and public sector, including Amadeus, BlackRock, Chevron, Ecolab, Kimberly-Clark, all chose our premium E5 offerings this quarter for advanced security, compliance, voice, and analytics. Now on to industry and cross-industry clouds. We're also bringing AI-powered transformation to every industry. In healthcare, DAX Copilot is being used by more than 200 healthcare organizations, including Providence, Stanford Healthcare, and WellSpan Health. And in manufacturing this week at Hanover Massey, customers like BMW, Siemens, and Volvo Penta shared how they're using our cloud and AI solutions to transform factory operations. Now on to security. Security underpins every layer of the tech stack, and it's our number one priority. We launched our Secure Future initiative last fall for this reason, bringing together every part of the company to advance cybersecurity protection, and we are doubling down on this very important work, putting security above all else, before all other features and investments. We are focused on making continuous progress across the 6 pillars of this initiative as we protect tenants and isolate production systems, protect identities and secrets, protect networks, protect engineering systems, monitor and detect threats, and accelerate responses and remediation. We remain committed to sharing our learnings, tools, and innovation with customers. A great example is Copilot for Security, which we made generally available earlier this month, bringing together LLMs with domain-specific skills informed by our threat intelligence and 78 trillion daily security signals to provide security teams with actionable insights. Now let me talk about our consumer businesses, starting with LinkedIn. We continue to combine our unique data with this new generation of AI to transform the way members learn, sell, and get hired. Features like LinkedIn AI-assisted messages are seeing a 40% higher acceptance rate and accepted over 10% faster by job seekers, saving hirers time and making it easier to connect them to candidates. Our AI-powered collaborative articles, which have reached over 12 million contributions, are helping increase engagement on the platform, which reached a new record this quarter. New AI features are also helping accelerate LinkedIn Premium growth, with revenue up 29% year over year. And we are also seeing strength across our other businesses, with hiring taking share for the 7th consecutive quarter. Now on to search advertising and news. We once again took share across Bing and Edge as we continue to apply this new generation of AI to transform how people search and browse. Bing reached over 140 million daily active users, and we are particularly encouraged by our momentum in mobile. Our free Copilot apps on iOS and Android saw a surge in downloads after our Super Bowl ad and are among the highest rated in this category. We also rolled out Copilot to our ad platform this quarter, helping marketeers use AI to generate recommendations for product images, headlines, and descriptions. Now on to gaming. We are committed to meeting players where they are by bringing great games to more people on more devices. We set third quarter records for game streaming hours, console usage, and monthly active devices. And last month, we added our first Activision Blizzard title, Diablo IV, to our Game Pass service. Subscribers played over 10 million hours within the first 10 days, making it one of our biggest first-party Game Pass launches ever. We were also encouraged by ongoing success of Call of Duty's Modern Warfare 3, which is attracting new gamers and retaining franchise loyalists. Finally, we are expanding our games to new platforms, bringing 4 of our fan-favorite titles to Nintendo Switch and Sony PlayStation for the first time. In fact, earlier this month, we had 7 games among the top 25 on the PlayStation Store, more than any other publisher. In closing, I'm energized about our opportunity ahead as we innovate to help people and businesses thrive in this new era. With that, let me turn it over to Amy.
Thank you, Satya, and good afternoon, everyone. Our third quarter revenue was $61.9 billion, up 17%, and earnings per share was $2.94, up 20%. Results exceeded expectations, and we delivered another quarter of double-digit top and bottom line growth, with continued share gains across many of our businesses. In our commercial business, bookings increased 29% and 31% in constant currency, significantly ahead of expectations, driven by Azure commitments with an increase in average deal size and deal length, as well as strong execution across our core annuity sales motions. In Microsoft 365, suite strength contributed to ARPU expansion for our Office commercial business, although new business growth continued to moderate for standalone products sold outside the Microsoft 365 suite. Commercial remaining performance obligation increased 20% and 21% in constant currency to $235 billion. Roughly 45% will be recognized in revenue in the next 12 months, up 20% year over year. The remaining portion, recognized beyond the next 12 months, increased 21%. And this quarter, our annuity mix increased to 97%. In our consumer business, PC market demand was slightly better than we expected, benefiting Windows OEM, while advertising spend landed relatively in line with our expectations. In gaming, we also saw better than expected performance of Activision titles, benefiting Xbox content and services. At a company level, Activision contributed a net impact of approximately 4 points to revenue growth, was a 2-point drag on operating income growth, and had a negative 4-cent impact to earnings per share. A reminder that this net impact includes adjusting for the movement of Activision content from our prior relationship as a third-party partner to first party, and also includes $935 million from purchase accounting adjustments, integration, and transaction-related cost. FX did not have a significant impact on our results and was roughly in line with our expectations on total company revenue, segment-level revenue, COGS, and operating expense growth. Microsoft Cloud revenue was $35.1 billion and grew 23%, ahead of expectations. Microsoft Cloud gross margin percentage decreased slightly year over year to 72%, a bit better than expected. Excluding the impact of the change in accounting estimate for useful lives, gross margin percentage increased slightly, driven by improvement in Azure and Office 365, even with the impact of scaling our AI infrastructure, partially offset by sales mix shift to Azure. Company gross margin dollars increased 18% and gross margin percentage increased slightly year over year to 70%. Excluding the impact of the change in accounting estimate, gross margin percentage increased roughly 1 point, even with the impact from the purchase accounting adjustments, integration, and transaction-related costs from the Activision acquisition. Growth was driven by the improvement in Azure and Office 365 just mentioned, as well as sales mix shift to higher margin businesses. Operating expenses increased 10% with 9 points from the Activision acquisition. At a total company level, headcount at the end of March was 1% lower than a year ago. Operating income increased 23% and operating margins increased roughly 2 points year over year to 45%. Excluding the impact of the change in accounting estimate, operating margins increased roughly 3 points, driven by the higher gross margin noted earlier and improved operating leverage through continued cost discipline. Now to our segment results. Revenue from productivity and business processes was $19.6 billion and grew 12% and 11% in constant currency, in line with expectations. Office commercial revenue grew 13% and 12% in constant currency. Office 365 commercial revenue increased 15%, in line with expectations, driven by healthy renewal execution, ARPU growth from continued E5 momentum, and early Copilot for Microsoft 365 progress. Paid Office 365 commercial seats grew 8% year over year, with installed base expansion across all customer segments. Seat growth was again driven by our small and medium business and frontline worker offerings, although growth continued to moderate in SMB. Office commercial licensing declined 20% and 18% in constant currency, with continued customer shift to cloud offerings. Office consumer revenue increased 4%, slightly below expectations. Microsoft 365 subscriptions grew 14% to 80.8 million. LinkedIn revenue increased 10% and 9% in constant currency, ahead of expectations, driven by slightly better than expected performance in our premium subscriptions and Talent Solutions businesses. However, in Talent Solutions, bookings growth continues to be impacted by the weaker hiring environment in key verticals. Dynamics revenue grew 19% and 17% in constant currency, ahead of expectations. Growth was driven by Dynamics 365, which grew 23% and 22% in constant currency, with continued growth across all workloads, and better than expected new business, although bookings growth remains moderated. Segment gross margin dollars increased 11%, and gross margin percentage decreased slightly year over year. Excluding the impact of the change in accounting estimate, gross margin percentage increased slightly, driven by improvement in Office 365. Operating expenses increased 1%, and operating income increased 17% and 16% in constant currency. Next, the Intelligent Cloud segment. Revenue was $26.7 billion, increasing 21%, ahead of expectations with better than expected results across all businesses. Overall, server products and cloud services revenue grew 24%. Azure and other cloud services revenue grew 31%, ahead of expectations, while our AI services contributed 7 points of growth as expected. In the non-AI portion of our consumption business, we saw greater than expected demand broadly across industries and customer segments, as well as some benefit from a greater than expected mix of contracts with higher in-period recognition. In our per-user business, the enterprise mobility and security install base grew 10% to over 274 million seats, with continued impact from the growth trends in new standalone business noted earlier. In our on-premises server business, revenue increased 6%, ahead of expectations, driven by better than expected renewal strength, particularly for contracts with higher in-period revenue recognition. Enterprise and partner services revenue decreased 9% on a strong prior year comparable for enterprise support services. Segment gross margin dollars increased 20%, and gross margin percentage decreased slightly year over year. Excluding the impact of the change in accounting estimate, percentage increased slightly, primarily driven by the improvement in Azure noted earlier, even with the impact of scaling our AI infrastructure, partially offset by sales mix shift to Azure. Operating expenses increased 1%, and operating income grew 32%. Now to more personal computing. Revenue was $15.6 billion, increasing 17%, with 15 points of net impact from the Activision acquisition. Results were above expectations, driven by better-than-expected performance in gaming and Windows OEM. Windows OEM revenue increased 11% year over year, ahead of expectations, primarily driven by the slightly better PC market noted earlier, as well as mix shift to higher monetizing markets. Windows commercial products and cloud services revenue increased 13% and 12% in constant currency, below expectations, with impact from the growth trends in new standalone business noted earlier, as well as lower in-period revenue recognition from the mix of contracts. Devices revenue decreased 17% and 16% in constant currency as we remained focused on our higher margin premium products. Overall, Surface demand was slightly lower than expected. Search and news advertising revenue ex-TAC increased 12%, ahead of expectations, with continued volume growth and increased engagement on Bing and Edge. And in gaming, revenue increased 51% and 50% in constant currency, with 55 points of net impact from the Activision acquisition. Results were ahead of expectations, primarily driven by Call of Duty. Xbox content and services revenue increased 62% and 61% in constant currency, with 61 points of net impact from the Activision acquisition. Xbox hardware revenue decreased 31% and 30% in constant currency. Segment gross margin dollars increased 27% and 26% in constant currency, with 13 points of net impact from the Activision acquisition. Gross margin percentage increased roughly 4 points year over year, primarily driven by sales mix shift to higher margin businesses. Operating expenses increased 41%, with 43 points from the Activision acquisition. Operating income increased 16% and 15% in constant currency. Now, back to total company results. Capital expenditures, including finance leases, were $14 billion to support our cloud demand, inclusive of the need to scale our AI infrastructure. Cash paid for PP&E was $11 billion. Cash flow from operations was $31.9 billion, up 31%, driven by strong cloud billings and collections. Free cash flow was $21 billion, up 18% year over year, reflecting higher capital expenditures to support our cloud and AI offerings. This quarter, other income and expense was negative $854 million, lower than anticipated, driven by losses on investments accounted for under the equity method. Our effective tax rate was approximately 18%. And finally, we returned $8.4 billion to shareholders through dividends and share repurchases. Now, moving to our Q4 outlook, which, unless specifically noted otherwise, is on a U.S. dollar basis. First, FX. Based on current rates, which reflect the recent strengthening of the U.S. dollar, we now expect FX to decrease total revenue and segment-level revenue growth by less than 1 point. When compared to our January guide for Q4 FX, this is a decrease to total revenue of roughly $700 million. We expect FX to decrease COGS growth by approximately 1 point and operating expense growth by less than 1 point. In commercial bookings, we expect solid growth on a relatively flat expiry base, driven by continued strong commercial sales execution. As a reminder, larger long-term Azure contracts, which are more unpredictable in their timing, can drive increased quarterly volatility in our bookings growth rate. Microsoft Cloud gross margin percentage should decrease roughly 2 points year over year. Excluding the impact from the change in accounting estimate, Q4 cloud gross margin percentage will be down slightly, as improvement in Azure, inclusive of scaling our AI infrastructure, will be offset by sales mix shift to Azure. We expect capital expenditures to increase materially on a sequential basis, driven by cloud and AI infrastructure investments. As a reminder, there can be normal quarterly spend variability in the timing of our cloud infrastructure buildouts and the timing of finance leases. We continue to bring capacity online as we scale our AI investments with growing demand. Currently, near-term AI demand is a bit higher than our available capacity. Next, to segment guidance. In productivity and business processes, we expect revenue to grow between 9 and 11% in constant currency, or 19.9 to 20.2 billion US dollars. In Office Commercial, revenue growth will again be driven by Office 365 with seat growth across customer segments and ARPU growth primarily through E5. We expect Office 365 revenue growth to be approximately 14% in constant currency. We continue to progress with adoption of Copilot for Microsoft 365 and remain excited for the long-term growth opportunity. In our on-premises business, we expect revenue to decline in the mid to high teens. In Office Consumer, we expect revenue growth in the low to mid-single digits, driven by Microsoft 365 subscriptions. For LinkedIn, we expect revenue growth in the mid to high single digits, driven by continued growth across all businesses. And in Dynamics, we expect revenue growth in the low to mid-teens, driven by Dynamics 365. For both LinkedIn and Dynamics, the continued bookings growth moderation noted earlier is a headwind to Q4 revenue growth. For Intelligent Cloud, we expect revenue to grow between 19 and 20% in constant currency, or 28.4 to 28.7 billion US dollars. Revenue will continue to be driven by Azure, which, as a reminder, can have quarterly variability primarily from our per-user business and in-period revenue recognition, depending on the mix of contracts. In Azure, we expect Q4 revenue growth to be 30 to 31% in constant currency, or similar to our stronger-than-expected Q3 results. Growth will be driven by our Azure consumption business and continued contribution from AI, with some impact from the AI capacity availability noted earlier. Our per-user business should see benefit from Microsoft 365 suite momentum, though we expect continued moderation in seat growth rates given the size of the installed base. In our on-premises server business, we expect revenue growth in the low to mid-single digits with continued hybrid demand, including licenses running in multi-cloud environments. And in enterprise and partner services, revenue should decline in the mid to high single digits on a high prior year comparable for enterprise support services. In more personal computing, we expect revenue to grow between 10 and 13% in constant currency, or 15.2 to 15.6 billion US dollars. Windows OEM revenue growth should be in the low to mid-single digits as PC market unit volumes continue at pre-pandemic levels. In Windows commercial products and cloud services, customer demand for Microsoft 365 and our advanced security solutions should drive revenue growth in the mid-single digits. As a reminder, our quarterly revenue growth can have variability primarily from in-period revenue recognition, depending on the mix of contracts. In devices, revenue should decline in the mid-teens as we continue to focus on our higher-margin premium products. Search and news advertising ex-TAC revenue growth should be in the low to mid-teens, driven by continued volume strength. This will be higher than overall search and news advertising revenue growth, which we expect to be relatively flat. And in gaming, we expect revenue growth in the low to mid-40s, including approximately 50 points of net impact from the Activision acquisition. We expect Xbox content and services revenue growth in the high 50s, driven by approximately 60 points of net impact from the Activision acquisition. Hardware revenue will decline again year over year. Now, back to company guidance. We expect COGS between 19.6 to 19.8 billion US dollars, including approximately $700 million from purchase accounting, integration, and transaction-related costs from the Activision acquisition. We expect operating expense of 17.15 to 17.25 billion US dollars, including approximately $300 million from purchase accounting, integration, and transaction-related costs from the Activision acquisition. Therefore, we now expect full-year FY24 operating margins to be up over 2 points year over year, even with our cloud and AI investments, the impact from the Activision acquisition, and the headwind from the change in useful lives last year. This operating margin expansion reflects the hard work across every team to drive efficiencies and maintain disciplined cost management, knowing we will continue to grow our cloud and AI investments next year. Other income and expense should be roughly negative $850 million, as interest income will be more than offset by interest expense and losses on investments accounted for under the equity method. As a reminder, we are required to recognize gains or losses on our equity investments, which can increase quarterly volatility. We expect our Q4 effective tax rate to be approximately 18%. Now, I'd like to share some closing thoughts as we look to the next fiscal year. We continue to focus on building businesses that create meaningful value for our customers and therefore significant growth opportunities for years to come. In FY25, that focus and execution should again lead to double-digit revenue and operating income growth. To scale to meet the growing demand signal for our cloud and AI products, we expect FY25 capital expenditures to be higher than FY24. These expenditures over the course of the next year are dependent on demand signals and adoption of our services, so we will manage that signal through the year. We will also continue to prioritize operating leverage, and therefore, we expect FY25 operating margins to be down only about 1 point year over year, even with our significant cloud and AI investments, as well as a full year of impact from the Activision acquisition. We are leading the AI platform wave and are committed to bringing that value to our global customers as we enter the final quarter of our fiscal year. With that, let's go to Q&A, Brett.
Thanks, Amy. We'll now move over to Q&A. Out of respect for others on the call, we request that participants please only ask one question. Operator, can you please repeat your instructions?
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. And our first question comes from the line of Keith Weiss with Morgan Stanley. Please proceed.
Excellent. Thank you guys for taking the question, and congratulations on a fantastic quarter. A lot of excitement in the marketplace around generative AI and the potential of these technologies, but there's also a lot of investment going on behind them. It looks like Microsoft's on track to ramp CapEx over 50% year on year this year to over $50 billion. And there's media speculation of more spending ahead, with some reports talking about like a $100 billion data center. So obviously investments are coming well ahead of the revenue contribution. But what I was hoping for is that you could give us some color on how you as the management team try to quantify the potential opportunities that underlie these investments, because they are getting very big. And maybe if you give us some hint on whether there's any truth to the potential of like a $100 billion data center out there. Thank you so much.
Thank you, Keith, for the question. Let me start, and then maybe you can feel free to add. At a high level, the way we, as a management team, talk about it is there are two sides to this, right? There is training and there's inference. Given that we want to be a leader in this big generational shift and paradigm shift in technology, that's on the training side. We want to be able to allocate the capital required to essentially be training these large foundation models and stay on the leadership position there. And we've done that successfully all the way today, and you've seen it flow through our P&L, and you can continue to see that going forward. Then Amy referenced what we also do on the inference side, which is, one, we first innovate and build products. And of course, we have an infrastructure business that's also dependent on a lot of ISVs building products that run on our infrastructure. And it's all going to be demand driven. In other words, we track very closely what's happening with inference demand. And that's something that we'll manage, as Amy said in her remarks, very, very closely. So we feel, and obviously we've been doing this, quite frankly, Keith, for now multiple years. So this is not the quarter. I realize in the news it's a lot more in the quarter nowadays, but if you look at it, we've been doing what is essentially capital allocation to be a leader in AI for multiple years now, and we plan to sort of essentially keep taking that forward.
And Keith, I do think it's important to really think about our planning cycles, and we do talk about spending sequentially higher, and we look forward to being able to continue to build out the infrastructure needed to meet the demand. Another thing that you really asked in the beginning was the opportunity and the size of that. And I think in some ways it's important to think about every business process that can be impacted and the opportunity that's represented by every business process. And so when you think of it that way, I think the opportunity is significant. The opportunity to power that next wave of quote-unquote cloud infrastructure is important. It's important because we've been the leader through this decade of the cloud transition, and it's important for us to confidently invest to do that in the second wave, building on our success in the first. And I think that's really the best way to think about how we'll spend, is the same way we approached it for a decade. Watch the signal, invest to be a leader in the technical foundation, and then execute consistently to add value to customers. The opportunity is represented by the amount of value we add. And I look forward to being able to, to continue to deliver that.
Excellent. Thank you so much.
Thanks, Keith. Operator, next question, please.
The next question comes from the line of Brent Thill with Jefferies. Please proceed.
Satya, how would you characterize the demand environment? On one hand, you have bookings and Azure both accelerating year over year in the quarter, but we're seeing a lot of future concern and hesitation from other vendors we all cover. So I think everyone would love to get your sense of budget health for customers this year.
A great question, Brent. There are a couple of things I would say. On the Azure side, which I think is what you specifically asked, we feel very, very good about we're fundamentally a share taker there, because if you look at it from our perspective at this point, Azure has become a port of call for pretty much anybody who is doing any AI project. So that's sort of been a significant help for us in terms of acquiring even new customers. Some of the logos I even referenced in my remarks are new Azure customers. So that's one. The second thing that we're also seeing is AI just doesn't sit on its own. So AI projects obviously start with calls to AI models, but they also use a vector database. In fact, Azure Search, which is really used by even ChatGPT, is one of the fastest growing services for us. We have Fabric integration to Azure AI, and so Cosmos DB integration. So the data tier, the dev tools is another place where we are seeing great attraction. So we are seeing adjacent services in Azure that get attached to AI. And lastly, I would say migrations to Azure as well. So this is not just all an AI story. We are also looking at customers. I mean, this is something that we have talked about in the past, right? Which is, there's always an optimization cycle, but there's also, as people optimize, they spend money on new project starts, which will grow, and then they'll optimize. So it's a continuous side of it. So these are the three trends that are playing out on Azure in terms of what at least we see on demand side.
Thank you.
Thanks, Brent. Operator, next question, please.
And the next question comes from the line of Mark Moerdler with Bernstein Research. Please proceed.
Thank you very much for taking my question, and congratulations on the quarter and the guidance. I want to follow up on the AI, obviously. We're seeing companies shifting their IT spending to invest in and learn about AI rather than receiving additional budgets for AI. At some point, for AI to be transformative, as everyone expects, it needs to be accretive to spending. Satya, when do you believe AI will hit the maturity level where it will be net increase to IT or outside of IT spending, and what would be the leading indicators of that maturation? And Amy, am I characterizing this correctly as it relates to Azure? Some projects are being delayed so that spending could be shifted from core Azure toward Azure AI. Thank you.
Yeah, great set of questions, Mark. Let me just start by saying, a good place to start is to watch what's happening in terms of standard issues for software teams, right? I mean, if you think about it, they bought tools in the past. Now you basically buy tools plus Copilot, right? So you could even say that this is characterized as perhaps shift of what is OpEx dollars into effectively tools spent, because it gives operating leverage to all of the OpEx dollars you're spending today, right? That's really a good example of, I think, what's going to happen across the board. We see that in customer service. We see that in sales. We see that in marketing. Anywhere there's operation. That's why I described it as, knowledge turns, You can even think of it as lean for long-edge work, right? So because it just reduces waste, increases speed, and customer value. And so one of the interesting rate limiters here is culture change inside of organizations. When I say culture change, that means process change. And Amy referenced this even in her answer to the first question, because at the end of the day, companies will have to take a process, simplify the process, automate the process, and apply these solutions. And so that requires not just technology, but in fact, companies to go do the hard work of culturally changing how they adopt technology to drive that operating leverage. And this is where we're going to see firm-level performance differences. So one of the things we see is any customer who is working closely with us, deploying it internally at Microsoft, we see it, right? We're also taking our own medicine to apply this across every process. And we know that this is not just about technology, it's about being able to have the methodology that goes with it. And so we see it in software development, we see it in customer service, we're seeing it even in the horizontal use of Copilot today, where every day people are discovering new workflows that they can optimize. And so that's like the PC when it became standard issue in the early 90s. That's the closest analogy I can come up with. And so yes, it'll take time for it to percolate through the economy, but this is faster diffusion, faster rate of adoption than anything we have seen in the past, as evidenced even by Copilot, right? It's faster than any suite we have sold in the past. But it is going to require workflow and process change.
And Mark, maybe to answer your question on, are we seeing project starts transition from maybe something that was core consumption
We're going to kick
an
things
AI
off
project?
here. I'm going to start off with the disclaimer, which is always everyone's favorite part.
We saw more what Satya was speaking to earlier, which is you see maybe growth in migrations again. You're seeing work in the data space again, and you're seeing AI project starts. And I think that's why maybe you see our growth be different, of course, than you'd see IT budget spend. It's because it's a share, I think, improvement, plus also really focusing on what Satya said. It's about spending maybe in other areas that we don't traditionally think of as being in the IT budget spend under a CIO. It's spend being done by the head of customer service. It's spend being done by the head of marketing. And I do think that will be important as we think about the opportunity ahead.
Incredibly helpful. Thank you both.
Thanks, Mark. Operator, next question, please.
The next question comes from the line of Karl Keirstead with UBS. Please proceed.
Thank you. And Satya and Amy, congrats on these outstanding Azure results. I'd love to hone in a little bit on the 7-point lift to Azure growth from AI. Outstanding number, but it's leveling off a little bit from 6 points in December. I'm wondering if you could unpack that a little bit. To what extent did the capacity issues that you, Amy, highlighted on the call impact that number? Is there any seasonality? I wouldn't think so. Or any other factor that can swing around that number that you'd advise us to keep in mind? Thanks so much.
Thanks, Carl. There's not a seasonality to the number, so you're absolutely right to start there, and it's a good question. The way to think about it is a bit more how much capacity we have in play and how much capacity that we have to sell on the inferencing side in particular. And so that is partially why you see the capital investment in the shape that it is because right this minute we do have demand that exceeds our supply by a bit. So it is fair to say that could have been an impact on the number for the quarter and does impact a little bit the number in Q4.
Okay, helpful. Thank you.
Thanks, Carl. Operator, next question, please.
And the next question comes from the line of Raimo Lenschow with Barclays. Please proceed.
Thank you. I have more a conceptual question for Satya. If you think about Copilot and what you're doing there, you're kind of impacting a lot of different businesses and the opportunities seem very broad-based. How do you think this will play out in the industry between you guys offering certain Copilots versus like the rest of the industry following and everyone seems to have a Copilot now and seems to be talking about that? How does that impact what you want to do, your partner strategy going forward? Thank you.
Yeah, it's a great question. So the way we see it play out is, if you think about it, the way Office was used broadly for knowledge work was in the context of business processes, right? So it's not like when people do knowledge work, they're not doing knowledge work. They're doing knowledge work in support of making progress in the context of sales enablement, customer service, revenue ops, supply chain, or what have you, right? So that's the first thing to know. And they do it inside of email, they do it inside of Teams, they do it inside of Excel, PowerPoint, Word, and what have you. Now we have the ability to essentially bridge the work and the work artifacts inside of these knowledge worker tools with the workflow and the business process and the business process data. So when we think about our Copilot has that ability to integrate, whether it's with ServiceNow, where it has the ability to integrate with SAP, with Salesforce, with obviously Dynamics. That's what we are seeing. In fact, you'll hear us talk a lot about it at our developer conference, which is the extensibility. And Copilot Studio is, it's really off to the races in terms of the product, and most people are excited because one of the things in the enterprise is you want to ground your Copilot with enterprise data, which is in all of these SaaS applications, and Copilot Studio is the tool to use it to make that happen. And so that's what we're seeing, which is we are building a Copilot, which also happens to be an orchestrator of all these other Copilots, which to us appear as extensions. And net, what happens is some of these knowledge worker tools that people have used all the time, right? Because when you think about Teams, when you're having a meeting, you're not doing a random meeting. The meeting is in the context of some business process. It could be a supply chain meeting where you're trying to understand which suppliers to bet on or what terms to do. And so now you can access all of that data right in the Teams context. So that's, I think, what's exciting for us, having built all these horizontal tools, which I would say were underappreciated for the amount of work how people use those tools to make progress on business process, but we now get to bridge that between the business applications and knowledge worker tools more horizontally.
Okay, perfect. Thank you. Congrats from me as well.
Thanks, Raimo. Operator, next question, please.
And the next question comes from the line of Michael Turrin with Wells Fargo. Please proceed.
Hey, great. Appreciate you taking the question. I wanted to go back to Azure. You've been hinting at stabilization there for the past couple of quarters, but still very good to see the bounce. Maybe you can expand on just what the commercial bookings number, appreciating the variability there, does in terms of visibility, and any characterization you can give us around what you're seeing in areas like cost optimization and core workload growth coming back is just helpful context for us in unpacking the numbers. Thank you.
Thanks, Michael. I may take those a bit in reverse. It's a little easier to address them. When you think about, we've been talking about sort of stabilization and what you saw this quarter, if you break down the Azure number, as you saw, which I think I talked a little bit about with Carl, was 7 points of contribution from AI, and you could call then the difference 24 from our core, really Azure business. And within that, the activity we saw on the consumption side was really this balance that we were quite used to and have seen throughout the cloud transition. We saw new workload starts and we saw optimizations. And then those optimizations create new budget and you apply it. And that cycle, which is actually quite normal, we saw it again this quarter in a balanced way. And I think so when we talk about stabilization, or even what we saw between Q2 and Q3, which is a bit of acceleration in that core, was a lot of the newer project starts relating back to not just AI starts, but lots of other workflows that companies are still going from on-prem to cloud. That's why Satya mentioned migrations. And some of that which I know isn't as exciting as talking about all the AI projects, this is still really foundational work to allow companies to take advantage of the cost savings. And the total TCO is still really good. And so I think that balance is really what you saw this quarter. And I feel like there wasn't really a big difference, Michael, across industries or across geos. So I would say it was actually pretty consistent, is the other maybe texture that I could give you to that question. And so then when you're saying, do we keep sort of pointing to stabilization, I really do look sort of workload to workload. What are we seeing? Where are starts? And this one actually felt quite balanced, and optimizations looked like they normally would, which, by the way, is super important. It's something we encourage customers to do. You want to run your workloads as efficiently as you possibly can. It's critical to customers being able to grow and get value out of that. So I sometimes think you all may ask the question more as a negative, and for us, it's just about a healthy cycle at the customer account level.
Now, consistent core cloud growth is still pretty exciting to us as well. Thank you.
Thank you.
Thanks, Michael. Operator, next question, please.
The next question comes from the line of Kirk Materne with Evercore ISI. Please proceed.
Yes, thanks for taking the question. I'll add my congrats on the quarter. Satya, I was wondering if you could chime in on a discussion that comes up a lot with investors, which is, is there a sort of data quality problem in the market in terms of being able to take advantage of all these new Gen AI capabilities? And I was just curious if you could comment on, do you see companies making inroads on sort of addressing that? And do you see that as sort of an inhibitor to AI growth at all at this point? Thanks.
Yeah, it's a great question, because there are two sets of things in order to make sense of successful deployment of these new AI capabilities. I mean, if you sort of say this, what is this AI? It does two things, right? There's a new user experience, there's a natural language interface, and second thing is it's a reasoning engine. And the reasoning engine requires good data, and requires good data for grounding, right? So people talk about something called retrieval augmented generation. And in that context, having good grounding data that then helps with the reasoning, I think, is helpful. And then, of course, people are also looking to sort of fine-tune or RLHF or essentially take the large model and ground it further. So all of these tools are now available. The sophistication of how people can deploy these models across various business processes where there is data and where there is tuning of these models is also getting more widespread. Even as system integrators and other developers are there to help enterprises. So all that's maturing. So we feel, good. And this is where I think on the commercial side, these are some of the harder problems to solve, broad consumer, right? I mean, I think this is a couple of orders of magnitude of improvements in, I'll call it, our models before we can sort of have more sophisticated, open-ended consumer scenarios. Whereas in the enterprise, these are all things we can go tackle. Again, I point to GitHub. If you think about how it's got an entire system, right? It's just not an AI model. It's the AI or the user experience scaffolding, the editor, the chat, the interpreter, and the debugger work along with the continuations of the model to help essentially create these reasoning traces which help the entire thing work. And effectively what we're doing with Copilot, Copilot Studio, and connectors to all these business systems, think of it as we are creating GitHub Copilot-like scenarios for every business system. That's what I think is going to have both what Amy referenced as business value and better grounding. But you're absolutely right in saying a lot of work we're doing with Fabric or Cosmos or Postgres or SQL is about preparing that data so that it can be integrated with these AI projects.
Thank you.
Thanks, Kurt. Operator, we have time for one last question.
And our last question will come from the line of Alex Zukin with Wolfe Research. Please proceed.
Hey, guys. Thanks for taking the question. I wanted to ask the AI question, but from a Microsoft 365 Copilot perspective. I think you talked a little bit about starting to see some of those impacts positively in the quarter on the Office business. I wanted to ask more broadly around that capacity constraint that you alluded to in your prepared remarks, Amy, and kind of how does the easing, how tied are we, like, as you invest for that CapEx and bring more of the capacity online, how much does that unblock or unlock the ability to deliver both a higher Azure AI number as well as a higher Microsoft 365 Copilot number?
Thanks for the question. It's a good opportunity to clarify. I would not say that there is a capacity constraint on the Copilots. It's a real priority for us to make sure we optimize the allocation of our capacity to make sure that those per user businesses are able to continue to grow. And so think about that as our priority one. And so then what that does mean is capacity constraints, when we have them, you'll tend to see them on the Azure infrastructure side, the consumption side of the business is a better way of thinking about it.
Perfect. Thank you.
Thanks, Alex. That wraps up the Q&A portion of today's earnings call. Thank you for joining us today, and we look forward to speaking with all of you soon.
Thank you all.
Thank you.
This concludes today's conference. You may now disconnect your lines at this time. Enjoy the rest of your day.
So, folks, we just heard the calls from Google and Microsoft. Overall, well received by the stocks. Stocks trading overall higher since their earnings were released and since these calls started and came through, both in the sense of Google, Microsoft as well. You know, these are both two stocks that are likely to trade up pretty significantly tomorrow. We've got NASDAQ futures implied to open about up 1.25% on the NASDAQ 100 futures and up about 0.81% on the S&P right now in the after-hours session. So I'd say this is a pretty big reversal from what we saw from Meta, and particularly Alphabet, talking about really it being a year of efficiency for them and leaning into AI, but also not spending aggressively the same way Mark Zuckerberg was talking about at Meta, where he really made the whole call about how much he's going to spend on AI and not really carving a path forward. So this is an interesting contrast. And after hours, we look at Alphabet. Alphabet is currently up 11.33% after hours. Microsoft is currently up 4.86% after hours. Microsoft had some good solid growth in the cloud. They are seeing deceleration in hardware, and they are planning to spend, but it does seem like they're seeing some degree of return on that investment come back, and Copilot's also taking off. So I would say both calls overall pretty optimistic. And we'll have to see how the market digests it over the next 2 or 3 trading days. But I liked what I heard from Microsoft and Google a lot more than what I heard from Meta or Tesla. So that's going to wrap it up for me, Markets and Mayhem from Traderade and Macrovisor. Hope you enjoyed this stream. Appreciate you all tuning in, and I'll catch you real soon.